ago, and we're trying to find the winners and the losers in the industry. And that has really shifted in terms of that horse race over the last few years. It used to be Southwest was the leader in terms of demand growth. Southwest was the leader in terms of overall consumer happiness, or at least right there with Delta. And now we're starting to see a big shift, and it's going a little bit towards United Airlines, believe it or not. This is one that was always pretty much in last place, but I think they've done a really good job on focusing on what they're pretty good at, and that is getting people to from point A to point B at a reasonable price with reasonable amenities. They're not going to blow your socks off, but they're doing a nice job overall of meeting expectations. We see the month over month, the change in consumer happiness among the airlines, United actually leading all of the airlines with a very, very significant move to the upside, which bodes really well for them going into the Thanksgiving and holiday travel season. So, overall, I think United's it's in the spot where, I met this legendary stock commentator and trader named Kevin Hinks one time. And one of the phrases he would use is summer school valedictorian. And I think that that's what we can use here when we talk about United Airlines. None of these are just absolutely blowing people away with unbelievable experiences, but United is definitely getting that most improved trophy at the moment, and that's a really good spot to be.
Hey, let's not bring my academic record into the show, Eddie, please. I mean, come on. But, correct me if I'm wrong. We always loved Delta. We used to love Southwest a lot. United, yes. Remember during COVID when they put in a big plane order during COVID that kind of changed. Remember, we reported on it being a massive investment in the new planes during COVID. So coming out of COVID and with the recent hiccup from Delta, your data, Andy, kind of confirms what we've been seeing in the activities of these companies, which is United's kind of taken over here, aren't they?
Yeah, they are. And, it's some of the stats are pretty mind-blowing. Last quarter, United topped estimates, but they had company records that they set 44 million passengers in the quarter and a single day record of over 500,000 travelers. So they've expanded the fleet, they've expanded the routes, and they're servicing people in what really matters to the customer, and that is, can you get me from point A to point B in a reasonable amount of time, somewhat on time, and at a reasonable cost? And United seems to be delivering on that. We've also seen a pretty significant boost in people talking about booking with United into the future because of their recent announcement that they're going to form an alliance with Starlink to provide better internet service mid-flight, which I think is a pretty big deal to people as well. So United seems to be investing where it really matters for the customer.
Yeah, and I think that's always been the problem on some of the laggards. United and Delta were taking advantage of business class travelers, overseas travel, that higher end seat that people were paying more for. But when you look at the year change in visit numbers are at record levels and above 2019. And here, Andy, because airfares aren't getting cheaper, and that's one of the sticking points for me. It's like there's never sales anymore.
Yeah, I think there's two sides to this coin. One is that the consumer is definitely feeling more of a pinch than they were a year ago. And so I think traffic to these airline websites is down a little bit. But I also think that the aggregators are doing a very reestablishing themselves as the place to go. So, the booking.coms of the world, the Expedias may be taking a significant portion of that traffic away from the direct traffic to the airline sites, which may be reflected in there. But overall, we think that the airline sector is pretty healthy. The macro tailwind is pretty good. It just may be slowing down a little bit.
Earnings score here, Andy, with the stock up just this month, up nearly 13% and hitting those multi-year highs. Do you have an earnings score on this one? Because it just seems like the bar is really elevated.
The bar is really elevated. I think United, if any of the airlines is going to get over the bar, I think United is the one. So we have a positive earnings score, which is kind of a hold your nose, buy it, and hope that the momentum of the trade that's been happening over the last year continues. I think that's very possible. I would say neutral to positive is where we would put things for this earnings call.
Yeah, and remember, Delta reported last week, and even that shutdown of 7,000 flights due to the CrowdStrike issue didn't really negatively impact.
The stock dipped and then rallied.
Then rallied back. All right.
They want to buy. They want to buy these, and so you kind of just have to get out of the way and let the momentum of the trade take you until it doesn't work.
All right, great
Remember,
stuff.
You look pre-COVID. This was a $97 stock.
Yep.
So it's still down significantly off its highs.
Yep. All right, great stuff as always, Andy. Appreciate it.
Thank you, guys.
All right, that's Andy Swan, co-founder at Likefolio, breaking down the data in United. Couple points I wanted to make, Kev. You mentioned that the all-time highs, we're still below them.
Right.
Crude oil prices, near $70 a barrel. Those have, during most of the quarter, they were below $70 a barrel. But the RSI is 71
there it is.
On this
That's
one.
on my notes.
Relative strength indicator.
It's run a long ways. But think about it. My thought on this is almost identical to what Andy was looking. Is that the news is probably going to be good, so they may not sell it. But boy, I don't know how high it's going either, because it's run a long way quickly. So you have to be a little careful here, and maybe. But here's the good news, Tom. If you look at the expected move of about, just about $4, $3.90, let's round it to $4. I looked at just the 1 week 68 call calendar, right? So buying October 25th, selling October 18th, 1 week, the 68 strike, it's got dollar strike, so you can pinpoint it right where you think. It's only trading about 30 cents, less than 35 cents. So it's remember the implied volatilities, almost 90 versus 60 on the first week versus the second. So you are getting that edge on this trade. You still got to be right, though. You still got to be directionally correct. But if you are, pretty inexpensive way to get into this for just the slightest of up moves.
Yep. So let's break this one down. 1 week wide call calendar, buying the October 25th weekly 68 call, selling that same strike in the October 18th options that expire in 3 days. 35-cent debit is what we got up here. The debit you pay is going to be your risk on it. So you're not outlaying a lot of capital on this one. You do have risk, though, that debit that you pay, so $35 per spread. Break evens kept between 63 and about 73, where you can potentially remain profitable. But you mentioned, we talk about that, especially now that we're getting into earnings season.
Yeah.
Those dispersions between implied volatility.
We're going to see a lot of those
in
this quarter.
Where you like to sell a 90% implied volatility on aggregate and then buy a 59% implied volatility on aggregate, which lowers the initial input and risk on this particular trade. Really short-term positioning. Got some assignment risk going into expiration over the next 3 days, so keep that in mind. But it's a flexible type strategy, right, Kev, where, hey, if you're more bearish on this one, maybe you go that one standard deviation move out of the money to the downside if you think it's going to pull back, or if you're something more neutral, you do something at the money. So it's flexible, right?
The lesson is the strategy. If you don't believe in the talking points that I put out there, and Andy and Tom, if you don't believe that, and you think if they miss anything, the stock could sell off, then it's maybe the put calendar. Remember, it's the strategy, and both strategies are probably inexpensive. The put side is probably inexpensive as well. Does that mean you do both? Maybe, but I don't know where it's going. It depends on the news, the numbers they put up, and the news and how they explain those going forward. But the stock pre-COVID is $97.
Yeah, and I mentioned the RSI, and I said 71. That was Delta. 80 for United Airlines. So
it's not low.
Bar's high for a reason, maybe.
Yeah.
Just as Andy said. So just a good example trade here on United Airlines earnings after the close. All right, coming up after the break, we're going to take a look at Morgan Stanley, the investment bank stocks at all-time highs into their earnings tomorrow morning. Stick around. Fast Markets coming right back.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com on all your streaming devices. Schwab Network is available anytime, anywhere, on any device for free. No place better than the Schwab Network.
Welcome back to Fast Market here on the Schwab Network. Before we take a look at Morgan Stanley, let's get a quick market update here on stocks. Near session lows on that sell-off post ASML and the pre-release. S&P 500 down nearly 0.4%. Dow off 115 points. NASDAQ 100 off just over 1%. And the Russell 2000 leading to the upside on those lower yields, helping out the small caps up 1% on the day. Hopefully that won't crack because Russell cracks, might be some more downside for the rest of the market here too. But off of session lows, but still weaker on the day and off of those records for the S&P and Dow record closes yesterday. All right, time to bring in our next guest. It's going to be George Tillis, senior markets contributor here on the network. George, pivoted. We were going to talk ASML. They pre-released, so now we're talking Morgan Stanley. They've got earnings tomorrow morning. We've seen all the bank stocks, Goldman Sachs, JP Morgan, Wells, really good reports at this point. George, what do you got for us on a background here for Morgan Stanley ahead of earnings?
Yeah, well, I think, when you think of Morgan Stanley, you have to think of, how consistent their earnings are. I mean, their wealth management and investment management business is about 50% of total revenue. And those are fee-based. In other words, assets under management, which right now, based on last quarter's results, $7.2 trillion of assets under management. So that's a significant, steady contributor for their underlying business. Wealth management also, and then, of course, their institutional trading and services and brokerage divisions, which if you look at Goldman Sachs, they reported about 18% increase on a year-over-year basis. Now, for Morgan Stanley, the updated quarter or upcoming quarter they're going to be reporting for Q3 is actually pretty good when it comes down to expectations. $1.59 is the estimate for earnings, higher by 13% compared to the same quarter last year at $1.41. Now, that's going to be slightly lower sequentially versus last quarter's $1.82, but nonetheless, if you look at the revenue estimates at $14.29 billion, that's higher by 8%, over $1 billion compared to $13.27 billion for the same quarter last year. So, you think about the institutional services business, this is, again, market making and trading. The other thing is investment banking and underwriting services. I mean, look at the market right now. The market is hitting new highs, but we actually really haven't seen, and this is my view, you guys can give me your take on it as well, a lot of the IPOs. And typically we see a lot of IPO activity when we see cyclical tops. I'm not saying that's going to be the case here, but it's kind of interesting to see that we haven't seen a lot of new underwriting of new shares. But of course, when it comes down to investment banking and issuances of secondary offerings, Morgan Stanley is one of these primary underwriters. The other thing is if you look at the net interest income, you don't necessarily look at this company relative to somebody like Goldman Sachs, which, by the way, when they reported their net interest income, Goldman did 70% year over year. This is not a depository institution versus, let's call it, Wells Fargo or even JP Morgan. It's really a wealth management business, and wealth management has been really booming with the markets at all-time high, assets under management growing, and those fees are relatively consistent and steady.
I hate when you answer my question before I ask it, George. It makes it more difficult for me. But when you look at Morgan Stanley, we compare banks all the time, right? JP Morgan, Bank of America, Wells Fargo, similar, right? Goldman Sachs, Morgan Stanley, kind of similar. They used to be like heavy fixed income, more trading than banking. But they've migrated a little bit, but is that the comp we should use? And therefore, is Morgan Stanley more comparable to Goldman? Therefore, we saw Goldman's numbers pretty solid. Should we expect part of that from Morgan?
Well, I think so. I mean, look at the price action. I mean, Goldman traded quite a bit higher in the pre-market, actually traded lower. It seems to be holding up. The two charts look very similar. And I think if you look at their institutional services business, both of these companies, they've been very robust. Wealth management, and Goldman reported 17% increase year over year in wealth management fees. I think that's, again, the critical component for Morgan Stanley. I think these banks are less sensitive to the yield curve. They're more in line with trajectories of underlying assets. And we know, of course, bonds and stocks are primary institutional and, of course, end user and consumer based wealth management products. So I think you have to look at it in that regard versus traditional banking. JP Morgan, obviously, they're doing very well just because they have such a high level of Tier 1 capital ratio. In other words, equity to assets over 14%. They're just beating everybody in that area. I think when it comes down to Morgan Stanley, they rely less on, the equity sliver for lending because they're not a primary lender. They're really a deal maker as well as a money manager, and that's how you have to look at it relative to some of these other banks.
Yep, bar high on this one. RSI at 78 on this one, all-time highs. Same as Goldman going into their earnings last night, but that stock's relatively flat. All right, great stuff. Thanks to George Tillis, Senior Markets Contributor. Okay. All right, Kev, let's get into the example trade here because the option market's pricing in about a plus or minus $4 move in the shares. Implied volatility levels, I was, not surprised because the banks typically don't have really big IV percentile rank. It's about 50% right now. So with that in mind and the way that Goldman's reacting, maybe the good news is already in. So I looked at a strategy that's relatively neutral, that you're taking advantage of that vol dispersion that we talk about here. So I looked at a double diagonal position, but this is sometimes called a straddle swap. So it's something a little bit different, complex four-legged spread where I'm going to go into the October 18th weekly cycle that expires in just 3 days, and I'm going to sell the at-the-money straddle on here, right at the 113 strike. So you're selling one of the calls, one of the puts. So there's your short straddle. And then in the October 25th weekly cycle that expires in 10 days, I'm going to buy the out-of-the-money 119 call one time and then buy one of the 107 strike puts. So buying the strangle there. So there's that strangle, straddle, swap component that makes up this double diagonal on this one. So you're selling the near term at the higher implied volatility. You're selling about a 52% implied volatility on aggregate on this one in the near term options where you're selling the 113 call and put. And then on the October 25th options, you're buying about a 34% implied volatility on aggregate, collecting a credit of about $3.30. So that takes your break evens at or near about 108 on the downside, at or near about 118 on the upside. But Kevin, this is a neutral strategy with a little kicker that you can roll that straddle to the next cycle, creating a short iron butterfly, right?
Yeah, exactly. It's not, you don't collect the massive credit that you do if you're moving them all in the same month. But what it does do is it gives you a little vega, right? It protects you that way, but it's still about that short strike. The 113 strike is what you're aiming for. If you don't get there, you can extend duration in this and make it a 1 week spread. But right now, this is a calendar spread with a straddle added to it instead of multiple short strikes. It's just one.
Yep, and Kevin, I think this is a good point to bring up because it's 1 week wide, right? You got that calendar aspect built into it also. But as we get closer to expiration, you're going to have some assignment risk on one of the short options, either the short put or the short call will be most likely in the money, right? So you'll need to adjust or roll or close this prior to expiration on Friday, right?
Yeah, we don't guarantee much, but one of those strikes is going to go out in the money. So this is a position that you have to defend and roll those options or close them.
Yep, and the risk on this, just about $270, remember, on this, because you're collecting $330 credit. It's $6 wide on each of the wings on this one. But a complex trade with a little bit of kicker and that roll potential also. All right, great stuff. Great look at the double diagonal straddle strangle swap. That's going to do it for Fast Market. Stick around, though, right here in the Schwab Network. Next Gen Investing is coming up.
you offer me the same choices as Schwab? Yeah, at Schwab, I can get full service wealth management.
Right? Neil, tell me you know this.
Carl.
Schwab.
Have a choice in how you invest with Schwab.
It's time to look forward.
Find the next trend.
From every click to every tick.
There's no fear of missing out on next-gen investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Small caps out in front this morning. Russell 2000 up about 80 basis points in futures. Opening bell going to bring us a mixed market with the NASDAQ basically flat alongside the S&P 500. But it is the Russell that's moving following yesterday's outperformance as well. Tech got hit hard. Of course, we've been talking about the ASML news, probably more an Intel implication than the NVIDIA trade, but there's still a little bit of hesitation in the realm of the Mag 7 this morning. Some dip buying in NVIDIA, about a $2 bounce. Chips also about 90 basis point move higher for the semiconductors, but much else in your Mag 7 category is weak. Apple, Amazon, Alphabet, Meta, Microsoft, Netflix, all down, with Apple down 1%, worth noting given yesterday's big move in Apple. That was certainly kind of a sleeper event. When you see NVIDIA down and Apple up, it's always an interesting expression of a shift in some of the risk tolerance. Perhaps Apple finds its way as a safety trade many times into this market. And yesterday's session, it did that again for the first time in a while. With so many of the growth names down yesterday, Apple was able to punch through to a new intraday all-time record. So I do want to watch that stock closely, given that it has been a little kind of plateau that's formed in Apple around 230, but it was a technical new high. So a lot of this stuff really on the brink of like major breakout, just hasn't quite extended as far as some bulls have wanted, with NVIDIA's rejection at 140, and then Apple still dabbling with the 23 handled 237 right now. NASDAQ down about 10 points. Otherwise, I mean, you pretty much see it right now. It's just a few of these big names that are under some pressure. Sector-wise, you've got about a split market. Energy, banks, materials, real estate kind of looks a little bit like yesterday's session, with the banks firm and the more cyclical themes outperforming. Airlines having a good morning with UAL. Talked about that. We've also got some decent strength in some of the metals, with gold up this morning about 80 basis points. Dollar and bonds not doing much worth talking about. Bitcoin still worth keeping an eye on as it tries to break out of its downtrend. It's going to take a little bit more than what it's got right now, but not too much. Bitcoin held along for the ride yesterday and is still on a pretty good little run. So we'll see if that can pick up the pace too. Let's go to Kevin Green, joining us for a look at the volumes and options, open interest, and trading. As far as the options market goes, KG, let's go there first. Is there a lot of buying pressure here? Is there just a lack of selling pressure? How did yesterday's drop in tech affect the overall dynamic?
When you're looking at open interest, it didn't really impact the overall dynamic here, Oliver, but we did see a little bit more balance to start this morning up. Now, obviously, when you have pre-market trading for the SPX options, it's going to be fairly, light when it comes to volume. There were some targeting of the 57.75 puts earlier this morning, as well as the 57.85 puts. That might be a little bit of downside risk, but you are also seeing a little bit of balance when you're seeing call selling to the upside, the 58.45s, the 58.50s, and somebody's going out to the 58.90. 90s here. So I would say it's a little bit more balanced. From a technical standpoint, you may want to come back down, try to get really close to the 5,800 level, see some buyers stepping in and then trying to bounce out to the upside here. I kind of have this channel that we were in pretty much on Friday of last week. We're pretty much revisiting that channel. You don't want to stay in there for too long. If we do, then that kind of gives you a little bit of an indication that selling pressure is continuing to step in to this market here. And if we do break that, 57.85 once again has been the flow that I've seen for this morning. And then I would say 57.65, if you break through that, then we have some pretty big problems where we can go back to that previous range that we saw about a week ago, early last week, actually. So once again, I think it's going to be somewhat balanced. You want buyers to really kind of step in. Usually we do get a little bit of a flush to start the morning, get buyers to step in and push higher, but it is going to be reliant on the technology trade as well as the semiconductor trade. If that can actually bounce back, that'll be a tailwind for the market right now.
So as we're looking at yesterday, I mean, it seems like there should be plenty of places for support technically, given our kind of stair-step pattern up. But also yesterday, we did see that when we kind of cracked one of those key dealer levels, it did create some more kind of waterfall selling. So we're not immune to some pretty quick moves. I mean, it was a pretty sharp move yesterday, especially in the second half after that 58.30 broke.
Yeah, and I would also say, too, we had VIX expiration this morning, so a lot of those VIX options are going to settle out, and then we'll start seeing a little bit more repositioning over the next couple of months when you're looking at the expirations for the VIX contract. So just because you may see a little bit of an elevated amount of contracts traded for the VIX today, that doesn't mean that the market's completely just fearful. It just means that there's just obviously just repositioning for the next expiration. We do have the monthly expiration coming out this Friday, too. That could create a little bit of volatility. But if you're kind of looking at this, I mean, we're now at the heart of the election season vol. If you're looking at the November contract, this is the elevated contract when it comes to the VIX. So that could give us a little bit of pressure. That could also provide us some trading opportunities in the near term, too, if you're a bull or a bear. But I think the dynamics that we saw with with the semiconductors yesterday, along with VIX expiration pretty much this morning, kind of created a little bit more of a domino effect in yesterday's trading. And today we're pretty much trying to just recapture. And if we can recapture 58.30, that's going to be an area of resistance. If you can recapture that and break out higher, I think that's going to be a really good sign for the bulls right now. We're just trying to maintain here, Oliver.
All right. Yeah, I like that. Maintain. There's that chart again. And I do like that one because it's kind of like the higher kind of momentum potential move. If we get out of it, it's already been a really nice trend. But if it's not powerful enough, if the bulls require more, then that would be pretty fun. And that's kind of what it looked like at the beginning of the week, that we were going to get a little frothier. Crypto markets melting up, small caps moving, and then it's just right on cue. You get a big tech shakeup, and then the main horse of the market kind of falters a little bit. So right now, though, it's not too bad out there. We're pretty much unch, and it seems like the overall momentum's still on our side. Appreciate it, KG. Thanks for the perspective there. Good stuff. Good look at the charts. Caroline Woods joins us for a little earnings chat and some analyst commentary. Let's maybe hit the analyst stuff first, actually, Caroline. Let's go to Cisco for a sec, since tech going to be really important today. And Cisco's been this late-stage leader since its earnings. In August, it's basically been up and to the right in a hurry. So nice to see, I guess, more bulls get on board.
Yeah, Cisco shares up about 2.5% this morning, despite the pop that you were talking about, largely underperforming still the broader market year to date. And Citi is turning bullish on the name, upgrading Cisco to buy from neutral with a price target of $62. That's up from $52. So Cisco is currently trading around $55.25 right now. So still more than 10% upside from here, according to Citi. And it's pointing to the reason for bullishness is actually AI, saying while AI is currently a small piece of the business, less than 2% of revenues, we see the potential for a stronger contribution. With more AI coming, we are incrementally more constructive on the group and expect continued investor rotation out of semis and hardware into networking equipment to benefit group valuation. Citi views the addition of Cisco's products and Meta Platforms' AI hardware as a positive validation of Cisco's technology. View Cisco's recent $9 billion 2027 hyperscaler AI opportunity forecast as potentially understated. And also, the analyst raised his EPS estimates for 2025 by 2% and then for 2026 by 5%. says, we believe shares warrant a sizable discount to net working peer valuation to reflect lingering share loss concerns, somewhat tempered by growing AI opportunities. Even at a 30+% discounted target multiple to peer average, we see meaningful upside to shares. So shares, of course, as you said, have really had a nice run since about early September, now up about 9% year to date. But Citi sees the stock popping at least another 10% or more. If you take a look at the breakdown for analysts, more holds than buys. The majority of analysts, more than 60%, are sitting on the sidelines for Cisco. Median price target is $57, so less than $2 away from where it's currently trading. But it doesn't report earnings until November 13th, so a little bit of a ways to go. But we'll see if other analysts jump on the bull train here.
Yeah, this one has been in a world of its own, really, now for months. Really impressive stuff. It was like kind of a late entrant into the narrative and into the AI storm, but it certainly has, caught a lot of speed. And it's definitely got a lot of wind in its sails right now, so I can see why analysts are piling on. The fact that it still has so many holds, I mean, the chart is like out of this world right now, just because, one, it looks different than anything else, and that it's in the middle of momentum and breakout after a kind of a year and a half of like sideways action. If Cisco gets through $58, then you're looking at levels we haven't seen since early 22. So I feel like a lot of those holds are going to have to get on board.
Yeah, well, yeah, I mean, analysts will have to start playing some catch-up. Even this Citi analyst, Cisco, was already trading above its former price target of $52 a share. So, I think, though, to Citi's point, less than 2% of revenues come from AI at this point, so sees a much bigger growth opportunity, but could be the reason why, others are on the sidelines, because it's just not as big of a part of the business quite yet.
All right, let's talk some earnings here. Yesterday we hit J.B. Hunt, which was kind of an interesting little nugget of information for those trying to get insight on the economy. Maybe some port strike stress limited what we could transport by sea, and perhaps that shifted some over to the roads and land via the trucks. But, I mean, it looked like also there were just quite a bit of negative numbers on the trailing basis. This kind of seemed like the market saying J.B. Hunt is in the middle of perhaps a turnaround, that maybe the trough of activity is behind them. I thought this was an interesting report.
Yeah, the CEO did say they continue to navigate a challenging freight environment, but similar to when they last reported, they do think that they're starting to see a more of a return to more normal seasonal demand patterns. But both earnings and revenue actually fell in the quarter, but still managed to top analyst expectations. So in turn, we're seeing shares surge higher this morning, up more than 5% right now. But keep in mind, this was a stock that was under pressure heading into the report, still down about 8% year to date, despite today's pretty impressive run higher. Adjusted EPS of $1.49 easily topped analyst expectations of $1.42. Revenue fell 3% to $3.07 billion, but still managed to top analyst expectations of $3.04 billion. Sales in the intermodal unit were flat at $1.56 billion. A 5% decrease in gross revenue per load was offset by 5% higher volumes. The dedicated contract services unit saw sales fall 5% to $846 million due to declines in average trucks and productivity. And then the integrated capacity solutions segment saw sales fall 7% to $278 million as overall volume decreased 10%. I mentioned that the CEO did talk about, continuing to navigate the freight environment. They did talk about the strike with some of the analysts, but it seems like, kind of depending on the situation, things were approached differently. I couldn't glean like one key takeaway from it. We did see some positive analyst reaction, though, following this announcement. B of A maintained a buy rating, but raised its price target to 196. It's currently trading at 184. Stevens adjusted to 205 from 195. So shares up about 5.5% right now. As I said, still negative year to date, but at least having a good day and good month. It's up about 7% this month.
Yeah, nice little bounce up off the lows, making a pretty good trend here for J.B. Hunt in the last few quarters. Let's do a little financial discussion real quick. Synchrony, which is having a great year now, 45% For those that were worried about credit breakdown in America and lending breakdown, boy, has that been a rough trade for anyone that tried to bet against companies like Synchrony.
Yeah, and this was one because it had already seen such an impressive run up. I wondered if the bar was pretty high here, but it's adding to its year-to-date gains, up about 4% after a beat on both the top and bottom line. Plus, the company boosted guidance. EPS of $1.94 easily topped the $1.81 analysts were looking for. Revenue rose by about 10% to $4.61 billion. Wall Street was looking for more like $4.5 billion. Net interest income rose 5.7% year over year. Average active accounts were flat at 70.4 million, but deposits grew 5% year over year to 82.3 billion in the quarter. Net interest margin declined to 15.04%. I talked about that raised outlook. Synchrony now is expecting EPS of $8.45 to $8.55 for the full year. The prior estimate was for $7.60 to $7.80 per share, so a nice boost there. And consensus was for $7.79, so also well ahead of what Wall Street was looking for. They say that assumes no late fee rule implementation in 2024. The conference call just finished, so we haven't seen analysts weigh in at this point, but I will say that the majority, it's pretty split. The majority in the buy camp, 12 buys, 9 holds, 1 sell. But the median price target is $58. So Synchrony is closing in on that. As you can see, only a couple dollars away, trading just below 56 right now. Up, as you said, actually now about 46% year to date.
Yeah, wow, what a move. And it seems a pretty good message about the consumer. Look, it also means that people are taking out loans. So maybe that will come home to roost. But for now, not enough defaults, not enough credit pressure for Synchrony to not get paid.
Yeah, and I always used to be a yield chaser. I've been kind of slacking in that department, but I did notice that Synchrony is offering 4.3% right now. Marcus is at 4.1, and Ally I know is at 4%. So Synchrony is pretty competitive there.
It's pretty good. Good stuff. Good
but
context.
only will come down, as we know, when the Fed cuts again.
Yeah, well, who knows? We've been now kind of pricing out the next deep cut, so it may be a little bit of a shallower path. So right now, 4%, not bad. Thanks, Caroline. Good stuff. Good look at the earnings. Good look at the movers here this morning. Appreciate that very much. Let's talk some more banks. Let's get into the details on structuring a financial portfolio when we come back.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. Also, you can trade brilliantly.
banks have kicked off a reliable start to earnings as we continue to see strength around the financials. Joining us, David Ellison, portfolio manager at Hennessy Large and Small Cap Financial Funds. Tom's with us in studio to do some trading in a moment. David, welcome back to the show. Good to see you.
Morning.
What's your big takeaway here from these earnings?
Well, the worm has turned in a sense. We've had 3-4 years of rising rates, inverted curve, difficult credit, difficult mark-to-market, problems with retaining deposits, and now that seems to be turning, in favor of what's happening. So you see that across the board. Margins are starting to get a little better. Credit's okay. The yield curve is helping the deposit and yield spreads. So again, we've been 4 years in the darkness. Hopefully we'll have 4 or 5 years in the light here as conditions improve.
Yeah, the message, it seems, is very encouraging compared to a couple of years ago in particular, when we were in the middle of this kind of regional bank crisis. And at the time, it seemed like the best explanation was that was largely the fault of a few specific actors and players who had kind of levered up their risk in a way that didn't make sense, their bond portfolio risk, but then also just kind of their sector risk too to their customers. So did we learn that was an isolated event?
Well, I think we learned that there's, 2008 was a credit mark-to-market, and this was a rising rate mark-to-market. And I think there's a difference between those two. And I think we're learning that, the issue of mark-to-market, which was not around when I started, I'm not dating myself, but hopefully not, but when I started looking at banks, you didn't do mark-to-market, you did higher of cost or market. And so that's why the banks were okay when my father, had a mortgage at 5% and money in the bank at 12%, because nothing was marked at market and the banks could work through that, and they did just fine. Then we added mark to market over, 15 or 20 years, and we got 2008, and then we've got, the couple of years ago when rates were up. So I think the industry is learning from that. The industry is constructed to deal with mark to market. It was not going into 2008, even though that was the rule. They weren't constructed that way. They didn't have enough liquidity or enough capital. And now they do, and I think it's paying dividends for the industry and hopefully the earnings and the stock prices.
Yeah, quite literally. So the regional's trying to basically make a breakout on the chart right now. Another big day as we speak. So should then a financial strategy embrace some of the kind of lower quality or higher credit at this point?
Well, I think generally the bigger banks are in a better position because they have the money, they have the earnings, they have the capacity to grow and innovate and stay competitive with sort of this fintech stuff. I think the smaller banks are attractive in a sense that they need to consolidate and become relevant. I think fundamentally they are okay, not great in terms of their long-term sort of positioning. So I think acquisitions are going to need to be a bigger part of this industry. We need bigger banks. And one of my sort of soapbox issues now is that if we had 40 years of declining rates, we're going to have 40 years of big deficits, regardless of where the economy is, to keep the game going. And I think to do that, we're going to need bigger banks and to finance that and keep that in check and keep it going.
The competition between financials and tech companies too for financial products, how does that play a role? I know in the past your fund has had some pretty big positioning in some of the consumer tech financials. How does it look right now?
Well, I feel like that, technology and financials is really being controlled by the bigger companies, and they do not, I think, have a real big interest in competing in the bank arena. You don't see Apple competing for meaningful deposits. You don't see them, competing for financial relationships. So at the end of the day, if the banks stick to what they do, which is take deposits, do some stuff on Wall Street and make loans, they'll be fine. There's plenty of market share for everybody. I think fintech is really hopefully a way to cut costs. It's not necessarily a way to grow. Visa and MasterCard have been the original fintech names, and I've owned them for years. and they are sort of the backbone of the industry. PayPal's trying to be, relevant, and I own some of that. So, and there's a few others, but I think at the end of the day, you stick to your knitting, you're fine.
Okay. MasterCard, the biggest holding, it looks like, as of the last filing in the large cap fund. PayPal in there next to Visa. Bank of America looks like the biggest traditional bank position that you have. How come Bank of America is the way to express kind of the legacy bank play, if you will?
Well, I think, the names move around. They're all kind of close together. So you just happen to catch it on a day where, the other ones weren't a little higher or lower. But I've got, 10 or 20 names that are all within, $500,000 of each other. But I think to talk about Bank of America, basically it's the biggest play on all of the things we talked about at the top of the conversation. They're going to benefit from recovery in mark to market. They're going to benefit from a yield curve that gets better. They're going to benefit from better deposit pricing or more favorable deposit pricing. And they're not being, choked up by credit. And so they have, all these things that are ahead of them. It's not happening as fast as it's happening at some of the other banks just because of the way they positioned at the bottom of rates, but it will all show up eventually. And that's what you're playing here. I mean, we've had, if you look at, the last 3 years, earnings have generally been going down, driven by lower margins, lack of loan growth, and building of provisions. The next 3 years will be higher because you won't have any more provision building probably, and you'll have higher NIMs. And even if you don't have loan growth, you'll have higher earnings. So earnings are now going to move higher the next 2 or 3 years. And that's, puts a floor under where these stocks, in a sense, it puts a floor under the downside.
Like that point. Sure seems like there's been a put in, some of these trades like JP Morgan. You described it as the GOAT in banking. The chart certainly is about as beautiful as an uptrend as you can see. But I'm curious if you can give me a quick thought on Morgan Stanley before we let you go, David, because, that stock is ripping this morning. It's up 7.5% right now. It's like kind of going a little parabolic.
It's in a very simple way, it's a wealth management play. And look what BlackRock is doing. And I think the wealth management business is doing quite well. Look at the market. The market goes up, that stock's going to go up because their assets are going to go up and their fees are going to go up. So they position themselves less as a bank and more as a high net worth or investment manager, much like BlackRock. And I think that valuation will eventually get there. So that's why you own that. It's pretty simple.
Okay. Good to catch up. Thanks, David, for the thoughts. Appreciate that.
Yep, you're welcome.
We're set up to do some trading here, Tom. Give me a Morgan Stanley trade.
Well, I got an RSI of nearly 85 right now. Woo! So anything above 70 on that relative strength index is overbought at all-time highs here. Post earnings up about 7%. So, a great earnings report. Investment banking fees grew 56%, 1.4 billion, highest among the major banks. So pretty good report. So I looked at the strategy based on the fact that, hey, it still pays a 3.1% dividend yield, even with this astronomical spike that we're seeing here over the last month or so. Shares up over 25% so far this year. So looked at a covered call where it's still bullish, right? But maybe I want to create some yield. Maybe it needs to consolidate because it's really an overbought territory while still owning the shares and collecting that 3.1% dividend yield. Covered call strategy for every 100 shares of stock you buy. You're selling out of the money, call the upside. I went out to the November monthly cycle, 30 days to expiration. Expires on November 15th. I sold the 125 strike call against the long stock. You're paying roughly about a debit of about $118. So you're buying the shares at a discount. That takes your break even to that 118 level that you paid on this. And then you create yield by selling that upside call against it while still being able to collect the dividend. You've got a nice little cushion to the upside before you start getting hurt on that. And then as you get closer to expiration over the next 30 days, you can roll or adjust that short call, creating more credits and increasing potential profitability. This might be the way to play it, where maybe there's going to be some more upside, maybe some consolidation needed, and you get paid to wait on this type of strategy.
All right. I think that makes sense at this point because it's going kind of ballistic.
Yeah.
What about the more steady trend of a JP Morgan right now?
Well, on this one, post earnings, it did come back in. Big red candle on earnings, but just below all-time highs here. So looked at something a little bit more aggressive, but also giving myself more duration on this bullish example here out in the December monthly cycle. So 65 days to expiration. You got a couple months in this one where I'm going to buy an unbalanced call butterfly where maybe you expect it to grind up, but maybe not explode in continuation of the parabolic move that we saw prior to earnings. So going out to the December cycle, buy one of the 220 strike call, slightly in the money, sell two of the 235 strike calls, then buy one of the 240 strike calls. So in essence, you're buying a bullish $15 wide call vertical in this strategy, offsetting some of the cost by selling the $5 wide one at the top there with that same common strike at 235 where you want the stock to grind up to over the next 2 months here. You're paying roughly about a $5.60 debit for it, so that takes your break even to $225.60 over the next 2 months. That's only about 1.5% above the current share price. So you don't need a monster move to the upside. You just want that gradual continuation, as you mentioned on the chart, that grind up over the next couple months into the end of the year, and that'll be profitable. Now, because you made it unbalanced, even above the 240 strike, it's going to be nearly a double in profitability. But the sweet spot is between that break even and about 235.
Okay. Yeah, the call butterfly versus kind of the buy, hold, and collect premium on Morgan Stanley.
Right.
All right. Thanks, JP Morgan Chase, but not chasing the stock. There you go. Maybe a little bit. All right. Thanks, Tom. Coming back. This election season, stay out of the muck and the mudslinging with Schwab Network's by the numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk. No agenda, no hysteria, just good old-fashioned analysis of what we are in hour 2 of our show, 30 minutes into the session, keeping a close eye on tech. NVIDIA started off strong, but kind of losing it a little bit. Watching the chip makers flip red. NVIDIA likely to go the same way, it looks like. Big tech hurting a bit. Apple giving back a decent amount as well. Now more than $3.50, down to $2.30. So back into the range of the old highs for Apple. And again, risk on kind of limited to the Russell. Small caps, though, really good day. And the financials are having a good day. Regionals are having a good day. A great day. Regional banks are up 2%. Value stocks having a great day. So just a bit of a flip from market leadership, and means you've got some stuff to go for. It's not like a panic, but yeah, the three sectors that are down are some of the big ones. Services and tech. Staples, the only other group lower. Financials way up top in the performance list. So a continuation, basically, of yesterday's sell-off in tech. It's just not as an extreme move. But we'll talk Taiwan Semi, which gets really important. Hopefully we'll get some closer insight into what we heard from ASML yesterday when Taiwan Semi reports tomorrow. We're going to trade that. That's the morning trade in TSM. John Kosar joins us for a look at the Asbury 6. Try and get some answers on the macro there to see what kind of breakout is possible for stocks. Chartmaster also getting ready for earnings. Discover, in the context of the financials and the credit story that seems encouraging, and the rally and Synchrony, Discover's in a pretty good shape going into their report. We'll take a look at Kinder Morgan, which has been on a tear, and also we'll look at CSX with the transports having a pretty solid day after JB Hunt. A lot of stuff working. Transport's actually looking great right now. Okay, let's go to George Tillis first for a look at the session so far. It's like a mini version of yesterday, George, where NVIDIA's holding on by a thread, but the semiconductors are now back red, and all the love is for the small caps and for the value trade. What do you think about that?
Well, I agree. I mean, it's a little bit of a carry through from yesterday. Obviously, the small caps are moving higher. It's really a function of what's going on with the financials. I believe they're the second, or if not the biggest, weighted component of the Russell 2000, and the KRE regional banking index looks like it's breaking out. There were some good reports from companies like Citizen Financial Group and U.S. Bank in particularly, which is one of the larger regionals, if not, can consider it more of a major commercial. But they came in and beat estimates for earnings, a little bit short on revenue. But revenues and earnings were both down about 2% year over year. And it seems like these regionals, and in fact, a lot of these banks were reporting or expected to report declining earnings and sales, and they beat for the most part, and they're moving to the upside. And it's really just a function of what's happening with the yield curve, especially as we moved into the latter part of September, early October. It was widening out. It looks like the yields are now falling. 10s, 5s, and 30s are falling. But nonetheless, the net interest income margins for U.S. Bank demonstrated improvement, which offset the fact that they increased their credit loan loss provisions aside 8% on a year-over-year basis. Looking across the board, the usual suspects for the most part are down, including Apple, Google. NVIDIA is teetering on either a green or a red day. At least right now, it's too early to tell. But as you mentioned, the transports, JB Hunt moving to the upside. CSX, I believe, is going to be reporting soon as well from the train standpoint and transportations. The other industrial names, United Airlines moving to the upside. A lot of the other industrials are higher. RTX, if you look at Caterpillar, is higher by 1%. And real estate also to the upside as well.
The fact that you're getting such kind of profound strength in some of the non-tech stuff, the transports, are really impressive. DJT with a dollar sign on the Thinkorswim, not to be confused with the other one, is like in a major breakout because of JB Hunt. We're going to talk CSX later, which is rallying going into its earnings. I mean, these are really encouraging signs about the economy where, the tech stuff, if it's just too expensive valuation-wise, or people are too loaded up, a lot of people are like super levered tech after the last year. If this is just about flows and rotation rather than some real threat to the, AI growth story, then it could be a welcome shift.
Yeah, I mean, look, yesterday during this time, I talked about, or I didn't mention ASML. I didn't know they were going to early release their numbers or if it was leaked or not. That company, if you look at it in the last three quarters now, the last 2 quarters prior to the one they just released, they guided lower, and the stock had been drifting lower. The other semiconductor equipment manufacturers like KLA-Tencor, Lam Research, which is going to be reporting next week, haven't traded well. Micron, from the high bandwidth memory standpoint, has been trading down. Qualcomm. So there's a lot of semiconductor names out there. If you just go back and look at their charts, some of them going back to March, Intel and AMD in the CPU space, because I think China is really encroaching on their markets. They've been weak since March. Most of these other names, late May and June, have been trending lower. The exception, of course, NVIDIA, because we know they've got basically a production problem. The demand is extremely high. So we may see a divergence. Maybe NVIDIA just takes the reins and moves higher. I can't say. But we know that there's still significant demand for their underlying products. Now, aside from that, there's money rotating. There's a lot of money rotating into the broader areas of the market. One of the things I noticed yesterday is irrespective of the declines, and some of them were quite large. You look at, Applied Materials, I think it was down 10% at one point in time. Pretty significant moves to the downside. The VIX really wasn't much higher than the decline we saw in the markets. And in fact, if you look at the VIX today, if I can find it here, it's trading slightly lower. So I think that speaks to your narrative that the market is broadening out, and that's a healthy sign.
Okay. You've also got a little bit of strength showing up in the coins again. Bitcoin trying to make that move. So perhaps just trying to find other things to rally besides tech. And I guess that can be
correct.
A very good thing, as long as it's not zero sum. It's just the rotations of the past were basically like all zero sum. And so it wasn't a good trade-off. But at this point, it's looking like a decent trade-off. With S&P's up 12 bips. May not be a lot, but at least it's positive. Thanks, George. Appreciate that thought. Good setup for us to look at Taiwan Semi in some more detail with Jeff Pierce. Earnings tomorrow morning. Definitely the highlight of the week, Jeff. I feel like chips might be a little stagnant, a little quiet, a little sleepy today, contained until we see this report from TSM tomorrow, and then we might get a big move.
Yeah, absolutely. And I think the move we saw yesterday, right, when we saw TSMC drop in sympathy with ASML, which came with softer guidance, that could certainly play a role in the move we see today. We know TSMC uses ASML's lithography equipment to produce those advanced chip fabrications. That brings in some concern around TSM's expansion efforts, them being able to meet demand, potential delays, things like that. But going into the report right now, expectations, the market maker move, has the potential to move $9.40 in either direction. Expectations are earnings coming in about $1.74, revenue about $22.72 billion. That would be up about 31.5% year over year. Net income expected to come in around $9.3 billion overall. If we do look back at last week, though, we saw them report a 40% rise in September sales year over year, coming in $7.82 billion. They didn't really offer any detailed commentary alongside those figures, but they previously said they expected revenue between $22.4 and $23.2 billion for Q3. If we look in August, revenue rose 33%. That was down about 2.5% from their July revenue, which rose 45%. I think what investors are going to be focused on, of course, is the strength in the 7-nanometer, 3-nanometer technologies. That's expected to drive their performance this quarter. 5-nanometer technology could also contribute to the wafer revenues. And then, their efforts to ramp up production on the 3-nanometer, as well as that development of the 2-nanometer, are anticipated to probably be tailwinds. Now, there are some concerns out there, still macroeconomic uncertainties, still some inflationary pressures, certainly geopolitical tensions, especially between the U.S. and China. That could all be a headwind. And then smartphone and PC sales. We know that those, they really stockpiled on chips during the pandemic. Really been a surplus of inventory. But if we look at the overall picture for TSMC, obviously we know they deal with companies like NVIDIA, Apple, AMD, good partners to have, no doubt about that. But the first 9 months, the company has increased revenue by about 32% year over year. They're outpacing analyst expectations of around 26%. We've seen the CFO say that they think smartphone and AI-related demand is going to drive business in Q3. And management says that they expect, a compound annual growth rate of about 15 to 20% over the next several years, as long as they can continue to catch up with demand, which they think they're going to meet in 2025 or 2026.
Good stuff. Right now, Apple and NVIDIA make up 35% of Taiwan Semi's customer base. ASML and Applied Materials make up about 40% of their suppliers. So these are all very, very closely connected. But, there's a reason for 30 and 40% and not 100. So this could very well be an issue of some of the other customers. And it should be much clearer tomorrow because this is a much closer tie to NVIDIA. It's just, it's one step closer, but when there's really only two steps, that's a pretty big deal.
Yeah, absolutely. And I know you were talking earlier about some of the differences in the chip makers, what we're seeing them come out of. You have to keep in mind TSMC, the biggest chip maker in the world right now, right? 62% market share in the first quarter of 2024.
Wow.
Their foundry business has been impressive. Obviously, what they've done with the A100 chips, as well as the H100 processors for NVIDIA, and the expansion piece, expanding in Europe, expanding in the U.S. We know three different plants coming to Arizona, about $65 billion on that. That's an important part of this because they're going to be spending a lot of money. I mean, if we look at their forecast for CapEx, it's about 30 to 32 billion now. About 70 to 80% of that's going to go towards advanced technology. So they're trying to meet demand. They're spending a lot of money. Of course, they've got these big names behind them, but that's certainly a concern for investors if we do see a slowdown in chips for some reason.
Okay. Good stuff. Good context. Good connections. Thank you, Jeff Pierce. TSM up today. NVIDIA holding its bid too. Let's go to Scott Bauer, prepping the trades for us, CEO of Prosper Trading Academy. How's it going, Scott? Pretty important report tomorrow.
Very important. And, so much of market momentum is really going to hinge on this one report. There's so much pressure here for TSM to come through with not necessarily a blowout report at this point, but maybe assuaging some of the fears that we saw and heard about yesterday. And I think they're going to come through. When I look at this stock, it is best in class. There's no question about it. I don't care, any of the other stocks out there, the NVIDIAs, whatever. TSM is certainly a leader. I think they're going to absolutely come out with excellent guidance. Maybe they give a little bit of caution here, but I really think they're going to ease the fears that we saw and heard about yesterday. So with that, I'm looking for all, blowout new record highs here. And I am buying a call spread. I am just buying a simple call spread for next week. I'm going to give it a little time, not this week, but for next week. The 192.5, 200 call spread. I can pay about $2 for that. And as Jeff talked about, the market maker expected move is coming in right around $9 to $10 or so. So that 200 target really aligns with this call spread.
Okay, so bold up. I'm liking it.
Yep.
Pick a direction you have, and so let's go for it then. Obviously, I mean, there's a little bit of a vol kind of premium going in here, but I guess not too exorbitant to where it makes sense to get some directional exposure.
No, that's right. And that's why I'm also using next week's call spread rather than this week, because just on a relative basis, the premium levels aren't as expensive here. But if we get a big move here, the premium or the implied volatility is not really going to matter. Listen, if I'm wrong, I know what I can lose. I can lose my $2 here, but I am really, looking at their charts, looking at the fundamentals. If it wasn't for yesterday, boy, I'd probably be targeting even higher in this stock. But I do think that, there is a little moderation to take into consideration because of yesterday. But I am really liking what I see here with TSM.
Okay. So if you're looking at next week to own the call, why not then maybe go to like this week's to sell the other one and put like that calendar element? How come you're also selling the further out of the money on the same date?
Exactly, because if we do get a blowout here, if I did a calendar or even a diagonal, that could moderate some of the upside if the stock goes too far. In this case, just by doing a straight vertical, I know where this thing can go. It can go to $7.5. So sometimes I do like the calendar. I like to weight one implied volatility versus the other. In this regard, though, I thought the better opportunity, the better return was just with a straight vertical call spread.
Okay. So looking to spend about $200 to get some exposure to the upside for a breakout in TSM. Unfazed by ASML yesterday. I like it. Good stuff. Putting it out there for us ahead of the report. Thanks, Scott.
Thank you, Oliver.
CEO of Prosper Trading Academy. All right, looking for the breakout. When we come back, we'll zoom out a little bit, look at the big long-term charts with John Kosar, Chief Market Strategist, Asbury Research, the Asbury 6. 5 of 6 of his indicators looking bullish right now, so expecting some positive commentary. Be back in a few.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Stocks trying to rotate this morning. Russell doing really well. Tech holding in after a little bit of a fade in semiconductors. John Kosar joins us, Chief Market Strategist at Asbury Research, with a look at his technical indicators on where we're going. John, good morning.
Good morning. Good to be here.
Looks like you're dressed for the part. Green, 5 out of 6 of your indicators looking positive, right?
Yeah, and they're solidly, they're not just barely positive, they're pretty solidly so. So we've had a little pullback here that we could talk about today. I mean, the move yesterday was sharp, and I think it spooked the market somewhat. But yeah, Asbury 6 is it. It's been positive since September the 12th. I think the market, the S&P 500, is up around 4%-ish since then, and you can see everything is positive. Most of these, about half of them were, let's call it the middle of September, is when they flipped positive. The other two have been in October, the rate of change and market breadth. And the only one that's negative is the VIX right now. So in other words, volatility is a little bit high relative to our tactical time period. It's historically very low, but we look at it as a very sensitive indicator. But otherwise, everything looks good.
Yeah. VIX, a good point, as that has been quite sticky, a little bit stubborn. The vol situation, a lot of folks are kind of chalking that up to the election. Do you see evidence of that, John? Is that the way to explain away the vol?
I don't. I think, we don't get paid anymore to tell you why the VIX is higher, right? I mean, I just try to look at the implications of the VIX. It means the market is a little spooky, not outrageously so. And again, because the other 5 of the A6 are strong, they're in solid green, I'm not as concerned about it. It's a drag on the market right now. I think, our work shows that when the VIX is elevated on a tactical basis, it's kind of like throwing an anchor on top of the market, right? It's going to weigh it down to some degree, but I don't see it as a big issue. I'm looking at some longer term targets in some really important indexes and stocks, and we have some of those charts today if you'd like to look at those.
All right. So yesterday's little dip didn't break the market, of course, but NVIDIA, maybe we knock that chart out real quick, John, given that, it's inconvenient to get stopped out right at your previous intraday high. Are you a big believer in double tops? Should we be scared?
Well, that's not a double top.
Yeah.
I mean, all that is a retest of the old high.
Okay.
In order for that to technically be a double top, it would have to come down and take out the low that we made on June the 10th. So what we're seeing here is we had a big move in NVIDIA that lasted. I think the major uptrend, if you look at the 200-day moving average as being the trend proxy, that trend started at the beginning of 2023. We got up to the June highs, and then you see that sideways it's kind of like a reverse megaphone. That's the market digesting those huge, enormous gains. And it starts to go into the turtle, so to speak. It's afraid to make new highs. So we finally broke out of that pattern on October the 7th. That target is 169. That's 27% higher than where we are right now. It's a huge target. Am I going to buy that and go to the Bahamas and come back and pick up a check? No. But it gives us a little bit of risk reward. As long as we hold 124, that's a good target. I'm not surprised that I'm not surprised that NVIDIA had a little reversal off of that old high, because anybody that's jumped on that move, that's a short-term trader, that's a great place to ring the cash register for a short trade. Made a lot of money in just a couple of weeks. So that's how I kind of gamed that out. I didn't see, if we just turned around on a dime yesterday for no reason, then I'd be pouring through data, news stories to see what was the catalyst. This just looked like it was some quick profit taking.
Okay, understood. And seems like a case pretty well made. Who can argue to take a little profit after a nice move back to the highs after NVIDIA had kind of languished for a bit. So it escalated pretty quickly, got back to that high. No double top unless it really proves to be the beginning of a big shift lower. What about when you kind of extrapolate and go stepwise up the ladder here? How about the NASDAQ as an index, John? Do you think that naturally goes in the direction of the S&Ps, which have been leading at highs?
Yes. The 2 points here. There's the comp. So the same pattern in the comp. Not exactly the same shape, but you had this huge move, this huge uptrend that started in early 2023. Peaked in the summertime. Market came right back to the 200-day moving average on August the 5th, which you can see kind of in the bottom quartile of your screen down there. And we broke out on September the 19th. That targets a move to 20,050. That's 11% higher than where we are right now. So this and the pattern in NVIDIA kind of corroborate each other. This pattern is going to stay valid as long as we stay above that. Let's call it 17,400. If we stay up above there, it's still a good pattern. And it did identically to what the chart of NVIDIA did. It got up to its old high that we made back on July the 11th, turned on a dime. People rang the cash register. I think that was a heck of a move for 2 or 3 weeks, but we haven't done any damage. In fact, if we just blew through that old high, that would be more abnormal to me than seeing the reversal that we had. I track the AUM in stuff like the Qs, because I want to see when we have a reversal like that, did it really shake things up? Is there a lot of money that was getting out of the Qs or getting out of other similar ETFs? That was not the case. There was a little bit of money that left there, but nothing that would make me nervous. So again, this looks normal. I know it was a little spooky to go through yesterday, but I don't see anything right now. The only thing that concerns me is I want to see continued relative outperformance by NVIDIA, by comp, by the NDX versus the S&P 500. That's been languishing a little bit. As long as we continue to get that relative performance, if we see that start to kick in over the next couple of days, I'm happy. We've got some seasonality factors that we have to deal with through the end of next week, but then seasonality gets very, very strong. I brought a chart of that too. Seasonality gets strong through the end of the year. So yeah, I mean, we might be a little bit dicey here over the next week or so. There we go.
This looks good. All that blue is pretty good looking stuff.
Yeah, this is the seasonal pattern for the fourth quarter in the S&P 500 based on data since 1957. So next week is week 4. That's the weakest week of the entire quarter. And then you see the next 2 weeks are the third and the first strongest weeks of the quarter. So we typically get a reversal as we get out of October and go into the early part of November. Is this something that you could take to the bank? Absolutely not. These are seasonal tendencies, but when you overlap them with those patterns that I showed you and a good strong A6, I look at those all together as pieces to a puzzle, and I like what I see.
All right. Seems like the puzzle right now is soundly bullish. Charts looking pretty good. Maybe a day of pullback needed to kind of reset some of the froth and the tech trade, but the expectations look like a catch-up trade into the S&P's leadership. Love it, John. Thanks so much for the check-in.
It's good to see you. Thanks.
Absolutely. John Kosar, Chief Market Strategist, Asbury Research. Some seasonality assistance coming too, it seems like. All right, good stuff. And a message that maybe the market heard because we're now all green across the board. Index is back positive as the NASDAQ is picking up some buyers. Chartmaster taking a look at earnings next. CSX, part of a big transport rally today ahead of their report. Kinder Morgan's had a really, really nice couple of weeks. And Discover Financial is in the same vein as the rest of the credit trade that's done quite well. Looking at technicals and charts next.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Ethan, how's my favorite client?
Great. I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends? All that research sounds exhausting.
Nope. Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes up to 25 stocks in just a few clicks.
Download the Schwab Network app and join us to follow all the market trends. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network. Let's get technical. Mr. Rick Ducat here with me on the charts. Jenny Horn in the newsroom as we get ready for a few big reports. Discover Financial, I think, fits into our conversation this morning, Jenny, about the strength in banks and credit-related stuff. So what are we looking at?
Yeah, and I have to say that this name, I mean, is only expected to continue to see some upside. As I was reading, like, the overall consensus on the street, which has turned very favorable on Discover. So that's frankly amazing. I know we looked at this several months ago, and I was shocked to see how strong and resilient this chart had been because, of course, we talk about the looming credit threat in the U.S. consumer. But hey, if banks were any indication of this company's report, I think that they look set up pretty solidly here. So report today after the closing bell. Overall, we are expecting right now about $3.44 a share for earnings, or $3.28, excuse me, on an adjusted basis. On revenue expected to come in around $4.4 billion. Now, earnings would have actually continued to be revised to the upside. Just over the past 60 days, been revised about 5% to the upside. Doesn't sound like a whole lot, but that's pretty rare, honestly, to see that much of a revision to the upside as we go into this report. Also, we are expecting that revenue to continue to rise. So I find that, frankly, in itself amazing because, again, this company has such a good read on the consumer, and I know that they're considered like one of those credit cards that tends to issue a lot of credit cards. So it's one that's very widely available, widely held, also gives a good read on debt. But they have been able to skate by what I have to imagine is a difficult right now consumer environment so well. And I think echoing a lot of the concerns we heard from these major banks just a few months ago, where it was like doom and gloom. It doesn't seem like the U.S. consumer is in any trouble. So we're expecting a lot of pretty much the same going forward. Obviously, if we see any disappointment as far as like guide, that's a concern. But up 1.5% today, and this name continues to surprise me, frankly.
Yeah, $150 almost here with another 1.5% rally. All the other reports seem like they're helping it. We talked Synchrony this morning, too, breaking out. How's the chart look, Rick?
Well, the chart looks pretty good so far. We can see that we did have a notable
two phases rather. We had this this earlier phase here, then we had this significant gap up. Then we kind of moved sideways for quite a while here. We did have a lift to the upside that gave us our previous 52-week highs near 147.61. Yesterday we poked our head up above that line, couldn't quite clear it though, closed below it. Today it's looking like we are making more progress to the upside. However, still haven't taken out yesterday's intraday highs. The day is still young though, so there's plenty of time left for things to solidify. We can also see that we have transitioned from a much more very gradual, very slight upward trending line here in blue going across these repeated lows many times here, and then we have a more steep trend line going upward in white. Now we are above our moving averages. They're all trending upward. RSI is trending upward as well here. Once again above the 50 midline here, making new highs above its previous peak here. However, not really taking out these old highs just quite yet here. So I wouldn't worry too much about that though. I mean, we already had kind of a reset in price before we continued to the upside here, but you could make the case that's a little bit of bearish divergence here. So as we look at potential support and resistance to the upside, we've got our +1 standard deviation channel near 163, 1 standard deviation above our blue linear regression line, our line of best fit. That is now a supportive area. So we've got our old highs, then our blue linear regression line, 147.60, 145.90 approximately to the downside, and then our +1 channel to the upside for resistance.
Okay. A lot of financials looking like this right now. A lot of the quote-unquote lower quality financials, just in terms of like the balance sheet, the risk components and stuff, are looking like they're in the middle of a breakout. It looks like a regional bank chart almost. Many of these competing with the highs from earlier this summer. So the standard for describing breakout, does it need to have consolidation? Does it need to have retest? Or is there just a certain amount of distance that you could put in between the current price and the old high that would qualify this as a real breakout?
That's a really tough question to answer. There's so many different criteria that you can use to kind of answer what you're asking here. I think the general thing would be just a close above the area in question that is not like, 1 cent above it or whatever, just a decent sized close. You could use various filtering techniques, a percentage move beyond that point. You could use just a raw dollar basis beyond that point. You could use technical indicators shifting from bearish to bullish. There's many. That's kind of a big question to answer. Yeah.
Well, it seems like the moving averages turning upwards definitely adds to that idea of the breakout. And also even today too, like the little wick of the candle there did kind of come back down to that old high and found some support. So that's the type of thing where it seems like it's settling in to some degree. All right, let's talk Kinder Morgan, Jenny. This thing has, I think, been a bit of a surprise mover, just really rocking now, like 3-4 weeks in a row.
And it's actually, of these three stocks, it's the best performer on the year, which frankly shocked me. I mean, modestly so, but up over 40% on the year now with, like you said, the recent strength we've seen. And I think it's encouraging that this company gave guidance last quarter saying that they expected overall natural gas prices to continue to decline. That has been a volatile space. I mean, we've seen natural gas prices rebound significantly in mid-2024 after steep declines following a more mild winter, and then U.S. prices surged 80% compared to their average in March. European prices saw a 25% increase. So we have seen, I think, this overall increased focus on, I mean, frankly, natural gas as well as the overall energy space. This company, though, did see its core profit from the CO2 transportation drop previously, but actually its profit from the natural gas pipeline segment increased with these higher transport and volumes. So overall, Street does still very much also like this name. There's not a single bear also in this name. So 18 analysts, it's pretty skewed between the buys and the holds. So you could call it basically a more muted, if not bullish skew in this name. But I was reading what basically Bank of America said. They cited this contracted long-term growth and demand from the Gulf Coast, as well as utility electrification as increasing tailwinds for this company. Overall, they've been able to beat in the last 2 years about 63% of the times on earnings and around modestly 25% of the time on revenue. So last quarter, we did see some degree of concern because their guidance was a bit muted. But hey, I mean, look at the chart. Obviously, this thing sees some momentum going into this report.
Yeah, it's a pretty good looking rip, Rick. I mean, it's basically vertical. So is this just like a gauge of how fast momentum's going? If it's going so fast, it's going to trip over itself? Or how do you read this?
Well, when we look at this one, the first thing to look at is the price activity here. We transitioned once again from a more shallow sloping trend line, although pretty consistent here with our blue line, into a much steeper white trend line going across these lows. General reminder, the less sustainable, or the steeper something is, the less sustainable it is. And we have backed off a little tiny bit from those highs that we reached near 2502. Haven't quite made a push above that area since Monday here, but not really a ton of signs that momentum is breaking down. To answer your question here, you can see that not only do we have an upward sloping trend line on the RSI here, we're above the 50 midline, we are in the overbought area, and during our high closes, we were making new relative highs along with price. So far, momentum looks pretty decent. The bearish signal would be if we were to drop back below that threshold of 70, the overbought area, and also that would probably invalidate our green trend line as well. So those would be some of the warning signs to look for in terms of momentum. Another thing would be if we do make another closing high in price and RSI makes a lower high, that would be the bearish divergence to be concerned about here. But really looking pretty strong so far here. A couple notable supportive areas, the old high and then the subsequent low after it was breached, 2385, then another low here near 2306. Once again, using our standard deviation channel study to project some potential resistance to the upside, we can see we have handily cleared the +1 channel, 2408, another supportive area to add to our list now near our green line that I mentioned earlier, and then also beyond that 26 +2 channel. That's the next area of interest.
This thing's kind of a beast. Can you go back to the RSI chart real quick?
Sure.
Just wanted to point out that it looks like this has kind of been a pent up situation. A couple other attempts to really get heated momentum, and this one kind of now this trend of RSI, whereas it kind of had been these momentary spikes of momentum. This feels like it really is a regime shift in terms of the appetite, the bullish appetite for the stock. Really good look at that. Last one, CSX in the transport category. What are we looking for? Rails. We talked trucks yesterday and today with JB Hunt. Let's talk some trains, Jenny.
So, we are expecting, overall growth. They should benefit from this increased volume as well as pricing gains for merchandise and intermodal. While average pricing growth for coal may remain more tepid per some analysts that are a bit more cautious as we go into this report. Lower fuel surcharges may help offset some of the growth at merchandise and intermodal. The company also should see an improvement in its operating ratio driven by this better cost management. So revenue is expected to climb to around $3.7 billion on adjusted earnings of around 48 cents a share. We did see previously they reported pretty much flat revenue year over year, partially due to these lower fuel surcharges and a decline in export coal prices. Overall volume still, though, was up about 2%, and the average revenue per unit actually dropped about 2% during the quarter. So the company has seen its operating margin deteriorate by about 50 basis points from last year to 39.1%. Notably, though, this name has been volatile. If you look at the last 3 years, it has been far from consistent. It's been, pretty much all over the place. I guess maybe the one thing, the bright spot is it trades at a relatively low multiple right now. Its forward earnings are around 17 times versus rails, which are around 20 times, and industrials at around 27 times. So it is trading at a discount, relatively speaking, and it's only made slightly a modest move to the upside this year. So it's actually our worst performer of the three, if you could call it that, but also not a single bear in this name. So there are 28 analysts and 18 buys, 10 holds.
Seems like a value trade, perhaps, in that category, as we've seen that type of stock get some attention. To Jenny's point, it's kind of a new thing to see them really rally. It hasn't been a particularly strong stock, but it hasn't been bad either.
Yeah, not known for making huge moves or big volatility or anything here, but kind of an interesting chart nonetheless here. We had this sort of mountain type shape here, trending upward, going into some extreme new relative highs above 40, but really kind of reversed just as rapidly here. Now we've found ourselves in a more triangular area. We've got this longer term trend line in blue starting all the way back here from our lows, going across the subsequent lows several times here. And then we have a competing downward sloping trend line in blue, once again going across all those lows. Triangular price pattern, symmetrical triangle, that's the kind of thing you look for in trading when you're looking for a potential breakout here. And really the moving averages as well exhibit the sideways nature of price. They're clustered together. They're right on top of each other. Kind of just price bouncing back and forth around this confluence of our indicators here. But now, when we look at the more recent activity, you can see they're starting to diverge apart from each other. They're starting to separate. The faster ones are outpacing the slower ones. So it's seeming like we have a pretty nice breakout on our hands because we have broken out from our triangle, and we've also broken above the high point that we established back there at our red line near 35.63. So we are hanging on above it right now, not making amazing progress beyond it, but we've broken out of the RSI. RSI is above 50. Price is on the move to the upside. Next potential stopping point would be that high point from our decline there, that little small rally there, 37.17, right about there, a little volume node there as well. For support, our old blue line, our old high point, 35.63, and then our boundary of our triangle.
Yeah, it looks like a nice little breakout from this kind of squeeze, RSI squeeze too. So some good little coiled spring opening up, potential to go and test maybe that $37. Good context on the charts. Thanks, Rick. Good look at the expectations for earnings, Jenny. We'll be right back with our meetup panel. Appreciate that, guys.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
All right, stocks still having a little trouble in the tech category, but the Russell having a great morning. Small caps running away with it. Caroline Woods and George Tillis back in for a little chat here, as we've got also a bid coming into the dollar too. Bonds not doing a whole lot, but it just seems like we're in the mood to rotate. Caroline, spinning up some new winners and some pretty real conviction trades out there.
Yeah, seeing a lot of money go into financials today after a pretty upbeat earnings season for the big banks. The regionals still reporting, of course. Morgan Stanley hit a new all-time high today, although coming back a little bit off of that still posting impressive gains. The other big banks higher as well, aside from JP Morgan. In terms of the regionals, I should note U.S. Bank actually also very close to all-time highs as well after earnings. We're seeing M&T, which reports a little bit later this week, up. Huntington Bank shares Truist, First Horizon up 4% today. Allies up 2%, another one reporting this week. So quite a bit of strength there. Utilities also seeing quite a bit of strength. And we're actually seeing tech try to rebound. NVIDIA is back in the green after yesterday's sell-off. We, of course, talked about how that sell-off didn't totally make sense for NVIDIA to sell off on that ASML warning, mostly because ASML said AI is strong, and of course Taiwan Semi makes NVIDIA's chips, and they've already said that they indicated that they'll beat sales guidance for the quarter when they report tomorrow. So I think the pressure's on Taiwan Semi tomorrow, but we are seeing strength in NVIDIA today and strength in chip stocks overall. ASML, of course, still quite a bit lower, but if you take a look, Broadcom, TSM, Lam Research, Analog Devices, ARM, ON, Micron, all posting gains today, so reversing yesterday's losses.
That is important that there is some dip buying, even if it's not hand over fist, extreme love for the stocks today. They're up, and that's kind of all we need is some stability. George, we talked about rotation in our conversation too. I mean, the Russell really powering up, 2,300 now for the rut. Or 2283, I should be more precise, for the index. The intraday high from July is at 2,300 on the dot. So we're in real potential breakout territory for small caps.
Look, everyone's been waiting for this. There's a lot of talk about how Russell 2000 is undervalued relative to the current index price. All you need is a catalyst. The catalyst obviously has been the banks, the regional banks, which are a large component of the Russell 2000. So that's been the culprit. That's the reason, of course, the Russell 2000 is higher. Plus the expectation that the Fed is going to be cutting rates at least another 50 basis points by the end of this year, and 225 basis point cuts. So that's, I think, a primary catalyst. And across the board also, I think, you're seeing some evolution of the semiconductor trade. Just to add to what Caroline talked about, I think if you look at the best of breed out there, which is NVIDIA, everyone really knows what their products are capable of doing. And there's a huge backlog, demand, and a production unavailability. So I think these names like Taiwan Semiconductor, NVIDIA, I think what we'll end up seeing is the best of breed just potentially take off and leave the rest, by the wayside based upon the price action we saw yesterday with ASML's problems. So I just wanted to add to that. But the other thing is there may be a catalyst for the U.S. dollar, maybe the euro weaken because the ECB is expected to lower interest rates for the third time since, of course, they peaked out in terms of their relevant federal funds rate, if you will, or core baseline overnight rate. Inflation, if you look at the prints for inflation in the ECB, below 2%, 1.8% was the print in September. So they're sort of in a disinflationary spiral below their target of 2%. So expect them to cut rates coming up as well.
Okay. The move on the macro stuff tomorrow ahead of retail sales does seem, like we're kind of muted, just waiting for that print. And I do wonder if that kind of limits where we go today, considering tomorrow's kind of the heavy day with retail sales, the jobless claims, industrial production, a fairly decent slate of economic data. And then on top of that with the TSM, it's like tomorrow should be our action day, Caroline. I mean, that seems simple enough to say.
Yeah, and leading into retail sales, which of course is backward looking, and as is earnings season, right? But that's why outlooks are so important. We have gotten some nuggets of information, about the consumer. We heard from luxury goods retailer or conglomerate LVMH, and they're under pressure today after basically disappointing. But they did a lot of the weakness has to do with China there, but they did say Chinese consumers are facing growing macro headwinds, which obviously impacts their confidence and weighs on discretionary spend. And on the other hand, demand from Western clientele shows a sequential improvement, this being very gradual given that inflation and interest rates remained high, which I thought was interesting. But we also had the National Retail Federation come out with the holiday sales forecast for consumers. And while the number of how much they're going to be spending is growing, the rate of change, the percentage increase is slowing down from the year ago period. Holiday sales are expected to rise between 2.5% and 3.5%, down from 3.9%. And, it's been a continual slowdown since like the 12% increase in 2021. So I think that's interesting. And just also to note, we're seeing Ulta pretty weak today after it reaffirmed its full year guidance, but also gave some longer term targets that don't seem to be impressing investors right now. They see 4 to 6% net sales growth for 2026 and beyond, low double-digit diluted EPS growth for 2026 and beyond, and shares it's one of the worst performers, if not the worst performer on the S&P 500 today, adding to steep losses.
See that? Nice. Yeah, it is the worst performer right now. So a little preview into the retail situation. Thanks for that. Good stuff. Caroline Woods, George Tillis. Thanks for the help this morning, guys. Coming up, Trading 360. Thank you for joining Morning Trade Live. Stay out of the muck and the mudslinging with Schwab Network's by the numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk.
No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
The market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Being lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see pattern. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways, as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I'm very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
Welcome to Market Overtime on the Schwab Network.
Quality Focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
It's controversial.
The old guard is saying, away, off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in.
90 minutes into the trading day. Welcome to Trading 360. So glad you're with us. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. Dow is giving it a go after a sell-off yesterday, a slew of earnings to go through, and more. In today's show, our 360 Spotlight will look at EVs after General Motors has established a joint venture to mine EV battery raw materials in the United States. Today's disruptor, Autodesk, after Wells Fargo initiating that stock with an overweight rating. In our 360 round, we'll break down the earnings from United Airlines. And let's take a look here at the numbers. Of course, we briefly hit a record yesterday, but Monday was really the day of records when we looked at the S&P and Dow, and yesterday we were selling off. And so let's see what we can clock in today by closing bell. 58.19 S&P right now, just up fractionally by 4 points. The Nasdaq pulling back 1/4%. The Dow is up 0.5% at 42,937, and the Russell up 1.5%. Oil and gold are mixed. Oil continues its trek to the downside, down just 37 cents now, 70.20, losing over 4% yesterday. At this time, we do see gold gaining about $8.50, and the VIX is at 20.36. 103.22 on the dollar. Bitcoin 67,835. So holding that 67,000 mark. In fact, it's up about 1% today. So that's good news there for Bitcoin. We've had a slew of banks. We kicked it off last Friday. Jenny Horn is with us, markets correspondent here on Schwab Network. And now we're taking a look at Morgan Stanley, all-time highs now, as this company had its report. Would love to hear more about this one. Good morning, Jenny.
Good morning, Nicole. And I think definitely cementing that these bank earnings collectively have been strong. And I mean, we've talked about so many of these major banks, but Morgan Stanley specifically gives a great read on the overall investment banking thesis, which continues to provide upside, as they did say that net interest income actually came down moderately versus their fourth quarter relative to third quarter levels. They also did say that overall the interest rate environment is a tailwind for trading. Their CFO said that investment banking pipelines at this point continue to really show health and diversity here moving forward. So nothing but optimistic remarks from this company's, like analyst calls and commentary following that report. But overall earnings did come in around $1.88 per share. That was up from a year ago. We also did see revenue top expectations, also climbing modestly on a year-over-year basis. Now, the company did maintain its quarterly dividend of around 92 cents per share. That will be payable November 15th to those on record as of October 31st. And again, I think that right now you look at this environment with falling interest rates is the continued hope, and also the fact that they say stock buybacks will continue to be opportunistic. Well, overall, this interest rate environment provides more upside from here. So I've looked at all these bank earnings. This was one of the most optimistic. So many of the other banks did come in perhaps better than feared, but we're operating with very modest revenue growth. I mean, Morgan Stanley saw a really healthy report. So no surprise, this name's up almost 30% now this year. It's up now 16% just this month alone, and modestly off those highs, like you mentioned, 0.5%, but 74% off of its 52-week low. So bank sentiment is strong, and if there's any read into the U.S. consumer and the strength there, it doesn't seem like it's stopping anytime soon, Nicole.
All right, Jenny Horn, thank you for that. Markets correspondent, appreciate it. Let's get some insights on the news that's shaping the markets. For that, we welcome in Eric Bailey, Managing Director, Wealth Manager at the Bailey Group at Stewart Partners. Thank you so much for being with us. You're feeling a little more cautious, in fact. You think the numbers have been good, but you feel a cautious tone setting in. Is that right?
Yeah. Clearly, the reactions so far to earnings have been quite impressive. And so the markets, as you've been reporting, are at the basically the highs we've seen. But I'm concerned about valuations. Just valuations are very high. And so investor expectations need to be met. We need to see continued positive earnings, continued strong numbers out of the economy. And we certainly have some uncertainty on the horizon. Clearly, the election could bring uncertainty. Global issues could bring uncertainty. And we're still not clear, even though we've had one rate cut, exactly how aggressive the Fed is going to be in lowering rates.
What would you tell the Fed to do at this point? I mean, they have 2 more meetings this year and, of course, more meetings next year. What do you think the Fed will do? But what would you advise them to do? What do you think is the right call?
Well, after the initial cut of 0.5%, which was a surprise, and was clearly the reaction in the markets was extremely positive, and we've seen this nice rally since then. I think you'll see more muted rate cuts, the 25 basis points, and I suspect we'll see that again in November, and then probably again in December, and then probably a pause. I mean, the political environment will certainly influence what happens with the Fed, even though, they say they're not influenced by the political environment. I do think it will. So I would say I would expect another, 2 quarter point cuts by the end of the year.
Wow. Okay. So look, you're likely to see that. Right now, the odds are favoring a cut in November, that's for sure, for 25 basis points. You do like technology and healthcare. Tell me about those sectors, and they're a little different from each other. When we think of technology, it's a little frothy. Healthcare may be a little more of a defensive play. I don't know. You tell me.
Yeah, exactly. Technology, clearly, it has to be in a portfolio just because of how strong that area has been. These companies continue to produce just very impressive results across the board, the Mag 7, but even across all types of, whether it's semiconductors or software, any companies related to those areas. We just continue to see strong growth in earnings. So you have to be invested in that area. Healthcare, on the other hand, I see more as a value play, right? These are lower value, typically in the big pharma, attractive dividends, and steady earnings. And long term, you have to like that area because of demographics, right? The aging populations are clearly going to demand and need more healthcare needs, and so I do like that sector for the long term.
Yeah, understood. When I think about the situation here and the names that you're picking, I definitely see that you have a theme, right? You have a lot of dividend payers. You like to get paid to wait, right?
Absolutely. Yeah, I like what are called the dividend aristocrats. So these are companies with very strong balance sheets. What they've done is they have increased their dividend payments to investors for 25 consecutive years. So every year the dividend is going up. It might not be a lot, but it's still going up. And that's a sign in all type of economic environments that these companies produce stable earnings, and they share those earnings, most importantly, with clients. And if you look at returns over the long term, dividends, and if you are able to reinvest those dividends, contribute a very substantial amount to returns. And so I like companies that are able to provide dividends.
Right.
And grow their dividends as well.
Yeah, and I want to go over your picks, but in this cautious environment, do you buy dips? Do you think that we see new highs between now and the end of the year?
I would. Yeah, I would, Nicole. I think the trends in this market are very powerful, and they're still going higher. And so buying on dips has proven to be the right move. And so I would continue to do that until we see otherwise, until we see a real shift in trends and, something happening where we get a very different market climate. So, yes, I would buy on dips.
Yeah. Look, I see you have S&P Global, you have Nucor, Sherwin-Williams. What I know those are the dividend aristocrats. Sherwin-Williams, are you thinking people are fixing it up? We think about Nucor. Tell me a little bit about these picks. Why these ones?
Yeah. Well, full disclosure, I have to pick names that I don't, own or have exposure to, but I like these names in the aristocrat names. Sherwin-Williams for the housing market, and housing has proven to be pretty resilient. And now, especially unfortunately, with some of the damage we've seen in these storms, we've seen these home-related companies perform very well, like a Sherwin-Williams, like a Home Depot, like a Lowe's. SP Global is a financial, right? And they do more fintech, all types of very interesting things related to financial services, and has been a very impressive company. They have outperformed, and all three of these have outperformed the S&P 500 on a 3, 5, and 10-year basis. I like them. Year to date, Nucor is a steel company. They have not performed as well, right? Yeah. We've seen pricing pressures in steel and other commodities, but long term, Nucor has proven to be a very good investment. And so I do like it long term.
Yeah. And, you know, we think about the election, and I think a lot of folks are expecting some volatility, they tell me, as they're counting ballots and what the new, you know, administration will look like and such. Do you expect volatility? Do you expect that it'll be noise and we'll be back sort of where we were pre-election?
Unfortunately, I do. You know, if you look at the polls and if you look at what people are saying, it's going to be extremely close election. And so we might not know who wins clearly election night, or it could roll into several days afterward. And so that brings uncertainty. And as we know, the markets do not like uncertainty, not knowing. So I expect volatility in the markets as we wait to see what happens with the results and if there's any negative reaction to whoever wins. So going into the election, yeah, I would be more cautious.
Right, but then you think we move back higher at some point. Okay, Eric Bailey, the Bailey Group at Stewart Partners. Thank you so much for being here, Eric.
Thanks, Nicole.
Good to see you. Thanks. Trading 360, we continue. Up next, it's the big three. 3 stocks, 3 charts, 3 trades. Rick Ducat will take us through the technicals. Don Kaufman will take us through the trades for the Japan ETF, EWJ, eBay, Eli Lilly. Next here at Trading 360 on Schwab Network. We'll be right back. Three stocks, 3 charts, 3 trades. Rick Ducat will take us through the charts. Here to take us through the trades, Don Kaufman, co-founder, Theo Trade. Great to see you both. Good morning. Don, before we get to your ETF, the Japan ETF, how do you feel about the markets? We've certainly seen volatility. What do you do on the swings?
Yeah, you know, right now it is quite the interesting situation. I think everybody's talking about right now with the S&Ps trading basically at all-time highs, but the VIX still remaining above 20. And yeah, we can talk about geopolitical risk, and yeah, we can talk about the election upcoming. Nevertheless, there's still a huge premium, okay, to volatility on the options inside of the S&Ps, and it's active and it's very worthwhile. No question about it. So I've been a big time premium seller in the last couple of weeks, which has done quite well in a marketplace that right now really isn't moving a huge amount. But again, pricing in heavy vol.
Right, right. So with this action, on your mind is Japan, EWJ, the Japan ETF. Tell us about your idea here.
Yeah, there's a couple things that actually have brought me to the EWJ, and one of those is which you can actually look, and Rick will do this in just a moment, of EWJ having a tough time breaking through about that 72 level. So I'm focusing on the 72 level, maybe as an area of resistance, but also the yen is kind of stabilizing. The yen carry trade is very much back. There's been a lot of discussion, obviously, out of the Bank of Japan. Nonetheless, I think it's in the near term still rather bearish, though, specifically for some of the big caps over in Japan. The EWJ, I'm going out and doing a November 15th expiration. I'm just going to use a $2 wide put spread. I'm going to be buying the 71 puts, selling the 69 puts for a 90-cent debit. Just a nice, easy put spread, looking for some follow through to the downside, coming off that 72 level, and a little follow through, as I said, to some sell side activity.
I see. Okay. What do you think here when you look at EWJ, Rick Ducat, looking at the charts?
Yes, the 72 level that Don mentioned was the first thing that stood out to me as well. And you can see why. It's this red line here, high point, high point, high point. We had a bit of a false breakout there that was a bit of a rug pull for bullish traders there. It looked like we were perhaps going to clear it with some conviction here, but it was not to be. It lasted for only one day before trending downward once again. We can also see that it was an especially difficult move because we also broke through our rather steep blue trend line here as well. Now we are finding ourselves in a situation where we've fallen below our moving averages, yellow 21-day, orange 63-day, exponential moving averages, as well as our thick red line, our volume profile point of control, RSI, also languishing a bit here, longer term, red trend line going downward here, green trend line broken, 50 midline, we have given up here. We are below that area. Now momentum has shifted more toward the bearish side. So, to touch on what Don mentioned, yes, 72 was the area that caught my eye first here, but our orange 63-day EMA right here, that coincidentally is exactly the break even for that trade there. So, if you were interested in this trade, you'd be looking for price to stay below that level here. Then we've got our green line here, which is 69.14. That was a low point, also roughly matching up with our short strike there. And then we've got this gap level down here, 67.77, another supportive area.
All right, so he's watching some of the same numbers, starting with that 72 and the support area. Don, final thoughts?
Yeah, one of the things that's actually going to be a standout on this, though, is some of the price actions specific to the yen. And that is a little bit of the wild card out there. So I don't expect more from the Bank of Japan, but the yen. If the yen were to see dramatically more sell-side activity, that could actually hurt this particular trade, although the technicals are in place. It's the yen that actually makes me a little bit nervous here. It's exactly why, though, I'm using a defined risk spread in this particular case.
I'm glad you brought that up because that's obviously a huge factor and something for folks to watch. Let's talk about eBay, which is hitting some new highs recently. What are your thoughts here, Don?
Yeah, this one, I got to tell you, I don't like being the trend follower here, but in this case, that's a trend I am not going to step in front of. One of the first things I kind of asked myself about eBay is like, is this going to be possibly even a recession proof or interest rate proof, underlying? And it looks like it when looking at some of the price action here. I mean, first of all, eBay's up 52% year to date. And if we actually extend out the chart, this thing hasn't had a lot of price action in previous years. So it looks like trade is actually jumping into eBay, okay, as a little bit, if you will, as a buffer, as a hedge, if you will. So the business environment happens to be solid in there. And again, the question is it recession proof? So in this trade, I'm going to go out a bit further. I'm going all the way out to the January 17th expiration. And I'm doing that because I'm going to take a little bit of a flyer. I'm going to go out and I'm going to buy the 75 calls and sell the 80 calls. So it's kind of a wildly bullish trade, buying the 75, selling the 80 calls, Jan of 17. This one's only done though for a 75-cent debit. It's an outside shot that if this kind of momentum continues, maybe the upcoming earnings kind of accelerates the stock a bit more. This could actually have a nice payout. It's good risk reward for a stock that seems invincible at this particular point in time.
All right, invincible. I mean, Baird hasn't outperformed, and they have a $70 target, so they're along with you. Cantor with a neutral 62 target. Goldman Sachs has a sell. They put a sell rating yesterday with a $55 target. So very interesting. A little bit of an array of calls there. How about Rick Ducat? Take a look at the technicals, please.
When we look at this chart, we can see, Don mentioned kind of not a ton of price action before, and oddly enough, that's kind of showing up in our yearly chart as well in certain phases. Obviously, we had this long sideways area, then a big jump up, long, mostly sideways area, kind of just very barely grinding upward, then another leap to the upside. Now I'm wondering if perhaps we're going to be in another consolidation phase around here, as we have not made a ton of progress over the past couple weeks or so. We are also developing a small volume node at these elevated prices and had a little trouble cracking above 67.66, which is our red line there. When we look at RSI as well, we can see long-term green trend line going across the lows. It had transitioned into a more steep trend line heading upward here, but now we've broken through that trend line to the downside. We've got our high point here forming our red trend line going downward on the RSI. We are out of the overbought area, and as I said, we've broken through that green line here. So perhaps momentum is slowing down a little bit here, a little bit of a bearish divergence that we saw as price was making the highs. RSI was not making a corresponding higher close. Does this mean we are going to get a crash? No. It just means that momentum is slowing down. It's not quite matching up with what we're seeing in the price action. Not the greatest sign for the bulls, but definitely not like head for the hills, everything's going to collapse here. But, not really what you'd want to see at the same time as well. So, as I said, this could just be a bit of consolidation after a rather lengthy rise up in price. If we do keep moving to the upside, near-term resistance +1 standard deviation channel comes in near 70.60, 1 standard deviation above our blue linear regression line, line. Then we've got our green lines here. A low point that we had, a high point before a gap up, lines up with our 21-day EMA near about 65.40 or so, and then a series of small low points near 63.61 line up with a volume node.
Okay. What do you think of all that, Don?
Oh, I actually, I want to go back to one of the comments you made a little bit earlier there. You know, I wasn't going to bring this up, but Nicole, you brought it up, and that was Goldman Sachs with a sell. That was actually one of the reasons I brought this particular trade up. I figured Goldman Sachs puts a sell on it, and it stared, it laughed, and just kept right on rallying. That's a long for me. So anytime I get a chance to take the other side of maybe Goldman Sachs, I will do just that. And that was, again, one of the impetuses for me bringing up eBay. Again, I didn't want to go there, Nicole, but you started this one.
Right. You know what? I like that. You know what? You're a true dedicated player to this market and your own team, which is smart. Let's talk about Eli Lilly, which is flat today, hit a recent high of 972. Some of your thoughts here as we, wait for results for the quarter and such, but it's had a nice run, 1 year up 48%.
Yeah, there's no question. This has had a spectacular run. And actually, a lot of the run, I've actually been on the bullish side. And I say that, because as you well know, I don't take a lot of bullish trades. And when I do, it's usually something spectacular to the upside. But in this particular case, I think it's finally time to possibly fade, take a bearish position in Eli Lilly. Number one thing, the GLP-1, that kind of craze might kind of be fading a little bit in the overall marketplace. So we're seeing price action right now kind of stabilize. Lilly doesn't seem to necessarily be able to break out above the 1,000 mark, 960, 950 level. So it's really the entire craze has kind of mellowed out. It hit $1 trillion market cap and over and done with. As such, I think it warrants right now taking the opposing side, meaning taking that bearish trade, take the shot, especially before this next earnings period. But I'm going to go all the way out to the January 17 on this one as well. And I'm going to be buying an 850 put, which is way out of the money. I'm going to buy an 850 put, selling the 840 put, but it's done for a $2.50 debit. So it's just kind of a measured shot to the downside. If there is any signs in here of slowing growth, if there's any signs of the GLP-1 kind of trade fading out, this is a stock that actually just doesn't have a favorable risk reward right now, in my opinion.
I mean, not that they're the same, but look at what's happened with Novo Nordisk. I mean, that's been pulling back off its highs. It's down 11% in 1 month. That's a theme that we saw. Okay, let's, last but not least, have Rick take a look at the charts.
It does seem as though this run upward is slowing down a little bit here. You can see, to start off with, we have our blue channel here going across these lows, duplicated it, put it across the highs, happened to match up pretty well here. But we had a very notable downside breakout here. We had this kind of V-shaped price action here that very quickly took us far below the boundaries of our channel here into the thick of this volume node near about 770 or so, but quickly, rapidly, right back up to where we were before, back to those 52-week highs, and indeed even pushed above those previous highs a little bit here, but failed to make any kind of convincing close above those levels here. Now, once again, trending downward. We've got a small, rather narrow white channel compared to our blue upward channel. The white channel is trending downward here. We have broken below our blue channel as well. Now, we are struggling to hold on to our moving averages here. We are kind of right on the nose of our yellow 21-day. We touched on our orange 63-day earlier today here. RSI we can see as well trending downward here, but also juxtaposed with an upward sloping green trend line here. So kind of this triangular type shape here for our momentum indicator, right around that 50 midline here, not really giving us a great lean one way or the other, but perhaps very slightly bullish at this time here. Once again, another volume node here near like 911 or so. If we were to break to the upside here, what the bulls would want to see would be a breach of this repeated high point near 940, and then this spot that we had trouble clearing near 966 or so. To the downside, if we break below our moving averages, recent lows 858.81, and then another low point after a gap up 825 or so.
All right. Thank you, Rick, for those charts today. We appreciate it. And I had Novavax on my mind, okay? It's not GLP-1. I mean, this happens to do with COVID-19 and flu. But it just shows you, one blast from the FDA. This stock's down almost 20% today. NVAX is down 19%. So some of these pharma names can get hit. Don, final thoughts?
Yeah. I'd like to circle back to the volatility in the overall marketplace. Look, there's a lot of reasons we could see a higher VIX, but a higher VIX coupled with a marketplace at all-time highs. Look, you got to be on your game right now. For those of you that are bullish in this marketplace, the only word I have for you is hedge. I think a hedge is worthwhile right now. I think there's a lot of risk to the downside, just given the fact that, again, we're seeing a substantiated higher volatility level for what is a considerable period of time in this market.
All right, we heard you. I feel like there's a little Halloween spook in that, we better hedge, like a big boo might come. Okay, Don Kaufman of Theotrade, Rick Ducat there on the charts. Thank you both so much for being with us for the Big Three. Coming up next, we're going to spotlight EVs and the very latest from General Motors. GM investing in joint venture to mine EV battery raw materials right here in the United States. What does it mean for the industry going forward? We'll be right back. Trading 360.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. All so you can trade brilliantly.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage and insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Welcome back to Trading 360. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. It's time to spotlight EVs and General Motors' latest move, investing in lithium mining right here in the United States. Ed Batowski's with us, managing partner, Chapwood Investments. Thank you so much for being with us. There's no doubt there always seems to be concern about the raw materials that go into EVs. GM making this big deal, $625 million. For lithium, and this goes into Nevada. What are your thoughts on this deal?
Well, it's shocking how little lithium there is in the United States and how much of a demand there is. So we have to go outside of our border and understand that this company, Lithium Americas, is actually a Canadian-based mining company that happens to own the Thacker Pass in Nevada. So what they've done is they've actually gone out and secured financing from General Motors for 38% asset level ownership. That doesn't mean that they sold the entire lithium area, if I can say that right, but 38% of the asset level, and they have an offtake agreement. That means that they're going to have an agreement that General Motors can utilize almost everything that they get out of it. So it's only a matter of time before possibly General Motors buys the entire company.
Yeah, and it looks like under the deal, so GM provides the $625 million in cash and letters of credit to Thacker, as you're noting, in addition to a conditional $2.3 billion loan commitment from the U.S. Department of Energy that was announced earlier this year. You know, the big picture here, is this the beginning? How do you feel? Because we always look to China for a lot of the raw materials that go into these EVs. And certainly we start to think about how we like to do a lot of things here in the United States, whether it's pharma or have Boeing and so on and so forth. You know, the semiconductor chips would be another example. So trying to have some of this stuff more at home, I think that's the big picture question too.
Yeah, and Nicole, one of the other things that has to do with the Thacker Pass has to do with there's a sacred burial ground that supposedly is right there where they're digging. And the Native Americans are very upset that they're drilling there. So that's another area of concern where I'm sure that General Motors has somehow, squelched that. But that's a real contentious thing about where they're getting this lithium from. But the idea that we're going to have to go outside the United States is something that we really have to be concerned about, because if the United States isn't liked outside the U.S. And if we have all these tariffs that are going to be brought on, we're going to have tariffs trying to bring lithium into the country from outside the United States. So we really need to be friendly with a lot of countries, and China has a huge resource of lithium. The United States only has about 2% of the world's inventory of lithium, and lithium has become very quickly one of the hottest commodities there are.
And so the big picture, when you think about EVs, I mean, part of it is the demand for EVs overall. I know hybrids have been hotter lately, but the hope is that EVs are it going forward. And while when you talk to people in the auto industry, they say, oh, demand's been a little pullback or whatever. Everybody who wants an EV probably has one already, but that it's coming and more EVs are coming. Are you on board with that idea?
Yes, yeah, there's no question about it. I mean, EVs are being jammed down our throats. I mean, I'm a perfect example. I drive 2 miles to work every day, and I'm a perfect candidate for an EV, and I just refuse to do it. I don't know why. I just like the idea of putting gas in the car and just being able to go and just get away. And I think there's a lot of people that feel that way. And until you're able to get a lot more mileage out of an EV, I don't think it's going to catch on as quickly as people had hoped that it's going to. And also, it's also important to note that 60% of lithium demand in 2022 was for EV batteries. The average battery needs about 8 kilograms of lithium, while an iPhone battery uses less than 1 gram. So you have to remember that iPhones and computers use lithium as well as cameras. So EVs are not the only place that you're getting use of lithium.
Look, it may bring value, it may create jobs and things like that. I certainly don't like the story about the burial ground. I mean, I'm not fully immersed in the story to know more details about that, but never like hearing people being upset about something. But the big picture here is this is just a drop in the bucket in the big rare earths and things that we need. Which car makers do you buy any of the car makers? Do you like Tesla? Do you like GM, Ford? I think when I think about some of the others like NIO and XPeng and things like that.
Yeah, I'm not a big buyer of any of the cars. I think that they're all, being hurt because of the mandate to go to EV, and they're not selling. So I'm very bearish on every auto dealer, even Tesla. I think Tesla is way overpriced at this point, even though there's other sources of income for Tesla than just the automobile. But I'm not a buyer of any autos at all. If any of them I was going to buy, it would be Toyota, because they have a strong push towards hybrid. But that would be the only one.
That's very interesting. So big picture, you feel like there's just too many headwinds for the group overall. What's your favorite group these days? If it's not automakers, clearly it's not. What's your favorite sector?
I continue to love utility stocks. I just believe that you're going to see, as interest rates continue to drop, you're going to see the dividends on utilities become more attractive. Plus, you're going to have a very quiet capital gain that's going to creep into these utilities because natural gas prices and coal prices have dropped considerably, and that's going to be a benefit to the earnings for these utilities. So I really, really like utilities. In fact, there's an ETF called UTSL, which is 3 times the utility market bull. And if utilities go up 3 times, this will go up 3. If it goes up 1 point, this will go up 3 times that. And again, that's only for certain people to take that risk. But that's how much I like utilities. And I think we have another 15% gain before the end of the year in utility index.
Wow, Ed, that's a big call right there. Thank you for talking about EVs and then sort of expanding into what you really do like. Ed Butowski, great to see you, Chapwood Investments.
Thank you.
Coming up next, the disruptors. George Stillis is standing by to take a look at Autodesk. Wells Fargo initiating coverage on the stock with an overweight rating. He'll break down the call and give us an example trade next here on Trading 360.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage.
He's live on the floor of the New York Stock Exchange. So glad you're with us. A look at developing stories here. I'd like to bring in Caroline Woods, senior markets correspondent, taking a look at JB Hunt, which some nice numbers.
Similar to what they said last time they reported, they continue to see a return to more normal seasonal patterns. So getting there. We did see quite a bit of positive analyst reaction. Several price target hikes. Evercore to 185, benchmark to 195, B of A to 196, Stevens to 205, all in the buy camp. So the median price target for JB Hunt now 195. Shares trading at just below 180. Keep in mind, shares are up 3% today, but it's still down about 10% year to date. So shares have been under pressure.
Right. Well, that's good to have that the target's all higher than where it is now for the most part. That's some optimism there. Thank you so much for that.
Sure.
Good luck there at JB Hunt. Let's turn our attention right now over to the disruptors. George Stillis is here, senior markets correspondent, taking a look at Autodesk, and Wells Fargo initiating coverage with an overweight rating here on Autodesk, and the stock is higher.
Yeah, Nicole, if you look at Autodesk, the stock is hitting some new 52-week highs. And this company we've talked about before is actually one of the leaders in architectural design and engineering software, AutoCAD software, as it's really known for. Those who use it, it's got about 60% market share globally, and it competes with Dassault Systems out of Europe. But there was a couple of issues going back to early this year. There were some accounting questions in terms of perhaps some restatements of earnings going back a year or two. And in fact, if you look at the earnings back in June, they didn't have to restate any of the earnings. There were some aggressive accounting tactics used, but nothing that violated any accounting rules. And since June, the stock has really taken off, and a lot of the analysts have actually found it very compelling, especially when you consider the company moving away from a traditional transitional license-based model to a recurring revenue model, which is subscription-based. And this is a company that's still going through that transition. And that's also a primary catalyst as to why, if you look at Wells Fargo's rating, they just initiated coverage with a $340 price target, they actually see improving EBITDA and free cash flow margins based upon this transition. And like I said, they have the majority market share globally for the AutoCAD software, which is used across the board for architectural design, construction, and engineering, as well as for animation and gaming, for that matter as well. But if you do look at the earnings profile, the earnings estimates keep rising for the stock. The price is actually moving higher, but it's still trading around 33 times next year's earnings. And if you look at its 5-year average, it's around 43 times. So it's actually trading at about a 25% discount to its 5-year averages, with improving free cash flow margins and EBITDA.
So at this point now, how would you go about an example trade, as you noted, at a 52-week high?
Yeah, so it's obviously in an uptrend. It's not moving very aggressively or quickly. It's moving slowly. And so I think it's just going to continue to move to the upside, just based upon the accounting clearance the company received back in June, and essentially the expansion of free cash flow, and like I said, an EBITDA based upon the transition model licenses to recurring revenues. So what I'm going to do is I'm going to go out to November. We're going to use the monthly contracts. It's 30 days to expiration. And I'm going to buy a $280-300 call spread. So I'm going to buy the $280 call. And right now, you'll notice that it's about almost $8 in the money. And then I'm going to sell the $300 call against it. So altogether, it would cost you about $10 a share or $1,000 a contract. So essentially, we're paying $10 for something, an option here, that is already worth $8 in intrinsic value. Break even is $290, so it only has to move $2 to break even. And we're paying $10 to potentially make $10. So there's a 1-to-1 return on risk on this trade. And that max profit occurs if the stock hits 300 or higher by expiration in 30 days. So we're not necessarily going for that max profit. What we obviously want to do is see the stock continue to move to the upside, at the very least to the 290 for break even. And then everything after that is profit, past that point up to 300.
All right, George Sillis, thank you for that example trade on Autodesk, and our disruptor every single day here on Trading 360. Thank you. Coming up next, our 360 round, we'll dive right into the earnings of United Airlines. The stock is a winner. It's rallying to the highest levels since its COVID drop in 2020. The other airlines are higher as well. Let's get into the details, what this really means. We'll be right back.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Download the Schwab Network app and join us to follow all the market trends. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network. Ethan, how's my favorite client?
Great. I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends?
All that research sounds exhausting.
Nope, Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
It's time to look forward.
Find the next trend.
From every click to every tick.
There's no fear of missing out on next-gen investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Welcome to Market Overtime on the Schwab Network.
Quality Focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
It's controversial. The old guard is saying, away, off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in.
Welcome back to Trading 360. It's time for our 360 round, all about the airlines. We're looking at United Airlines, which came in and beat on the top and bottom line, gave a nice forecast for the fourth quarter, sees a strong finish to 2024, and the stock has moved to pre-pandemic levels. It looks like it could close at the levels that it did in February of 2020. Let's have a conversation. What's next? David Nelson, Chief Strategist, Bell Point Asset Management, and Robbie Silk, Senior Editor for Aviation, Travel Weekly, a part of North Star Travel Group. Thank you both for being with us. David, it's so nice to hear when airlines are doing well. They talked about attributing an improving domestic revenue environment, easing fuel prices as some of the large contributors. Nice to see the stock here leading the S&P 500. Are you a believer? Do you buy in here? It's up 11% today, David.
You know, this is one of the best trading vehicles out there. You know, airlines. We've seen that in the past. You know, I look at the model and certainly a lot to like there. You know, what I saw was, you know, revenue, a small beat there on revenue, very handsome beat on the bottom line. Looks like fuel costs came in better than expected, but maybe the most controversial item out there is the buyback that they announced, 1.5 billion. That's the first since 2020. And already they're getting pushback, you know, from some of the employees. The flight attendants union has come out pretty hard against this. And frankly, I kind of agree with them. Why are they buying back stock when they have $31 billion in bed? I think there's better uses for that cash.
Yeah, they said they would buy $1.5 billion worth of shares. As you noted, the first buyback since the pandemic. They'll begin doing that. They'll start that program. What do you think? Robbie, I'd like to hear more about your thoughts in the big picture and what you think about the buyback.
Well, the buyback may have been influenced by Southwest Airlines making a decision, you know, to do buybacks. Also announcing that just a couple of weeks ago. They, of course, are under pressure from an activist investor, Elliott Investment Management. I'm not sure. I know it definitely got immediate pushback from the flight attendants union. So we'll see. And it does represent the confidence that United has had, or has, I should say. United has pursued a pretty innovative strategy coming out of the pandemic, and it's including adding extra capacity in Europe, going past Delta, becoming the biggest airline flying to Europe from the U.S. Other strategies that have really paid off, and they're a confident company right now.
And that buyback was a previous program. They had just suspended it after what had happened in 2020, the pandemic. But in the meantime here, they see better than expected numbers going forward. Barron's has an article that says, say goodbye to cheap flights. Robbie, is that what we're going to have to do as consumers? We're going to get hit hard with some high prices?
I think we're going to see higher prices. There's been an inflection point already. Delta talked about this last week. United's talking about it, where over the summer there was a lot of extra industry capacity. It was up about 6% year over year. Now it's up in this quarter, just going to be about 1.6%, I think. And most of that capacity is from the higher end airlines, the full service carriers. We've seen big cuts in capacity from the discounters. So as the discounters are changing their models, trying to find ways to appeal to higher end travelers, it's taking a lot of that discount inventory out of the market. So it is going to be harder to find deals, I think.
David, you know, I looked and I saw United Airlines leading the S&P 500, Delta, American Airlines also in the top 5 or 10. The stocks on the S&P today. Do you like the group overall? Do you buy these names? I mean, Southwest has been in this big transition, of course. You know, what do you think about this group?
They're very dependent on the economy, and I think they're great trades. They're always cheap, and they're cheap for a reason. But there's a lot of things they can't control. They can't control fuel costs, and they certainly can't control the economy. My biggest problem with them is things like this buyback. These are the mistakes they make every single decade. They were buying back stock right up until 2001 when we had the 9/11. Same thing with COVID. And then when they come out of these horrific events, and they do happen, they have nothing in the piggy bank to get out of it, and they have to come back to the American taxpayer to bail them out. We've seen this time and time again, and I suspect it will happen at some point in the future.
Yeah, I mean, there are some people who think it shows that the business has tailwinds and they like the buyback, but you disagree. So would you buy any of these stocks today, David?
United would be one, but I probably would go back to my holdout. I think one of the best run airlines out there is Delta. That's probably where I would go.
Yeah, to Delta. Robbie, what are some of the other parameters that you're watching really closely between now? They also noted some strength for Latin America and pricing there, domestic. What are you watching for in the next 6 months when it comes to the airlines?
Well, first of all, the industry is always susceptible to shock. So what's going to happen that we have no idea about? Will the discount airlines be able to have any success in some of the model changes they're going to make? What's going to happen with Spirit Airlines? Will they end up going into Chapter 11? How does the merger between Alaska and Hawaiian proceed along? And of course, what's going to go on with the proxy challenge at Southwest? So lots going on in the industry to watch for going forward.
Yeah, and the exotic destinations that you mentioned, Robbie, are we going there? Is that going to help these companies? You mentioned some exotic destinations.
Well, United in particular is pursuing the strategy in their international route network of going to places like Bilbao, Spain, Ulaanbaatar, Mongolia, Nuuk, Greenland, Marrakesh, in Morocco. So it is something they say drives new customers, gets people to use their loyalty cards, so forth. It's fun, and we'll see how well those routes do.
David Nelson, Bell Point Asset Management, Robbie Silk, Travel Weekly. Thank you both today for looking at United Airlines and the other names. Great to see you both. That's it for Trading 360. I'm Nicole Petalides. I'll see you at 2 o'clock. Download our free Schwab Network app. It's available in the Apple App Store. Tune in 24/7, schwabnetwork.com. Catch you too for the watch list. Join me then. In the meantime, keep it right here. Fast Market is next.
This election season, stay out of the muck and the mudslinging with Schwab Network's By the Numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk. No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
The market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Being lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see patterns. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways, as if you don't have an emotional reaction.
I'm not very good at sales, turns out.
I am very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
the market overtime on the Schwab Network.
Quality focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
It's controversial. The old guard is saying, away off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market overtime on the Schwab Network. Thanks for tuning in.
Traders, and welcome to Fast Market here on the Schwab Network. I'm Tom White. We've got a great lineup for you today, including we'll cover the markets as they gyrate around the flat line. Then we'll take a look at some option strategies in Apple, which hit an all-time high just yesterday ahead of its iOS release later this month, and Taiwan Semi, which is near its all-time highs into their earnings report ahead of the open tomorrow. And like Folio, break down consumer sentiment data in Walmart. The retailer stock has rallied over 50% in 2024 and hit a fresh record high this week. Now let's take a look at the major indices, which continued to gyrate around that flat line. S&P 500 up about 0.1%. Dow Industrial is up over 200 points, or 0.5%. NASDAQ lagging for the second day in a row, down 0.3%. And the Russell 2000, the small caps, leading to the upside once again, up 1.6% on interest rates going lower, helping support those small caps. To help me break down the market action, let's bring in my co-host. That's Kevin Hinks. Kevin, it seems like the calm before the storm, before earnings really start to ramp up, and everybody's kind of taking a little bit of a breather after yesterday's losses, with the equity market still at or near all-time highs.
Earnings season starts with the banks, the financials, and the airlines. And, you know, incredible movement out of some of these banks and airlines today. Morgan Stanley up big, United Airlines up 11.5%. That stock had already run incredibly. It was remember, one of the things we talked about on yesterday's show was that it was overbought yesterday. Well, it's up 11% today. that should tell you what you need to know about the RSI.
87.
Yeah, exactly. So, listen, these airlines, I thought some of the United news, here's what concerned me, that the market seems to be shrugging off. Capacity up 4%.
Yeah, 4.1% or something. Once I saw that number, I was like, oh, now I know why initially it went a little bit lower.
Yes.
But then has now rebounded. Some commentary out of the company.
Total revenue per seat mile was down 1.6%. Cost per available seat mile was up 0.1%. So, but it just shows you the strength of the airlines right now, and how much, lower crude oil prices, higher fares. I mean, they made a lot of money. They're buying back stock. Apparently, they're buying it all today. $1.5 billion. I mean, I didn't see the fine print. Is that today they're doing that? Because, man, this stock is moving a lot. I was worried yesterday, talking about it, that they were going to have good news, but it was already in the stock. Apparently not, Tom.
Right. And they did say they had a pivot point in August as far as capacity concerns moving forward, because demand remains pretty robust. They're expanding their premium offerings. That's where they make a lot of their margins. And it doesn't hurt the fact that crude oil is back below, below $71 a barrel.
It's a little windfall for them. It's basically the net interest income of airlines is jet fuel prices. When they go down, it's just a windfall for these. It just lowers the cost of doing business. And remember, during COVID, when everyone was worried about airlines and United was buying new planes.
Right.
So they've got a fleet ready for international travel, and boy, it seems to be working what they're doing. Now, still not to the all-time high yet.
Right.
Still not there, but having a big day today after a run. Tom, this stock in August was $37.
$37, and
that's a lot for an airline.
You mentioned it didn't get back to all-time highs, which was in 2019, about $97 a share. But we're at the highest level that we've seen since the start of the pandemic, when the airlines fell out of bed. And
pretty solid performance, though.
Yeah, definitely helping lend some support here to equities. Let's expand this conversation. They'll bring in our next guest. That's going to be Kevin Green, Senior Markets Contributor here on the network. KG, give me your take here. I mentioned to Kevin, it's like the calm before the storm before we really start ramping up in the earnings season. But so far, if you look at the financials, Morgan Stanley is a perfect example. They're knocking it out of the park, kind of supporting the lofty levels here for the equity market, right?
Yeah, not only financials. I mean, if you're looking at some of the other interest rate sensitive stocks or even the defensive sector in general, they continue to pretty much hold up the market as we have some of the large cap stocks, taking a little bit of a beating. I know Apple is down here today, but we see utilities, financials, real estate, and industrials all leading the way. And we have around 72 to 74% of the stocks in the S&P 500 up on the session. So I think we actually have to say, thank you to the other 93 stocks that are out there. If you're looking at the S&P 100 here, the other 93 stocks are really helping us out to be able to tame some of the losses that we've had in the near term here. And there's still going to be a lot of optimism. Now, if this trend continues when it comes to earnings, we probably should be able to exceed the earnings growth expectations that analysts had going into this, which is sitting at around 4.2%. We're on the right footing right now. We haven't heard anything that has been negative. I think the Ally Financial earnings announcement that we're going to get in the next couple of days probably will be the only one that may provide us a little bit of a speed bump when it comes to financials, as they did pre-announce that they're having some issues when it comes to car loans and seeing some stress when it comes to consumers. But outside of that, financials have been doing a phenomenal job over the last couple of trading sessions.
Yeah, and KG mentioned the broadening out of this rally that we've seen. Communication services, consumer staples, discretionary down today, information technology down, as we're seeing the NASDAQ weaker. Everybody keeps on talking about this push into small caps. I get it. Rates are down the last 2 days, right? That's lending some support to small caps, the RUT here, Kevin. But at the same time, when you look at the amount of there's 40% of the companies that aren't profitable in the Russell 2000. So I think, in my opinion, it's still a stock picker's market in there. And then you've got some of the regional banks getting lifted up by the big bank earnings.
Yeah, I don't know if that's the place you want to be rotating into.
Right.
That would just worry me. I get it. I think the Russell is something you can trade, but do you really want to go in some of these individual names?
As a whole of an index, it's a tough. That's kind of what the point of my question was. Should people be plowing into these names where if we do get a downturn or a slowdown in the economy, maybe rates kind of settle right about here. Data's kind of reflective of it. The economy is kind of reflective of it. That maybe the push into it as a whole, there's a lot of names in that don't make money.
I don't know.
Yeah.
I wouldn't consider myself an expert on the Russell 2000. I think it's kind of a mystery.
Yeah.
I get what it is. It's small caps. It's a lot. It's the largest sample size. It's, it says the Russell 2000. I think it's over 2,000 names. It's 2,000 and a couple more. But listen, so many of these things, it's a big index. It's a big sample size. It does move. It is sensitive to interest rates. I'd rather trade the Russell as a whole than almost any of the individual names, Tom.
Right. And KG, I'll give you that question because I know we've talked about this recently, and we're seeing some strength here in the small caps as this rally's broadened out. But, are you all in on the small caps? I know the financials are a big component within, that index.
Yeah, I wouldn't say I'm all in on small caps here, but I do understand the bull case for small caps here in the near term. So you have financials and the regionals right now kind of leading the way, and that's the bulk of the earnings power for the Russell. And in order for you to have sticky institutional flows going into small caps, you really want to see the regional banks really outperform or have better than expected earnings as well as guidance. I think we're there. If you're looking at the regional bank index right now, up around 1.2% on today's session, and we actually had a really nice session the other day as well. And if that's going to continue, we do break out, that gives you a little bit of tailwinds. Here's the other tailwind that no one's actually talking about here today, and I think it's very, very, very important. The uranium trade, it continues to catch some steam. Amazon's doing a deal with Dominion Energy for another, small nuclear reactors and things of that nature. A lot of those smaller nuclear plays are actually sitting in the Russell. A lot of those industrial players that are going to be direct beneficiaries of the infrastructure spend is sitting in the Russell. And the industrial sector in the Russell right now is actually still outperforming. So if you kind of strip away some of the high beta tech names in there that are not making that much money, and you look at some of the other core areas that could actually have longevity when it comes to growth, you can make a case as to why that index is actually moving to the upside. Maybe won't go all in, or maybe just don't have broad exposure, but you can actually pick out some really decent sectors within that. And I think that uranium and that nuclear theme is going to be something that we're going to be talking about for a very long time. It seems like a lot of these tech companies are all in, and a lot of dollars are being spent and flown into a lot of these smaller cap names that have exposure.
Yep, and if you take a look at, not only the deal that you mentioned, Amazon pouring some money into that follows Google Alphabet investing in that segment, Microsoft, so anybody that's running data centers or need that extra power for their AI, theme moving forward, they're going to.
And full disclosure, there are a couple of names that people would recognize, like MicroStrategy, Supermicro is in the Russell.
Yeah.
But boy, not a lot that really stick out to you. Well, but, there's a couple.
Well, let's flip it to a big cap name in the chip space, and that's Intel. Cybersecurity Association of China recommending that products sold in the country be subject to security review. This is a big deal. I mean, they did it to Micron a little over a year ago also. It's almost like a tit-for-tat struggle here, Kevin, with Intel, but that stock's been under the gun for the last couple of years here, and it continues today.
You know how I'm a fan or a proponent of the news flow. And the news flow on Intel is just brutal, right? They just can't seem to get any kind of good news. And I think the biggest take from yesterday's trade to today, NVIDIA followed ASML yesterday. Today, ASML down $40, NVIDIA up, right? That's what one of our themes for the afternoon discussions were yesterday. Do you buy this dip in NVIDIA because of the sell-off with AMSL? Apparently you do.
Yeah, and KG, we talked about that earlier on the Future Show, is that, the other segments within ASML are the ones that are underperforming. They said AI is doing fine here, so maybe that disconnect that we're seeing today is warranted at this point, where, ASML kind of turned the whole market yesterday, or at least the tech sector, that maybe you should start doing a little bit more digging if you're doing some research on these companies, because their exposure to NVIDIA is only one segment, and that one's doing well.
Yeah, I think you probably just saw a little bit of fragmentation when it came to the semiconductor trade as a whole, and so we're probably seeing a little bit more tactical positioning here in the near term. The issues that you're seeing with ASML, that's going to be a direct reflection of these companies like Micron, which has a significant exposure when it comes to analog chips and these logistic type of chips out there. You can also say maybe Intel has a little bit of that. IBM could be also a player in that, and then last but not least, Texas Instruments. But when you're looking at these AI stocks or these GPU players out there, the NVIDIAs and the AMDs, they shouldn't be as impacted here. And I don't think it really gives you a really good quality channel check for the industry as a whole. Now, I will also say too, Intel also had that, that news from Qualcomm, right? There might be a deal that happens here. But it seems like Qualcomm's going to wait until after the elections to really make a decision because of certain policy that could be put in place. I think that also kind of takes a little bit of the wind out of the sails for Intel for the time being until we get past that event risk and we start to see exactly how they're going to attempt to make that acquisition if they're going to be able to.
Yeah, and the fact that I think there's other people laying in wait to invest in Intel just because they're getting so much money from the federal government, the CHIPS and Science Act, as they try to build out their foundry business at this point. But Kev, I wanted to turn to another asset class that's been just parabolic in the move to the upside, and we don't talk about it that much as it relates to equities, but the dollar is up once again.
Yeah.
It's overbought on a technical level, which historically we don't see that, maybe a couple times a year. But this thing's been up, just a parabolic move over the last 2 weeks.
When I look at the dollar, then you look at everything that it affects. How about dollar up, gold up this morning?
Right.
Now gold's off its highs,
right,
but it was up $20 this morning with the dollar stronger.
Yeah.
Now that higher dollar, I know from trading the grain markets, that'll weigh on these prices as the day goes on, and it's not surprising that when gold tries to rally on a day where the dollar's up, it kind of struggles up those levels. But gold is still, up almost $8 here with the dollar higher. But remember, we were almost talking about the dollar going into 2 digits. Now, over 103.
Yeah. And I think what we're going to turn to tomorrow, Kevin, KG, looking forward, is going to be that retail sales data, because we haven't had much data this week. We had Columbus Day and not much yesterday. Import-export prices were lower moving forward. But retail sales, we're going to talk Walmart later on in the show, but retail sales, this is going to be maybe one of those caveats that, hey, if these are good, that's kind of supportive of the economy, right? But then doesn't that push off maybe interest rate cuts maybe to December? Because I think this is going to be a big number tomorrow morning.
That could be the case. I'm not sure about how much the recent economic data is really going to factor into a November cut, just because of the hurricanes that we've had, and there's going to be some really murky data coming out over the next couple of weeks and if not months here. So I'm not sure how much it's going to play into, but we are actually expecting month over month to come in at around 0.3% for growth there. Is there the ability for that to exceed the street's expectations? There is. The other side of that, what if we do see maybe that number coming in a little bit short? And that could actually be driven by gasoline sales in general. I mean, we've seen gasoline prices for the futures actually go to the upside. But if you're looking at it from a retail side, the consumer like yourself and myself, gas prices continue to actually move to the downside. So if you have prices moving lower, you're still consuming as much. That dollar figure is not going to be adjusted when it comes to retail sales. I think that's going to be the biggest wild card that we have out there. Also look at consumer electronics and the trends there. That was actually a really key indicator for Best Buy's earnings about a month and a half ago. And so if those trends continue, maybe some of these the consumer electronic players may actually catch a bid off of that report tomorrow. Just keep your eye on that correlation, because it was actually a very strong one last month.
Yeah, and take a look at, we're talking Walmart, which hit all-time highs this week. Home Depot, the rally. Lowe's, the rally, even though they had, worse than expected earnings the past couple quarters. So some of these retail names, especially the big ones, are at elevated levels at this point.
And here's the final thought. If this data starts to get disrupted or, not be accurate because of the hurricanes, how do you lower interest rates? How do you move on interest rates with data that you can't trust?
Right. Yeah, we're going to get some choppy numbers over the next month or so based on that. All right, guys, let's take a quick break. We come back, we're going to take a look at Apple. The iPhone maker stock hit an all-time high just yesterday ahead of the iOS release and the earnings at the end of this month. Stick around, Fast Market's coming right back.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Schwab.
Have a choice in how you invest with Schwab.
Welcome back to Fast Market here on the Schwab Network. We're talking Apple, the largest market capitalization company in the world, continues to surge higher this year in 2024, up about 20%. And if you take a look at this, Kev, I think one of the biggest questions that a lot of people have, because everybody talks about the super cycle, everybody talks about the AI tools that are going to be integrated. They're not there yet. They're supposed to release that first iOS 18 on the 28th of this month, right ahead of earnings. But it's the optimism that they're going to sell more phones due to the fact that it's going to have some AI capabilities moving forward. But I always look at valuation in Apple, and that's I think the sticking point. Historically, we're at record levels for valuation.
There's some people that you'll hear talk about where we are right now in terms of valuations and all these magnificent seven stocks and say it's different this time because of the growth and the levels and everything that we know about the S&P 500 and the fact that names come in and out of the S&P 500, Tom, that the valuations can go higher. Well, the answer is it really can't, right? And they can get up here for a while, and Apple is not cheap. And Tom, just warn our viewers, you're going to hear this a lot this earnings season. Valuations are not cheap across the board.
Right.
There's going to be a lot of high bars out there for these earnings, and Apple's got one of them. Now, one of the reasons it's rallying, it had a great fiscal third quarter this past quarter. Mm-hmm. It's got quarter coming up. If they put up those numbers again and look forward to the holiday shopping season, they've got some things to be excited about. You know, you're always going to hear the things about the suppliers and that little news, and then it never shows up. They've got earnings October 31st, so not that far away, and so, you know, it's not cheap. Let's put it that way. I don't know how else to say it, but you've got a lot of good catalysts on the horizon, and it's not cheap.
Yeah, and a couple days before that earnings release, KG, is that release of that iOS 18 that's going to have some of those AI tools built into it. But, I mean, do you expect with the valuations and the PE at these levels getting elevated, even though, you know, comparable sales to the last couple of iPhone releases, they're about in line with those estimates that, hey, it might be a spooky Halloween come earnings for Apple?
I'm not sure, Tom. I mean, if you're actually looking at the quarter end, they're only going to have 2 weeks worth of sales data for the iPhone within this report. Now, I think if they give a little bit more color on the conference call as to sales trends, that's probably where you could see the stock getting hit. But they also may not make any type of comments around that either. They might be saying, look, we're ramping up at this point in time. We're making sure that our suppliers have more than enough inventory in order to meet demand. They might go really high level and rather than giving us the specifics. So they actually might have a little bit of cover there. And then you also have to look at year-over-year comps. They actually are going to be very, very good. This time last year, they were decelerating when it came to revenue growth on a year-over-year basis. They should actually be able to exceed that expectation. Now, you know, once again, I think there's going to be some tailwinds for them. I think they get some cover right now when it comes to the AI features and phone sales. And they can talk about the future on the call. And they do a pretty decent job of trying to spend that. Also, kind of looking at the chart, too. This is just one thing that I'm kind of looking at here. We have this wedge pattern that's kind of taking place. We saw that breakout to the upside yesterday, but a little bit of a failure that's happening. Now, you could call this a doji. It's kind of a lopsided doji. You can call this a spinning top or what have you. But this is usually a formation that we see pretty much at the top end of a bull run. And if that's going to be the case, maybe we do have a little bit of a pullback before that earnings announcement because those valuations, as you kind of talked about, are getting pretty lofty for the name.
Yeah, and UBS came out with a note and said that firms tracking iPhone data available across 30 geographies suggest modest demand relative to last year for this iPhone 16. But then, as Kevin said, there might be that super cycle that starts after these AI tools come out where everybody does want to kind of upgrade their phones at this point. But KG, on that note where it hit all-time highs yesterday, pulling back 1.5% today, you got an example trade for us. Break it down.
Yeah, looking at just the technicals, as we kind of talked about, that spinning top type of pattern that is taking place, this wedge formation, maybe we do actually come down to that area of support on that chart, which is going to be around $225. I'm actually looking for a little bit of a pullback in the name over the next week. I'm looking at the October 25th, 230, 225 put spread, buying the 230, selling the 225. Doing this for a debit of $1.50. Max loss is going to be the debit paid for the trade, $150. Max gain would be around $350 with a break-even point at $228.50. You're looking at around close to almost a 2.5 to 1 risk to reward ratio. Obviously, this is going to be risk defined, but this is just looking for a pullback, utilizing that technical setup, utilizing maybe some of the macro setups that we have seen, some weakness when it comes to mega cap tech names over the last couple of trading sessions. And if Apple's going to also participate in that downside, this is the trade to be able to try to capitalize on that.
All right, let's break this one down. October 25th, weekly cycle. So you're going to avoid that iOS release. You're going to avoid the earnings on this one, trades ahead. Paying $1.50 for buying the 230 put, selling the 225 put. Pretty straightforward on this downside put vertical here, Kevin. Paying $1.50 if it can expand to $5 if it goes below 225 at expiration. But this is a good if you're maybe not bullish. You need less than a $2 move to get lower to get to that through that break even. But also if you own the shares, maybe this is a hedge that you put on because the stock's had such a spectacular run. So there's two different ways to look at it, but this stock or this kind of strategy gives you a little flexibility too.
Now you look at a $5 put vertical with the long being right at the money and say, wow, $1.50. That's not too expensive for a chance to more than triple your money if you're right. Why is that? Why is that trading so cheap? Because you got 9 days. That's why. You need to move and you need it quickly.
Right.
So, any move on the upside, and this can go to very low numbers very quickly. So Kev's making a little bit of a market call here on this because buying the 230, selling the 225 put in 9 days with, 2 of them being weekends, so you really got 7 trading days on this, you need the move. But if you get the move, like we talk about with long verticals all the time, you get the move, if he's right and it moves back towards that 50-day moving average, you got a triple plus here.
Yeah, KG, and I mentioned the flexibility part of this type of strategy is where you've got 9 days to expiration, but that gives you the flexibility that, hey, if this stock does move lower, say it goes down to 225 and this vertical expands to $3, $3.50 or something like that, it gives you options, right, to maybe close a portion if you do multiple contracts or all of it ahead of expiration, right?
Yeah, exactly. And once again, kind of going back, I'm looking at the technical setup. If you're looking at the average trading range for this stock, just right now, it's actually at the lowest level that we've seen or close to the lowest level that we've seen in a month and a half, almost 2 months. That's sitting at around $4.48, average range for a day. So it is on a relative basis, knowing that it's at the money, you're buying a little bit of delta, but it is within the realm of possibility for the stock to be able to range bound into those levels. But you also could take it off too if it does hit that key area of support. Now, once again, I'm looking at 225 as that area where buyers might be stepping in here. So if it does that before the expiration, Tom, you're right. You might want to be able to take the trade off and move on to the next one.
Yeah, good look at an example trade there. I like the risk reward setup too. You're paying $1.50 to make a potential $3.50 on this type of trade, so that setup's good. And the percentage move down lower below that break even isn't that far below the current share price. And KG, you mentioned the technicals, that 50-day moving average, which might be support just below 225. So if it does go down there, maybe it bounces off of that level also. All right, great look at the example trade there in Apple. Thanks to Kevin Green, Senior Markets Contributor. But coming up after the break, we're going to be joined by Landon Swan from Likefolio. We're going to have some sentiment data on Walmart. The retailer stock is up over 50% so far this year, hit an all-time high earlier this week. Optimism reigns supreme in this big, large retailer ahead of that retail sales data tomorrow morning. Stick around.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close. No place better than the Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of think or swim. The award-winning trading
maybe those flows into volatility at this point. All right, let's bring in our next guest. That's going to be George Tillis, Senior Markets Contributor here on the network. George, talking TSM, just off of all-time highs into their earnings. If you take a look at it, it's a chip manufacturer, right? They're the foundry business, and they're the behemoth within the space. Maybe kind of warranted these all-time highs, right? Just because of the demand that we're seeing on the AI side, right?
Yeah, definitely. So, I mean, everyone's obviously looking at ASML yesterday, but in fact, if you look at ASML as a semiconductor equipment manufacturer, they've actually reported now 3 declining quarters on estimates. So it wasn't necessarily just a 1-quarter decline. It's actually been trending lower since around June. But if you look at TSM, the chart obviously is moving in the right direction from the bottom left to the top right. So something is going on different for TSM than ASML. So I'm not saying that they're completely separate, but there's a differentiation from the standpoint of TSM being a foundry or a manufacturer across all technologies for semiconductors. And there's tremendous growth, obviously, for NVIDIA's artificial intelligence chips. The Blackwell chips are already sold out for the entire year of 2025. They can't keep up with demand. And that's essentially what is creating some generous revenues as well as profit margins for TSM. The other thing about TSM, which maybe a lot of folks don't know, is they actually are a manufacturer for basically semiconductors that go in all of Apple products. And Apple basically has 25% global market share in phones. Samsung, Korean manufacturer, uses TSM. They have 20% of the market share globally for their technologies for mobile devices and tablets and so forth. So my point is this company, TSM, is very diversified. It's not just AI-centric. It's not just analog or digital chips. They got manufacturing tentacles across different technologies in the semiconductor space. Now, obviously, artificial intelligence is huge demand, and that is actually demonstrated not only in the price of the stock, but also based on revenue and estimate numbers for the quarter they're about to report, Q3 2024. The numbers expected from an earnings standpoint are $1.79. Now, that's about 30% higher, or 39% higher, forgive me, than the $1.29 last quarter for the same quarter last year. If you look at sales, also expected to be higher by 38%. So these are pretty good numbers, $23.3 billion versus $16.89 billion last year. Obviously, the majority of this increase has to do with artificial intelligence chips, GPU chips from NVIDIA, because there's been tremendous growth. There's also other catalysts for TSM, which include many federal grants going to this company for manufacturing in the United States. This is essentially a military and economic partner with the United States, as well as Japan. And the Japanese have actually used Taiwan Semiconductor pretty aggressively and extensively over the past 5 to 10 years as well. So this will be interesting because, from a chart standpoint, it's trending higher, but it looks like there may be a double top going back to, about the mid part of August at around the 190 area. So it also, kind of looks like NVIDIA, if you ask me. NVIDIA also around the 140 area might be, again, posting a double top or a potential breakout. That's to be seen, of course, post-earnings for both these companies.
George, real quick, if you're in the AI business and your customers are NVIDIA and Apple, you've probably got as much business as you could possibly handle. Now, that being said, this stock was rolling here. It traded as high as 194.72 overnight the other night. It got swept up in the ASML sell-off with the rest of the market yesterday, but unlike NVIDIA, it hadn't recovered as much. A lot of our theme yesterday was you buy the dip in all these names because all these names aren't ASML. Is that the same here, or should we be more cautionary because NVIDIA's recovering today?
It is. So it's a great question. I mean, I'll try to keep it short, but if what you want to do is consider moving away from the equipment manufacturers, ASML, Lam Research, KLA Tencor, AMAT, all those stocks were down significantly yesterday. What it comes down to is I think the market is narrowing to the best of breed. And there's clearly lots of demand for NVIDIA's chips. I'm not saying it's going higher. What I am saying is the market seems to be narrowing away from CPU chips like AMD and Intel, high bandwidth memory, Micron. If you look at all these stocks, Qualcomm also, by the way, if you look at all these stocks, they've been trading poorly really since earlier part of this year, in the last 6 months. But so the ones that are doing well, obviously, are the ones that are AI interface centric. That includes Broadcom, NVIDIA, as well as TSM. So, obviously the semiconductor market is narrowing to the best of breed. I don't know how healthy that is for the overall context of the market, but I think that's what's happening here. At the very least, maybe in the next 2 quarters, there will be a little bit more visibility on the delays or demand or even supply constraints for NVIDIA's chips. So I think NVIDIA may go higher from here, but it may go higher alone, and Taiwan Semiconductor may follow suit since they're a primary manufacturer.
All right, great stuff for us. That's George Tilla, Senior Markets Contributor, breaking down TSM. But let's get to the trade here, Kev, because if you think this thing's going to go higher post-earnings, expecting about a plus or minus $10 move, I set it up that way.
Sure.
Where I'm buying an unbalanced call butterfly. We're going to offset some of the costs on it. So going out to the October 25th weekly cycle, 9 days to expiration, not a pure earnings play. Buy one of the 190 strike calls, sell 2 of the 200 strike calls, and then buy one of the 202.5 strike calls. There's the risk profile on it. You're paying roughly, we got a $3 debit. It's trading closer to $2.75 now, so you can get it cheaper. But that would take your break even if you paid $3 up to $193. That's your break even to the upside. Even above 202.5, it's more than a double on this type of trade because you're offsetting some of your costs, Kev. But this is a directional bias way where it's not a pure earnings play where, hey, you take advantage of upside.
Like I said, traded over 194 yesterday, almost 195. All of this you're doing is setting yourself up to buy the dip in this name based on the ASML and the sell-off yesterday, like NVIDIA's recovering. It's not, but that doesn't mean it won't.
Yeah, and the debit that you pay is going to be your risk on this. So if you pay $3 or $2.75, $3, it's going to be $300 per spread. Pretty good risk reward setup, but you do need that move to get above 193 on this one to be profitable. If you're bearish on it, maybe you buy the put unbalanced put butterfly to the downside if you think this thing's run up too far too fast. So different way to play it if you want to do the put butterfly. All right, that's going to wrap it up for us today here on Fast Market. Make sure you stick around right here on the Schwab Network. Next Gen Investing is coming up.
This election season, stay out of the muck and the mudslinging with Schwab Network's By the Numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk.
No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
The market is a multi-trillion-dollar beast.
When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Being lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see patterns. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I'm very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
to Market Overtime on the Schwab Network.
Quality focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
It's controversial.
The old guard is saying, away off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
Welcome to Next Gen Investing. I'm Jenny Horn, and today joining me in place of Alex Coffey is Caroline Woods, joining us here from the NYSE. So we have a jam-packed show to get through today, Caroline. Looking at the four major indices, we are seeing weakness in the NASDAQ, which is, actually overstating it, as we pretty much now slip into green in real time. So they must have heard us, because now we are pretty much higher in the four major averages. I was saying it's kind of been a boring day, but choppy as we wait for most of these big tech earnings, which is somewhat on my radar. I know we get economic data for the rest of this week, but I'm an earnings girl, so I'm excited for Netflix tomorrow.
Yeah, Netflix under pressure ahead of earnings tomorrow. But on the whole, this is a market that we're not talking all that much about big tech today. NVIDIA, of course, is an outperformer. But if you take a look, the Mag 7 mostly lower, aside from NVIDIA and Tesla. And, we're seeing strength in other areas of the market, like banks, big banks and regional banks, hence the Russell outperformance today. We're seeing airlines higher. United is the best performer on the S&P today, bringing Delta and American with it after earnings. Morgan Stanley is another, big winner on the S&P 500. So it's kind of a nice break to really kind of focus on things other than big tech. That being said, I know we're going to talk about Netflix earnings a little bit later in the show. That, of course, will be a key highlight this week. And shares are under a bit of pressure today ahead of that tomorrow.
And I think, go figure, because last week we were pretty much, soaring in Netflix shares. So I think okay to see somewhat of a retracement, and thankfully we are seeing these semis higher after NVIDIA was one of these names got crushed after ASML released early, and there's all these concerns about AI. But we'll actually kick off things here on this show with Upvote and Downvote. We'll be talking about so many of these semiconductor and chip names and the winners and losers, as it does feel like that divide is becoming more and more clear. FOMO today is, of course, Netflix, as we just said. We'll also be diving into Amazon, which landed a pretty major nuclear deal, which I think is becoming more and more interesting as the data center build needs all of these various clean energy sources. And we'll close things out with, unfortunately, a loser on the day, the FDA putting a hold on Novavax's application for its combo COVID flu vaccine. So, unfortunately, shares selling off. That was a name I had not heard, I think, in years, Caroline.
Yeah, certainly the case. George Silas always is able to bring a lot of names that aren't necessarily, as popular back into the mix. So we can always count on him for that. And I also said that
lots of details with the bank earnings. So as always with Upvote, Downvote, not recommendations, but as we said, we have a nice tech chip theme today. So we'll start off with Cisco, which did catch an upgrade. And I have to say, Cisco is not one I tend to think of when I think of the overall tech world, but it actually has had a pretty decent year. I wouldn't say it's an outperformer, but it's having a nice session today.
what it's really had is a decent, basically from September, early September to now, it's had a really impressive run higher. But yes, from a year-to-date performance, it's only up about 10.5%. That being said, Citi is turning bullish on Cisco shares, upgrading the company to buy from neutral with a price target of $62, up from $52. So Cisco's currently trading just below $56 a share, so still more than 10% upside, according to Citi. Citi is pointing to AI as the reason why they're now bullish, saying while AI is currently a small piece of the biz, less than 2% of revenues, we see the potential for a stronger contribution. With more AI coming, we are incrementally more constructive on the group and expect continued investor rotation out of semis and hardware and into networking equipment, and expects that to benefit the group valuation. Citi also views the addition of Cisco's products and Meta Platforms' AI hardware as a positive validation of Cisco's technology, and views Cisco's recent $9 billion 2027 hyperscaler AI opportunity forecast as potentially understated. So thinks that could actually potentially come in better than that. The Citi analyst also raised his estimates for 2025 by 2% for Cisco, and then for 2026 by 5%. And, you know, it's giving Cisco shares a boost today. They're up about 3.25% right now, adding to the, you know, it's now up about 10.5% year to date. I will say the majority of analysts still very much on the sidelines for Cisco. More than 60% of analysts keep a neutral rating on shares. Median price target is $57, so only $1 and change away from where it's currently trading. Doesn't report until next month, so we have some time, but we'll see if other analysts decide to join the bull camp for Cisco.
Yeah, and as we know with Cisco, they do still have that hardware exposure, which has been, I mean, more muted, and I guess that's part of the reason for this upgrade. So they do see some recovery in that market. I mean, we've been calling for a bottom, I feel like, in this PC and hardware space for years at this point. So I'd have to hope that they will benefit from what we're hoping to be a continual recovery. Next name today could also benefit from a recovery, and that is Intel, which allegedly has constantly harmed China's national security and interest in products it sells in the country, should now undergo security review, according to the Cybersecurity Association of China. The industry group did warn that Intel chips, which really do carry these massive cybersecurity risks. I mean, they believe that Intel has major defects when it comes to product quality and security management. This is the last thing, Caroline, you want as the headline when you're Intel, a name that is, I mean, continuing to take out new 52-week lows, continuing to just not see any upside from the overall market strength. I know we've only fallen about 4% this month, but the fact that that's my disclaimer, I'm like, well, it hasn't been the worst month, but gosh, it sure hasn't been the best year either.
Yeah, Intel shares have had a lot working against it, including these reports that it might now need to undergo the security review, or chips might need to undergo the security review in China. Shares are down on this news, down about 1% today. Year to date, down more than 50%, about 55% year to date declines. So it's been a tough year for Intel. As you said, the Cybersecurity Association of China says that Intel has allegedly constantly harmed China's national security and interests, and so that these reviews would be necessary to safeguard China's national security and the legitimate rights and interests of Chinese consumers. Reuters is reporting, based on their WeChat account, this association's WeChat account, that the association accuses Intel of having major defects when it comes to product quality, security management, indicating that it's extremely irresponsible attitude toward customers. So, you know, kind of a scathing review of Intel. It seems to be weighing on shares. And, you know, you have to keep in mind, more than a quarter of Intel's revenue comes from China, about 27%. So that obviously is the reason that, you know, investors are a bit spooked by these reports. We, of course, saw this happen to Micron last year, and China accused Micron of, or the association, finding, you know, significant security risks in Micron's chips, and basically advised people to not buy Micron's chips, which, you know, weighed on shares last year. Micron having a great day today, though. Shares are up 4%, and it's had a different year than Intel so far, up about 27% year to date. So a winner and loser there in the chip space, but Intel, just the hits just keep on coming for Intel.
I know, I did see the headline also that Intel as well as AMD have joined forces to create this x86 ecosystem advisory group. I mean, it does sound like a strong partnership. It doesn't really go into like too many of the details, but it involves CPUs and of course AI. But I mean, market not reacting to this at all today. And I think exactly what you said is that China is an extremely important market to them. This is not anything positive that you want if you were Intel, which has already had a pretty blistering year, especially after their last earnings release. Now, next name today is, I believe, yes, it's our best performer of the group. So finally, some upside here. Taiwan Semiconductor, which does have earnings due out tomorrow before the market opens. I have to say, I feel like the street has been difficult on this name when they report because oftentimes they're one of the largest AI players that reports first, at least historically. And they're also sitting at a really, I mean, now a high multiple. The stock's up 80% this year, roughly, and about 8% this month. So stark contrast goes to show what's working is a name like Taiwan Semi, of course, the foundry business that supplies a lot of the GPUs to NVIDIA. What's not working is if you're Intel.
Yeah, so as you said, TSMC, a major producer of NVIDIA chips. Also, Apple is another customer. Now, ASML is a major supplier to Taiwan Semi. And at the top of the show, you talked about the weakness that we saw yesterday. And of course, we're continuing to see today after ASML warned basically of, weaker than expected, or actually pre-released results mistakenly early that kind of waved some red flags. Now, keep in mind, ASML did say that AI demand was still strong, that there was still potential upside there. And TSMC has already indicated that sales should be upbeat or better than expected for this quarter because earlier this month they released September sales that rose 40% from the same month last year. And that number brought Q3 sales to about $23.5 billion overall. TSMC had initially said it expected revenue of 22.4 to 23.2, so that would be higher than the range that Taiwan Semi had previously given, and also higher than what Wall Street is looking for. The number Wall Street is looking for is around $22.72 billion in sales. In terms of the earnings number, looking for adjusted EPS of around $1.74. I think what's important to note here, you can see the chart. It's very easy to tell. The bar is high because this is a stock that has seen a really impressive run higher. Shares are up more than 80% year to date. It's only about 3% and change away from the highs. I will say analysts do see more upside to this name. The 12-month price target is $210 a share. As you can see here, it's trading around $188 right now. So analysts are still bullish on this name. All but one has buy rating on shares. So still a lot of bullishness, but I think that, when this is a stock that's up 81% year to date. Just really goes to show how high that bar is to clear when it finally reports results tomorrow morning.
I know, and I feel like they also give a great read on the supply chain because, like you said, they're involved. They're like an integral cog in the chain of supply chain. Like ASML supplies to Taiwan, who supplies to NVIDIA. Everyone is connected. So their success of their foundry, supply chain is so right now important to the rest of AI. I was having a hard time I understood the connection of ASML, why we were seeing that weakness, but I didn't believe in the narrative that meant that AI demand was waning or anything like that. But I think Taiwan could be actually a really great read on how, of course, that looks. Now, last name today is Qualcomm. Qualcomm has also been relatively a pretty strong performer. And interesting enough, maybe I was not aware of the fact that they were even possibly interested in purchasing Intel. But per Bloomberg, Qualcomm is likely to wait until after the U.S. presidential election in November before deciding whether or not to pursue that buying offer. So I guess I didn't realize that was on the table because that would be a very interesting move by Qualcomm.
Yeah, in terms of Qualcomm's move today, we are seeing a move lower, down about 1.3%. So not taking part in the rally that we're seeing in terms of some of the other chip makers today. It did get a price target cut over at Citi. The Citi analyst was already on the sidelines for this name, but is scaling back their price target expectations. Lowered the price target to $185 from $200 a share, kept a neutral rating on shares. So as you can see here, or actually the chart's not up anymore, but Qualcomm's currently trading around just below 172 right now. So still some upside, just not necessarily as much. The analyst also issued a negative catalyst watch on Qualcomm, saying we are launching a negative catalyst watch on Qualcomm given our expectations of lowered forecast. In addition to Apple going away beginning in 2025, we are 11% below consensus for the December quarter. So Citi expects semiconductor consensus estimates to decline during Q3 earnings season given cooling demand for PC and wireless end markets, along with worsening demand and excess inventory in the auto end market. As such, they're developing a much more defensive stance in semis until the end of the year. Analog devices is the top pick for them there. But we also heard that in the Citi note that was upgrading Cisco as well, saying that they're continuing to see an investor rotation, or they think that we'll continue to see this investor rotation out of semis and into the networking equipment space. So this kind of follows through with that theme. Qualcomm shares under some pressure today, down 1.3%, still up almost 20% year to date, but a long way as off those July highs or late June highs, about 25% off the 52-week highs.
And just absolutely stuck now at this current level around 170 I was seeing. But I will say, I was saying that TSMN does trade at now this lofty valuation. It actually doesn't. It trades at around 26 times its forward earnings, but Qualcomm trades at around 16 times versus the semiconductor industry at around 37 times. So actually, both of these names look relatively, historically at least, affordable on a forward-looking basis, given their valuations, which is interesting because there's so many expectations for these names. But we'll be looking more at the chart of Taiwan Semiconductor as well as Cisco on an upgrade day today. We'll also be diving into some example trades. So we'll be right back. Stick around. Next Gen Investing will be right back.
Wrap up the trading day with me.
Choice you need, right? Neil, tell me you know this.
Gotta run, Carl.
Schwab.
Have a choice in how you invest with Schwab.
Welcome back to Next Gen Investing. It's time to chart and trade our upvoted stocks, which are Cisco and Taiwan Semi. For that, let's send it over to Jenny Horn, who's standing by with the chart master, Rick Ducat. Rick and Jenny, take it away.
Thanks so much, Caroline. So we've got two very different names today, but both operating, hopefully benefiting from AI. Of course, that's the theme of our show, the really A block today. But we'll start off with Taiwan Semi, as they do have earnings tomorrow morning. And I think that this is one that could be interesting because oftentimes, there's the bellwethers of the rest of the space. Not to say that one name is indicative of the rest of these companies' earnings, but I do think this has been a winning trade this year. I mean, objectively, we're up 80.5% year to date.
Like many things in life, it all depends on where you started and where you finished. Because you're right. In general, we have been moving to the upside pretty convincingly for a while here with a notable departure. We had kind of this V-shaped, situation here where price fell off very sharply here. We did find a bit of a foothold near our purple 252-day exponential moving average here. So that's why it can be useful to include moving averages and so forth on your charts. They can be support during uptrends, resistance during downtrends. And in this case, we can see the move our last downswing. Now we have been rallying to the upside. We crossed above this green line here that represents the post-gap down high points, a repeated stopping point for price here. And we have also made our way above not only the previous highs, but also this downward sloping trend line that we had in blue. Now we are finding that we couldn't quite crack that previous high that we established here near 193. We formed a bearish engulfing candle yesterday where the red candle completely swallowed up the previous day's smaller green candle here. Not a lot of follow through to the downside today though, which is a crucial part of that bearish engulfing candle setup here. So we remain close to the highs. We saw heavy volume yesterday, a volume spike, but not a ton of net movement so far here. Still comfortably near those highs, Jenny.
Yeah, about 3% off of highs, which, hey, it's not too bad, especially when you're talking some of these big tech names. So considering they did have some pressure on their last earnings, I mean, they have seen a bit of a mixed reaction to their earnings reports this year. And I know because I follow the same closely. I think this is actually one of the most interesting of the AI world. But momentum of this trend now, what is RSI showing you?
More geared toward the upside here, but there is a bit of a question mark, I would say, because we do have this longer term downward sloping red line here starting back here and connecting to the subsequent highs. You can see that we have stayed more or less within the boundaries of that trend line here. Now, what we don't want to see if we're bullish is the disparity between the closing prices and the closing levels of the RSI here, because you can see that price notched a higher close while RSI actually was trending slightly lower there. So that's what we call bearish divergence, a mismatch between price and momentum here. However, momentum still more angled toward the upside. We're above the 50 midline despite this failure to overcome our trend line here. And as I said, we're still pretty darn close to those 52-week highs. So it's hard to make too much of a counter argument here against that here, but look to see if momentum continues to deteriorate, especially if we invalidate our green trend line and slip below that 50 midline. Those would be some potential warning signs to watch, but for now, like price, more geared toward the upside.
Okay, and I very vividly remember that oftentimes when we talk about NVIDIA, because we preview their earnings like 1,000 times, I feel like we talk about how momentum has historically waned into earnings because we're just waiting and seeing. So maybe similar sentiment there. Well, not weakening, it's just not necessarily taking off either. So now, of course, earnings tomorrow. What are we watching as far as some price levels? Yeah,
that's a really good point to keep in mind too. Momentum does tend to dissipate a little bit as we head into an event risk situation that everyone knows is coming here. So for our purposes here, 194, 195, that's the obvious high point that we're quite close to. That's where you'd be looking for a potential breakout here. So, I mean, that area really stands out very clearly here. However, when we look a little bit more closely here, there's two questions we need to ask is, are there any other near-term sources of resistance? And if we do break above those highs, where do we go from there? So linear regression line, and from that, the standard deviation channels that we create from that line can help us answer that. So we have our solid blue line right here, our idea of fair value, our line of best fit based on closing prices, comes in near 190. So that's where we have not really been able to make our way above yet. That would be a crucial stepping stone on the path to those highs. Beyond that, if we were to keep moving higher, 221 is our +1 standard deviation channel, one standard deviation to the upside from our linear regression line. To the downside, yellow 21-day exponential moving average is right on top of our white short-term trend line that began with our notable low point there at our 252-day EMA. So right around 182 would be another key area here. And then our green line, our repeated resistance point that could become supportive. Old resistance becomes new support and vice versa, 175.
Yeah, so a really interesting one. I have to say, I know that earnings, like when they report tomorrow, it's backdated because it's the previous quarter now at this point. But there's two different ways to look at it, because when you see a name like ASML, which I cannot believe how many times we've talked about this company this week, but when you see a company like that that says they could see some more muted expectations going forward, that could also impact a name like Taiwan, considering their relationship. But then NVIDIA at the same time says they have like insane demand, were their words. So that could also benefit Taiwan. So I think it's really interesting way into earnings. So walk us through now how you think about trading this name, of course, for example purposes only, given the fact that I do think that the conviction is still very much in the bullish camp.
Okay, so two thoughts that I would have on setting up an example trade here. One is that we're near the highs. We're just a stone's throw away from that high point there. Two, It's hard for me to imagine a scenario where we use less computer chips going forward.
Right.
I just can't really see that line of thinking in general here. Maybe some chips are better than others, of course. You know, like there's obviously differences between the products here, but in general, it seems like the demand's just going to keep going up here. So for this example trade, we set our sights on that high point here, and we thought about a call calendar type trade here. So +1, November 1st, October 18th, 195 strike call calendar at a $2 debit here. So we've got a short call at our October 18th strike, a long call at our November 1st strike at the same price there, strike price there. Break evens come in near 181 and 212. You can see our shaded area, that was the expected move here, you know, comes within the peak point. That would be our max profit area. Were we to leave this spread as a single unit here? But there's other ways you can do this here. You could just use that short option to defray the cost of buying that long option. You could, if it is going in your favor, you could get rid of the short option, then just keep the longer dated long option, or just keep the whole thing together for added safety, or if it's not going exactly how you want it to go here. But as our friend Alex Coffey says, highly customizable type of trade. You can kind of set it up to your own parameters here. But the thinking is we would get some kind of push beyond, or at least head toward that 195 level. That's the main thought for this one.
And also utilizing some of its already momentum, I mean, to the upside. I know we're only up modestly today, and we pulled back this week, but again, still a name that's up over 80% this year. So it's
one quick thing too. The reason we sold at this expiration, high premiums because we have earnings coming up, so things are a little bit more juiced. So we were able to actually knock off a good bit of that debit that we paid for the long option.
Okay, and that's a great point, because right now anything with earnings, I feel like you're looking at a premium, so I think a great way to put that there. But now to look at Cisco, and a name that I talk Taiwan, frankly, a lot more. I'm not as familiar with Cisco, and I think that's because the hardware space has not been as exciting this year. But to your point, we're not going to use less computers. I mean, I do believe that I do use Cisco systems every day still, so that's not going away anytime soon.
It's hard to work in an office and not come across Cisco products. You know, it's just so pervasive everywhere throughout, you know, the office environment in general here. So definitely I can see that line of thought here. So when we look at this chart here, it's actually kind of a similar short-term read on our last chart here, but maybe perhaps even a little bit stronger here. So you can see that we were in a bit of a slide for quite a while here on the year, but when we did bottom out at this low point near 44.50, we have just taken off with some serious strength here. We're up about 25.5% from that point, moving comfortably into those 52-week highs, you know, just really breaking above any previous boundaries that we had set on this chart here that we're just looking at the past year. So you can see this is kind of the downward sloping trend line, our blue line there that we have moved very convincingly above at this point. We've crossed above all our moving averages, where everything's trending upward here. You know, things are looking pretty decent here in terms of this shorter term trend.
Okay, and correct me if I'm wrong, this is one of these names where we're obviously at 52-week highs today, but I believe their all-time high was back in like the 2000s.
Yeah, we're not near the all-time highs. You know, it's not even like multi-year highs really, but just the past 52 weeks. I would have to check the longer chart specifically.
I took like max time frame, and I couldn't even read what year it was. It was so long, so I think it was quite some time ago, which I just thought was kind of amazing here, given the fact that we've seen, I mean, a pretty nice run since hitting actually lows now. So now when we look at momentum also of this trend here, we don't have earnings for about another month, I believe. So what are you seeing as far as RSI?
So kind of a contrast to our last chart. This is more what you would want to see in terms of momentum behaving in terms of the RSI here, where we've got a higher high relative to our previous high, matching up with just the price behavior, and we are in the overbought area. If you had asked me a couple days ago, I would say, well, you know, we're perhaps getting a little bit of divergence there because we were not clearing that high. Also, it's always important to note that it gets more complicated when you have these mixed signals of the divergence, but also heading into the overbought area, because the overbought area is a sign of strength in a trending market here. So overall, though, new highs, overbought, looking pretty good. large green candle right near the high of the day so far here. So everything's looking like we're lining up pretty nicely. As I kind of said in our previous thing, look for the bearish signals to be the cross below the overbought area and the invalidation of the green trend line for some cracks would be starting to show if that were to develop here. But for right now, it's hard to find too many signs of a slowdown.
No, and unfortunately for this name, I feel like earnings are almost their Achilles heel because, I mean, you could see some pretty substantial gaps down, and then since the last earnings, we've been making this nice breakout. So can we hold through their earnings, which I believe is the first week of November? I'm going to have to check that. But now, as far as these levels we're watching with Cisco, which is making, like you said, a nice 3% move today, outperforming the market this week thus far, what are you seeing?
One of the other reasons that I like using standard deviation channels to assess a big move in a stock, not only does it give you potential targets to look for to the upside or the downside when a stock is making new highs or lows respectively, it also helps you gauge how extreme the move is relative to its own history. That's because we're comparing our own set of data here and examining kind of the variance of that data. So now we can see that we've got our blue linear regression line, our fair value idea, our solid blue line there. Price has been traveling upward in kind of this very steep, very narrow, rising wedge type shape, and we're breaking out even beyond that here. So we have handily cleared the +2 channel. That was a long time ago at this point in terms of our price activity. We are moving above the +3 channel. The +4 channel is not insanely out of reach or anything at this point either. The +4 channel in purple there would come in at 57.43, so that could be one general area to keep in mind as we move forward through our trading activities during the coming weeks here. But if we were to get a little bit of a pullback, look for that red line, 55.19. Beyond that, there's a couple other supportive areas here. The gap that we formed here near 54.61 or so, and then this green line all the way back here was another gap that was filled and then breached near about 53. So, things look a bit more geared toward the upside right now, but those would be some levels to watch if we do start to take a turn to the downside.
Okay, and earnings November 13th. I just had to check because I have a lot of earnings dates in my head right now. But now, when we trade this name again, for example, purposes here, bullish Nevada City today, so leaning into this bullish mindset.
Yeah, we have two charts in similar situations, both making new highs. We took perhaps a slightly more aggressive approach to our last chart. This would be a bit more of a softer target here, so we would sell a put spread instead. -1 November 15th, 55.52.5 put vertical at a 70-cent credit here. So all we have to do is just stay above that break even to keep our credit here rather than having to overcome a target that we have set, that's above the current prices here. Neutral to bullish, break even comes in 54.30. Risk reward, $70 of credit versus $180 of max loss. So roughly 1 to 2.5 in terms of reward versus risk here. Once again, you can see our shaded area. That's kind of the expected move of where price could be going in the coming weeks here. You can see it is much more biased toward that upper margin that we have here. So this is a more high probability type of trade that we could put on here, just seeking to take advantage of the continued momentum and giving ourselves a little bit of a cushion if perhaps things take a little bit more time to develop than we would hope for. But still, a neutral to bullish play looking for additional upside in this name as well.
Yeah, and a good way to play on duration because obviously their earnings aren't tomorrow morning. We do have some time to work with here to hopefully see things continue to the upside as we're making a nice 3% move higher today. So great breakdown. Appreciate it, Rick Ducat. Now I'd like to send it back to Caroline, who's standing by at the NYSE.
Thanks so much, Jenny and Rick. All right, we're going to take a quick break, but coming up next, it's time for FOMO, and we're going to preview Netflix's earnings tomorrow afternoon. One analyst are already getting more bullish ahead of the report, although we have seen downgrades to sell as well ahead of that report. Shares under pressure right now. We'll talk about it all when we come back.
Empower your portfolio with the Schwab Network. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab Investing Themes. 40 customizable themes, up to 25 stocks in just a few clicks.
Get each and every angle, the whole picture. Everything comes full circle on Trading 360. Catch us right here at the New York Stock Exchange on Trading 360, only on Schwab Network.
This election season, stay out of the muck and the mudslinging with Schwab Network's by-the-numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk.
No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Next Gen Investing. It's now time for FOMO, and joining me today is my co-host Caroline Woods from the NYSE to break down Netflix's earnings, which I have to say is my main focus of the entire week. I know everyone was excited about banks and economic data, and the Fed, what have you. I'm watching Netflix because there was a time when this name brought down the overall market. I mean, this could be an interesting name. We haven't seen those types of earnings reactions in a while. I mean, thank goodness, honestly, because it was a bit of a jump scare. But I do know that you recently watched the Netflix show that I cannot think of the name with Kristen Bell, and I'm also a huge fan. Now I can't think. It's like Nobody Wants This.
Yes, I actually recommended that show to Tom and Kevin on Fast Market, and then I was thinking maybe this is a better recommendation for Jenny. So I'm glad that you love it too, because I actually, Netflix, of course, has made a bunch of business model changes. They made them last year that have been hugely successful, one of them being password crackdown on sharing. So I've actually converted to be a paying customer. Finally, there were only so many times I could get rejected when trying to log in, and I did so that I could watch that show. I absolutely loved it. But yeah, the bar is high for Netflix. We talked about it being high for Taiwan Semi. I would say with Netflix's 45% year-to-date gains, the bar is pretty high for Netflix as well. In terms of what the Wall Street is looking for in terms of the actual numbers, adjusted EPS of $5.09 on revenue of $9.77 billion. That would represent about a 14% year-over-year increase. Just to put that into perspective, in Q2, they posted a 17% year-over-year increase, so a sequential decline, but still double-digit growth nonetheless. Of course, subscriber numbers are always key when we talk about Netflix. For Q3, Wall Street's looking for Netflix to report 4.76 million net new paid subscribers. So in Q2, they added about 8 million, bringing the total global base to 277.65 million. So we'll see where they are in terms of subscribers. And then when they last reported, they said that they're making steady progress scaling its ad business. I talked about the password crackdown, password sharing crackdown. Another big business model change, of course, that they made were the cheaper ad tier models, which I can't bring myself to use because I can't stand watching ads. But they had said that ad tier memberships grew 34% quarter on quarter in Q2. So we'll see how that's going as well. In terms of the outlook for Q4, previously they had said that they're expecting full year 2024 reported revenue growth of 14 to 15%. I will say that Gene Munster over at Deepwater was out with an X post, or posted on X earlier this week, and said that he doesn't expect any commentary in terms of 2025 outlook from Netflix. So we'll probably have to wait a couple months to get a sense of what 2025 is looking like in terms of the outlook. But what I think I'm most worried about is that some analysts have talked about a potential more price increases from Netflix. Back in 2023, that was the last major price increase, and it was just on premium and basic tiers. So that left prices of the ad-supported tiers unchanged, but now they're calling for potentially more broad-based price increases, which would be a bummer for someone who just signed up here. But New Street research analyst Dan Salmon wrote in an October 15 note that the next price hikes could potentially be broader-based, and he's not alone. There are others that are expecting that Netflix will hike those prices too, especially when you compare the price of Netflix versus some of its competitors like Hulu, Disney Plus type of thing, those bundles. So Netflix shares, we talked about it at the top of the show, under a bit of pressure today, down about 0.4%. Basically, down almost 1% this month, not much, but they've had a really impressive year to date. And if you take a look at the one-year chart, up almost 100% over the past 1 year. So it's seen a really incredible recovery, especially if you even scroll back even further and go to, I think it was the 2022 lows. Netflix has really had this impressive run higher, but let's see if they can clear the high bar.
I know that is, I think my skepticism is we've had a really phenomenal run. I mean, like Mag 7 Who, Netflix has been one of the most compelling names throughout this year in the tech space. And I have to say, I recently did like a clean house of all my subscriptions because I was signed up for just way too much. And Netflix was the one I kept. I mean, of all of the major streamers. So there's a reason we keep coming back to it. There's a reason I get kicked off my dad's plan and another plan. I keep subscribing. And I agree, I will pay any dollar amount. I feel like I've reached an age where ads, I'm like, I cannot deal with anymore noise. I will pay premium dollars to avoid those ads. And I also know, less interesting, but in the spirit of the NFL, and we are approaching at least Thursday, which does have football, but the NFL games are coming to Netflix this Christmas, I believe. So that's also, I don't know, it doesn't have to do with their earnings, but that's exciting to me because we've never really seen live sports. They did do that live Tom Brady roast, which was well done, but I'm excited to see more of this live content.
A couple points that you made there, Jenny. First, the Mag 7 comment. I've actually added Netflix to my Mag 7 watch list because I do think that it really should be the Magnificent 8 after this year, or after the past, 1 year, essentially. In terms of other content, now that I'm a paying subscriber, I'll have to talk to you offline because I need some other suggestions in terms of what to watch because after now that I'm paying for it, I've only watched that one series and haven't turned it back on since. So I need to justify the cost. In terms of, we kind of previewed some bullishness on the name heading into this report. I do want to talk a little bit about the analyst breakdown as well. Loop Capital did just bump its price target to $800 a share from $750 on Netflix, reiterated its buy rating heading into earnings, saying, we believe there will be a bias to upside revisions, and in turn, they raised their price target. Wedbush also earlier this week raised their price target to $775 from $725, saying we think Netflix is positioned to accelerate ad tier revenue contribution into year-end and 2025 as it improves advertising solutions and targets and utilizes new partnerships and adds more live events. Earlier this month, Piper Sandler upgraded shares of Netflix to overweight from neutral, increased the price target to $800 a share from $650. Could say that was playing quite a bit of catch up there, but they said that their previous neutral rating on shares was due to the stock's high valuation, but now they say, now we appreciate the company is expensive for a reason. And then there was also another analyst note that stuck out to me, not something that interests me, but Jefferies, one of the reasons that Jefferies is bullish on Netflix or continues to be bullish with a buy rating and $780 price target is based on the anime boom. I guess analysts are expecting the anime market to double from $31.2 billion in 2023 to $60.1 billion by 2030, and they think that Netflix is poised to capitalize on that anime boom. But there are some, more skeptics out there. We did see Piper Sandler recently downgrade shares to underweight from equal weight, maintained a price target of $550, saying even if the company gets to its revenue growth goal, valuation is implicitly pricing in more than a doubling of subscriber base from present levels. And they said that they don't think that it's really saying paid sharing more than likely pulled forward some growth, but they don't think that they'll get anywhere near that level. So there are some skeptics out there. More than 70% are bullish on the name, though, heading into this report. So, Jenny, I'll toss it back over to you if you have any final thoughts for Netflix.
Gosh, Caroline, I heard anime, and that's why really I signed up for Netflix, because my boyfriend is a huge anime guy, and so I have watched way too much anime as of late. So, gosh, I cannot even dive too much into that. I'm like getting PTSD, but we'll leave it there. We'll be watching, of course, Netflix very closely when they report tomorrow. But coming up next, we'll switch gears. We'll actually look at one of these Mag 7 names with AWS going nuclear, investing $500 million in nuclear power. We'll dive into it with Kevin Green coming up next.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
No politics, no noise, from bell to bell and beyond. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Next Gen Investing, and I'd now like to welcome in Kevin Green, senior markets correspondent here for the network, to talk about AWS going nuclear here. So this is interesting. Nuclear has been one of the stories in the last several weeks, as we know that it's become more and more important to the AI trade. So Kevin, walk us through the story.
Yeah, especially when you're talking about small nuclear reactors. That's really what's getting a lot of attention here from these mega cap tech names here. And AWS is actually looking at expanding their footprint when it comes to power. They are actually investing $500 million and actually working with Dominion Energy in order to start up these factories or these reactors in order to power their data centers. Now, this is going to be really focused within the Virginia area in order for them to be able to expand. But this is just another reason why the data center side of the equation when it comes to AI is also going to need energy. And so they're utilizing these type of techniques in this industry as a whole in order to also reduce its carbon footprint, which has been kind of that back and forth for a lot of these traders in the utility space as well as the energy space. There's been a lot of questions as to where are you going to get the actual energy to power these data centers. And at first, there was this notion that it was going to come from natural gas, but you're seeing a lot of these tech companies are really trying to look towards renewable energy sources or even nuclear energy in order to fulfill their needs. Now, this SMR, which is the small nuclear reactors that they're going to be setting up here, is going to power at least 300 megawatts worth of power to Virginia's grid. And then obviously AWS will be drawing off that grid as their needs apply here. So another boon when it comes to the uranium trade. And you can look at a couple of other stocks that are actually getting a bid for this. We have CCJ, which is a very popular uranium name that is out there. Even if you're looking at URA, which is an ETF that has uranium companies within it, that ETF's up over 6% in today's session. And the other one that's catching a little bit of a bid is the ticker symbol SMR, which really does focus on the small nuclear reactors. And that one's up over almost 30% in today's session. So really good news on the utility front as well as on the data center front.
And Kevin, I think this is such a great conversation regarding AI and how they're building out, but we are out of time for today. We'll talk about this, I'm sure, more later on, but appreciate it. Kevin Green, senior markets correspondent for the network. Now coming up next, last but not least, time to talk a name that's a blast from the past for me, at least, Novavax, which is down 17.5% today. We'll tell you why coming up next.
Empower your portfolio with the Schwab Network. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Welcome back to Next Gen Investing. It's now time to talk Novavax, which is unfortunately down almost 18% on the session, and actually has come off of session lows here. So to tell us more about why we're seeing the sell-off today, I'd like to welcome in George Tillis, Senior Markets Correspondent, and of course my co-host today, Caroline Woods. So George, walk us through what we're seeing here, because Novavax needed a win. Today is definitely not a win.
Yeah, it's definitely not today, Jenny and Caroline. I mean, if you consider Novavax, I mean, this was one of the names out there, along with Pfizer, Moderna, for COVID-19 vaccines. And one of the challenges for Novavax is they didn't actually receive their emergency use authorization until 2022. So they were actually one of the last players to actually get FDA approval for their vaccine. And they've actually gone through and now revamp some of their products, which includes commercializations of vaccines for infectious diseases, including a combination of COVID-19 and a flu vaccine. They did get, of course, a clinical approval from the FDA, but it looks like, based on the news today, that the FDA has now placed a hold on that combo COVID-19 flu vaccine and their clinical trial based upon some results that found neuropathy, which is basically nerve condition in some of the patients that received this particular combination. And so as a result, obviously, the stock is trading the downside by about 16 or 17 or so percent. But, you know, one of the things about this name, and this also goes in the same camp with Moderna and, of course, Pfizer, those stocks are all down since their peaks going back to late 2021. And, of course, Novavax is no different. The stock was trading around $230 or so, and now it's somewhere in the double-digit range, around $10 per share. I think one of the challenges for this particular company relative to some of the others like Pfizer is essentially there's lack of sustainable growth. Vaccines have always historically been not necessarily the most appealing capital investment-based preventative measures for health because they're not very profitable. And one of the things, of course, Moderna did is they partner up with BioNTech as a company. We know Pfizer has a lot of other clinical trial drugs and even drugs in distribution to treat chronic illnesses, which help, of course, sustain its revenues to push its vaccines out the door. I think Novavax is really a vaccine company, and it's facing some challenges without some meaningful partnerships.
You know, George, you make a good point, because I was looking at Novavax versus Pfizer and Moderna because they're very much clumped together. And if you take a look at the year-to-date performance, it's quite a bit different for Novavax. I mean, shares, despite this huge drop today, are up 115% year-to-date versus minimal gains for Pfizer and then huge losses for Moderna. But if you scroll out on the chart and take a look at where it was trading, it's really had a huge fall from grace. So I guess how much of the run-up do you think in terms of share price this year was based on this combined vaccine, or is there something else in the pipeline? Because if that's the case, does it give up this impressive year-to-date rally if they can't get this sorted out?
Yeah, so, I mean, a couple things. First, it's a smaller cap stock. Its market cap, based on yesterday's close, is around $2 billion. If you look at the revenues last year, around $980 million, so let's call it about $1 billion. The company's never made any money. And the biggest revenue-generating year was 2022, when they got that emergency use authorization, is around $2 billion. But in that year, they still lost about $650 million. But fast forward to the last 12 months, they sold about $1 billion worth of product, but they lost still $300 million. So they're not profitable. That's something to keep in mind. That's what's depressing the shares, at least in the last few years. There is some promise, because if you go into next year's revenue numbers, they're expected for 2025 to be down about 39%. But in 2026, they're expected to actually increase. And in fact, they're expecting, based on earnings estimates by analysts, 98 cents a share in profit in 26. So it looks like there's a potential for a partnership. Sanofi has always been a name out there to partner potentially with Novavax for an R&D and, of course, a manufacturing distribution partner. Some of the analysts are still quite bullish. In fact, if you look at Jefferies today, they cut their target from $31 to $25 based on this news, but nonetheless, they still have a $25 price target. And I think it's because there's a lot of prospective potential for Novamax contingent upon them, getting, approval for many of their upcoming immune disease vaccines, but also a meaningful partnership with a large pharma company.
Yeah, and I totally agree with both of you that I feel like we need to see some diversity as far as our pipeline's concerned. But fortunately today, taking it on the chin a bit, and like Caroline said, still holding on to a decent year-to-date rally, which shocked me. But we'll leave it there. Great breakdown, George, as always, and appreciate the co-hosting, Caroline Woods, who joined me, of course, from the NYSE. That'll do it for Next Gen Investing for this Wednesday. Coming up next, we have the Watch List with Nicole Petalides.
This election season, stay out of the muck and the mudslinging with Schwab Network's by-the-numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk.
No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
The market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Being lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see patterns. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways, as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I'm very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
Welcome to Market Overtime on the Schwab Network.
Quality Focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
It's controversial. The old guard is saying, away, off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in.
Good afternoon. Welcome to the Watch List. I'm Nicole Petalides. It's 2 p.m. Eastern Time, and we're coming to you live at the New York Stock Exchange. Glad you are with us. We have a big show for you today. We'll focus on fixed income markets, discuss why leading asset managers are leaning heavily in the space, and Microsoft is on our radar ahead of earnings at the end of the month, and how Microsoft's Azure has grown And how will AI contribute to the earnings? Our panel standing by to discuss Apple ahead of the release of Apple's intelligence later this month. So let's take a look at the markets. We were seeing some records in the S&P and Dow, and whether or not we could see them again today or this week. So we've seen yesterday we saw a sell-off, but today bouncing back. The S&P 5835, it's up 1/3 of 1%. The Nasdaq's flat, 20,160. The Dow's up more than 0.5%, and the Russell up 1.6%. Oil and gold are mixed. Oil is right now at $70.38 the barrel, down 20 cents, while gold is gaining over $12. The VIX comes back down below 20. It's at 19.96. The dollar 103, so that 103 handle, 103.35, and Bitcoin continues to gain. Look at that, 68,100, up 1.3%. A nice move there for Bitcoin recently. It's certainly had a good run. That being said, we have a lot to discuss, a lot of big stories here, front and center, lots of earnings. Kevin Hinks is with us, host of Fast Market.
Third quarter passenger volumes in company history. They also approved a $1.5 billion stock repurchase program. This is despite a normally bearish metric, which is capacity was up 4.1%. Total revenue per available seat mile down 1.6%, while cost of available seat mile up 0.1%. But as you know, airfares, TSA numbers, these airlines are all having a great summer and third quarter, Nicole. United, like I said, which has already had a great run, currently up 13.5%. That is a big move for an airline, Nicole.
Yeah, and seeing a strong finish for 2024 for United, really helping the other names like American Airlines, and we also saw that Delta was in the top 10 on the S&P 500 today. We turn our attention over to the financials. Morgan Stanley out some new highs too. Let's talk about Morgan Stanley and double beat.
Morgan Stanley up 6.75%. As we get to the 2 o'clock hour, Morgan Stanley $1.88 a share versus $1.58 expected. Revenues $15.38 billion versus $14.41. A nice beat there. Revenue growth 15.9%. Return on equity 13.1%. So, and including provisions for credit losses, a positive $79 million because of lower commercial real estate provisions. Ironically, all the alarms and all the concerns about commercial real estate, Morgan Stanley was able to add money back from their reserves. So really good numbers out of Morgan Stanley. Again, the stock up 6.7%.
And then Discover reporting after the bell today, right?
After the bell today, Discover, which is basically the owner of the Discover card. Their estimates looking for $3.28 a share on $4.36 billion in revenue. Last quarter, they had 4.54, so slightly lower than last quarter, but higher than a year ago of 4.04 billion. So yeah, a Discover card, one of these secondary level credit cards for consumers. It comes out with earnings after the bell today. Then we get Taiwan Semiconductor tomorrow morning and Netflix after the bell tomorrow. So earnings season, now we're through some of the airlines, we're through the financials, things starting to pick up, Nicole.
All right, Kevin Hanks, thank you for all of those. A good luck there. We appreciate it. Now let's take a look at the bigger picture. Dale Smothers is with us, President, CEO, RDS Wealth Management. Thank you for being with us. We have up arrows today. Yesterday, while the Dow touched a record, we saw markets under pressure yesterday, but a lot of back and forth action of late. What do you expect between now and the end of the year?
Certainly. Nicole, October historically is not a good month, especially in an election year. However, it seems like everything is going pretty smooth right now. Believe it or not, we're positive in the S&P 500. Just like you said, we're hitting record highs. A lot of that probably has to do with what's going on with the Fed and potentially another rate cut that is coming sometime soon, maybe right after the election. I think a lot of things are going higher, although there is a lot of skepticism about what's taking place in the market. We've got an uncertainty here with the election that's coming up, and that could go one of two ways. We've got some uncertainty with what the Fed is going to do over the next 2 to 3 meetings. And of course, there is always the October surprise that could very easily be right around the corner. If you couple that with the fact that this market is hitting all-time highs on a regular basis as we are going through October, I think short term we could see a continuation. And after the election, maybe things settle down a little bit with the uncertainty and we see us climbing higher to the end of the year. But there are two different ways to look at that. Are we looking short term? Are we looking long term? I think the long term picture, we could have a little bit of turbulence in 2025. And of course, if we're thinking 10 years out, we certainly could experience the next, say, 2 or 3 years. If inflation comes back, we could experience a pretty nasty pullback over the next, say, 2 to 3 years, depending on what inflation does.
Yeah, look, the idea here is that inflation is going in the right direction, not only here at home, but also globally. Sure. And that the Fed will cut 25 in the next couple of meetings. Are you implying that you're worried about inflation coming back, or that the Fed is making moves that are probably not appropriate?
Nicole, I just don't see what they're exactly trying to attack with Fed rate cuts right now. I think of it as if they're shooting all their bullets and there's no enemy out there. I wish they would save some of that ammo for when the labor market actually starts to cool off. Now, I'm certainly not in the position to make any Fed policy, and they see things that we probably don't see behind the scenes. But according to the numbers that we're taking a look at right now, I'm not exactly sure why they switched entirely to the other side of their dual mandate. They talk about the soft landing. Believe it or not, in landing an airplane, I've got a little bit of experience behind the yoke of a fixed wing aircraft. And in landing an aircraft, there is this thing called ballooning. I have personally experienced ballooning when you think the landing is going to be soft, and all of a sudden the nose begins to rise again. This is a very dangerous time in landing the airplane. And without a skilled hand behind the controls, you could see a crash. I'm not at all predicting a crash, but I don't believe that inflation is quite dialed down like they believe it to be.
I like the pilot's analogy. We haven't had anything like it. That stood out, Dale. That was something special, hearing that, and I'm glad you were able to handle the situation when it came upon your plane. That being said, here you have a few things that you're watching. You have some ETF picks and stock picks. The stock picks I see are in the at least Exxon in the energy space. I mean, how are you feeling about energy overall? And you have Exxon as your pick.
Yeah, that's a good question. Nicole, honestly, if you're thinking about Exxon specifically, in the short term, a Harris administration, if that's the way things go, could put a restraint on oil. So supply and demand alone could drive Exxon a little higher. If you think long term, I think the Trump administration could make Exxon a household name for years to come. Not to say that either administration is going to do entirely away with things like this type of energy that it seems to be under attack right now, but coal and oil in a Harris administration, short term, I think we see a little bit of a bump. But long term, if we believe that a Trump administration is going to take effect here, having that energy produced in America is going to help a company like Exxon, especially if these tariffs come into play. You mentioned some other ETFs that we have. I'm a big fan of Exxon for the same reason that I've listed all of my other positions that I like right now, because of the strong dividend. Over 40 years of continued growth in their dividend, and we don't see that ending anytime soon.
Yeah, you had Coca-Cola on there too when you look at staples, right?
Yes, ma'am. Coca-Cola is a household name. Again, a solid dividend. When we talk to clients, Nicole, we talk about using another analogy. We talk about dividend investing as if you're investing in a home that you are wanting to rent out. We're not necessarily concerned with the valuation of the home, right? Everyone else foreclose around you. As long as you're still getting the rent, nothing matters about the valuation of that home. Yeah. Coca-Cola has steadily increased, and we're getting the dividend. In other words, they're a renter that pays on time every single month, in this case, every quarter, and they never damage the property. this type of stock is what we're looking for someone who's maybe retiring or just wants steady long-term growth.
Yeah, and you had the NOBL, the Pro Shares, which are the dividend payers, and you had JEPI as the other one. So we're out of time, Dale, but it was a pleasure speaking with you. Thank you, and thanks for telling us about Exxon and Coca-Cola as well.
Yes,
thank you, Dale Smothers, President and CEO, RDS Wealth Management. Coming up, Options Corner. Tom White is standing by. He will highlight unusual options activity from the day and how investors are looking to trade on recent news of Cisco Systems, Delta Airlines, and Alphabet. We'll be right back.
Them, so he's pretty bullish on this name. And if you take a look at the past couple quarters, they've actually reversed some of the losses. They've laid off workers, so they're on this efficiency path also. And the AI revolution, a lot of growth opportunities there for Cisco with the stock only up about 10% so far this year, but having a nice day on this upgrade today. And typically when we see upgrades like that, we'll see some unusual option activity also. And we saw this out in the December monthly cycle. Now, they don't report earnings until mid-November, so you'll capture the earnings event here also. But a trader bought 6,000 of the December 60 strike calls, paid an average debit of only 68 cents. These are far out of the money to the upside. So that break even of $60.68 over the next 65 days is only about 8% above the current share price. You're going to capture that earnings event call volume about 6 times normal daily average volume that we've seen over the last 5 trading sessions. So yeah, a lot of big major call volume in there today. I think it's on about a 7-to-1 call to put ratio as far as volumes go today. So yeah, a lot of positive flows into Cisco, but you wonder if this analyst on the upgrade was maybe a little bit late to the game, as the stock, as I mentioned, was already up about 25% over the last couple months. But yeah, call buyers across the board in here today.
Yeah, look, it's had an incredible run, to your point, right? Had that gap up on earnings, hitting new highs now. On the heels of this upgrade, $62 being the new price target instead of $52. They probably did have to play some catch up there. And you really start to say how AI, it's only the beginning, and how it will boost everything from revenue and valuations, not only for Cisco, but also so many companies, right? I mean, isn't that sort of the idea that we're only in the beginning of all of this?
Yeah, I think that's the thought process with a lot of these offshoots in tech, right? Cisco, legacy tech maker, making highs in the year 2000, but their wide customer base also, I think, gives them a leg up on competition as far as networking goes, because most of the Fortune 500 companies across the globe are their customers already. So as networking capabilities have to start to expand to absorb all this AI data, Cisco is definitely the leader in there. And I think what the analyst basically stated was that the total addressable market in networking for AI is relatively small right now, and that'll expand rapidly as AI continues to roll out.
And then, thank you for that. And then we look at Delta, because when we heard from UAL, I mean, pretty impressive, and seeing a strong finish for 2024. And, you know, the question was whether or not Delta was delivering the same message or not. And now we're seeing Delta moving to new highs as well. So it bodes well for all these airline names. What are you finding today?
Yeah, stock today up, 4 or 5% on the back of those United Airlines earnings. Now, remember, Delta just reported last Thursday, and they were decent numbers. They missed a little bit on EPS, but revenue was above expectations. Revenue per average seat mile was a little bit lower, I think, than the street wanted. But these names have had big, major runs over the last couple of months here as crude oil prices have come down. That helps margins moving forward. Delta is more focused on the business traveler, international travel. That's where they make a lot of their revenue, as opposed to domestically, which had some fare wars this summer. But I think on the back of that United earnings beat and the guidance moving forward, kind of lifting all the names within this space today. A lot of call activity, not just in Delta. I'm highlighting a trade that I saw, put on here in Delta, but American Airlines are buying calls. They've got earnings next week. United Airlines, of course, is seeing a lot of call activity also. But one that stuck out to me here in Delta is all the way out in the January cycle, so about 93 days to expiration, where a trader bought 10,000 of the 60 strike calls, paid an average debit of about $2.35 on those. So that break even is $62.35 over the next 3 months, is about 11% above the current share price in here. And I think one of the key things, I think with these airlines and all the call activity that we're seeing in here, you have to take a step back, because remember, the last time Delta was at these levels was at the start of the pandemic, when they all had to take on a lot of debt. Delta's starting to work through some of that debt. They recently paid off about $4 billion in debt that they had in the balance sheet. But yeah, a lot of call activity, not only in Delta and this one I highlighted, but also in American, Southwest, and United.
So a lot of optimism here. I mean, I don't know if these names can go up another 10, 12, 15% from where they are now. You know what I mean? When you watch the runs, and that's the whole thing about the market is, you know, when do you say it's time to pull back or take profits, and then you have people betting, well, it's had a great run, I think it can go even further, right?
Yeah, and that's part of the problem. I think if you look at fares, they're not coming down. It's in a lot of the CPI data. They'll say, oh, fares came off 3%, but we're still at really elevated levels at this point. TSA numbers are at record levels also, so that need or that want from consumers to travel is still there. But I'll tell you, Nicole, airfare prices are extreme at this point. If they can keep that up, but with crude oil back near $70 a barrel, jet fuel prices coming down, that's actually going to help their margins quite a bit, and demand seems robust at this point.
Yeah, I mean, there is, and now we have the holiday season, and even Barron's was saying something about, forget the cheap fares, because those aren't going to be around. But they did get some nice, hedges on the fuel. So that was some good news there. Let's turn the tech numbers we've seen. You know, we're entering the third year of the bull market. We've seen articles about the tech bull run, and that Google here, front and center, has been moving higher of late, let's say, over 1 month up 3.5%. What do you think is going on here, and what kind of trade did you find?
Well, this is definitely the unloved member of the Mag 7 so far in 2024. It's only up about 17%. And if you look at valuation on this company compared to the other Mag 7 names, it's at the lowest level, and by far, as far as the PE ratio moving forward and forward-looking PE, this is really low. Well, they've got a lot of issues in front of them, right? They've got regulatory issues, a potential breakup from the Department of Justice on the line at this point. So a lot of headwinds for this company. They're still the leader as far as digital ad spend out there. Search, they've got about 90% of the market out there in search. So Gemini, they made some missteps early on as AI was starting to roll out, but seems like they're riding the ship. Truist actually came out with a positive note on them today. They raised their price target to $220 from $196. They keep their buy rating. And this is ahead of their Q3 results, which take place in a couple weeks here. So keep that in mind. And then last night, President Trump came out and said he might not break up Google, so maybe he'll push back against what the Department of Justice is trying to do by breaking up this company potentially. So maybe some positives on the horizon for this company. And we saw some call buyers in here too. And this was out in the November monthly cycle. You're going to capture those earnings that take place in 2 weeks. But a trader bought some deep in the money calls. This is almost like a stock replacement type of option play in here, because out in the November 15th monthly cycle that expires in 30 days, they bought 3,000 of the 150 strike calls. Those are in the money, a delta of about 83, so it reacts more like the stock. They paid an average debit of about $16.88 for those, so that break even of 166.88 over the next 30 days, that's only about 1.5% above the current share price. So you don't need a monster move, but they're paying a big hefty option premium for these calls because they're deep in the money on this potential stock replacement type of strategy. So yeah, some call buyers in here on a down day for Google Alphabet.
All right. Thank you for that. And that 220 call, pretty amazing.
Yeah.
Thank you so much, Tom White. Everyday Options Corner, finding real trades and sharing them with us here on the watch list. Thank you, Tom White. Looked at Cisco, Delta, and Alphabet. Coming up, we'll dive into the outlook for Microsoft ahead of the quarterly earnings due out on October 30th. Stay with us.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
This election season, stay out of the muck and the mudslinging with Schwab Network's by-the-numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk.
No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Schwab.
Have a choice in how you invest with Schwab.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to the watch list. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. It's time to turn our focus to Microsoft. Ahead of the earnings that are due out at the end of the month, I welcome in Angelo Zeno, Senior Equity Analyst at CFRA Research. So the earnings are due on October 30th. It'll be first quarter. You do have you have a top pick within the software space of Microsoft. So you like this name. Where do you think it's headed and why?
So yeah, you're right, Nicole. We have a strong buy recommendation on the name. It's one of our favorite or top names within the software arena. And 12-month target price is $490. That represents some notable upside from these levels here. And a big reason how we come out with that $490 target price essentially is a 30 times multiple to our 2026 estimate. So as we we look 12, 13 months from now, exiting the calendar year, you put a 30 multiple in that year ahead number, and that's how we kind of come out with that target. It's in line with historically where the stock has traded here over the last 5 years or so.
And it's all about AI, right? The AI services that it can contribute to Azure, and every single sentence I read on different categories, there's some sort of AI line in there. It's really across the whole gamut, isn't it?
Yeah, I mean, for the most part, you're right. I mean, and that has been the case really for, all these kind of Mag 7 names here over the last, 6 to 8 quarters. But when you look at Microsoft specifically, there's, I guess, 3 key areas that we're looking out for here on the call. First and foremost, it's the Azure number, right? So that's the first number all investors are going to go to. We're looking for a growth rate of about 33%. It's a slight deceleration from what you saw in the prior 2 quarters. And that's after kind of restated numbers or announced restatements that they cited back in late August. So that said, as we kind of go towards the December quarter, there could be some disappointment on the Azure side of things. But more importantly, what we've told investors is look into the first half of 2025. Blackwell is going to ramp within kind of Microsoft's Azure platform, and that should help kind of that cloud business reaccelerate. The second thing we'd be looking out for is kind of a new segment that they created, their Microsoft 365 commercial cloud business, where they're essentially kind of taking anything kind of tied to the commercial cloud, including any kind of growth opportunities, associated with Copilot within that business. We're looking for about 15% growth, but it's all about kind of what they have to say, at least qualitatively, in terms of kind of the Copilot opportunities out there. Investors initially kind of at the start of this year, we're hoping the second half of this year is where we would really see kind of massive Copilot adoption. It's probably taking place slower than most anticipated, but it's an area we're still optimistic about. And the third thing you have to look out for, of course, is the CapEx spend number. Everyone's kind of making sure that they're going to, hopefully kind of, keep kind of CapEx spend at a prudent level here. And that kind of remains to be seen. Our view is probably biased to the upside, but nonetheless, I think we've kind of seen at least most of the announced kind of increases really hurt the stock price at these levels.
Look, AI spend is important and costs a lot, and you said you want them to be prudent. It may come in above expectations, to your point in some of your notes, and that could pressure sentiment. So it sounds like it's a really fine line. You want them to spend to grow, but not too much?
Yeah, I mean, listen, when it all comes down to it, you need these hyperscalers to continue to spend aggressively. You need them to continue to see the top line do extremely well, that being cloud growth and, digital ad spend growth specifically. Those are the 2 most important themes out there. As long as you continue to see some decent growth from those 2 themes out there, you should hopefully see kind of higher CapEx spend from these companies, because they need to spend more in an effort to kind of increase capacity, and that increased capacity will lead to higher revenue, specifically on the cloud side of things. Our view over the next kind of 3 to 4 years, Microsoft's cloud business should more than double here. So the opportunity is there. The growth potential for Microsoft remains there. They're going to need to continue to spend. You just don't want them to kind of get to a point where capital intensity rates get kind of egregious in nature. Let's call it north of 25% or so. So we think the levels right now are okay. You just don't want them to kind of surprise to the upside in terms of spends.
So when we think about, sometimes we worry about the pressures and the risk and recession and maybe not a soft landing. I mean, there's the sort of bull case scenario where the macroeconomic conditions can improve. And how could that help Microsoft? What would happen in the, what supply would come? What would, how could this boom?
Yeah, I mean, listen, that's a good question. I think, and I think this is an important point here. When you kind of think about the first 12 months after an interest rate cut, most people don't realize this, but the best performing sector since 1990 has historically been the tech sector. And actually, when you look within the tech sector, the actual best performing sub-industry has actually been software within tech the first 12 months after an interest rate cut, which is kind of where we're at here. Software has underperformed here over the last kind of 12 to 18 months. So we do think kind of there's somewhat of a catch up over the next 12 months for software. But as far as kind of maybe your point out there, as we kind of see interest rates come down, especially from elevated levels that they have been here over the kind of the last 2 years or so, that hopefully frees up budgets on the enterprise spend side of things. And if that does free up budgets out there, you would think the enterprise space is going to favor increasing spend on the AI side of things. And then if that happens, clearly you look at a company like Microsoft out there kind of being the enterprise king out there and, being a huge kind of driver of their business out there being AI. So I think you can kind of point to the fact that if the macro holds up and even potentially, more importantly, if interest rates start to come down and some of those enterprise companies out there have the ability to kind of invest a little bit more, some of that money or a lot of that money potentially goes into Microsoft.
So if you're to have a well-balanced portfolio, you don't want to have too many of one kind of tech. You're talking about software doing well, particularly after a rate cut. So maybe Microsoft would be the software name since that's your top pick in the group. What else would complement in a tech portfolio a name like Microsoft?
Yeah, and I'll throw another software name out there. A name that we do like a lot is Salesforce.com. It's a name that's really kind of come back strongly since kind of hitting their lows back in May. But you actually specifically look at what they've done since mid-September when they had their Dreamforce conference out there. It's a name that's performed extremely well. They've kind of got this agentic AI theme that's out there. So it's a name that's really starting to capture some interest out there. And we think there's actually AI monetization potential on a name like Salesforce here going into 25 and into 2026, where they've kind of lagged here over the last 2 years. I'd say kind of, outside of, some of the kind of the system software type names out there, like a Microsoft, you kind of want to still be exposed on the semiconductor side of things. We do think you're kind of still early days in that kind of new industrial revolution out there. So some of the key areas that we've kind of pointed out to in the past in terms of the kind of the semiconductor theme out there, whether it be on the compute side of things like an NVIDIA or an AMD, whether it be a Micron on the memory side of things, or a Broadcom or a Marvell more on the networking side of things. Those are names you kind of do want to be exposed to. You want to be exposed to some cyclical names on the semiconductor side of things as well, like an NXP Semiconductors. And then on the hardware side of things, we think, investors should continue to look at a name like Apple or Dell, where we think they will be kind of key beneficiaries of the AI theme.
Yeah, wow, you covered the gamut. That was good because I wrote them all down. And then, we'll have the battle for $4 trillion. Which company will get that, the Apple, Microsoft, NVIDIA, that's always the ongoing race too. Okay. Angela, I won't even make you pick. Do you want to pick which one hits it first?
I mean, listen, if we're looking 12 months out here, I think, the name that I would kind of say it should be the front runner out there is NVIDIA, because they've got that Blackwell ramp taking place, and they're the ones that have the most upside in terms of the earnings trajectory. But listen, you can never rule out either Apple or Microsoft and their free cash flow potential in their business model.
Yep. Okay. Good to see you, Angelo. Thank you so much. Always a pleasure to chat with you here.
All right.
Angelo
Thanks
Zeno,
for having
Senior
me.
Equity Analyst at CFRA Research. Thank you. Okay, let's continue our focus on your portfolio and some trends of fixed income markets, analyzing why some of the leading asset managers really, including Fidelity and Vanguard, they're leaning heavily into the space. We'll explain with our next guest. We'll be back.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Trading at Schwab is now powered by Ameritrade, unlocking the power of think or swim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to the watch list. I'm Nicole Petalides. Glad you're with us. We're talking fixed income ETFs. In fact, already broke a calendar record for asset category inflows this year. So what are some of the leading drivers and where do we stand now? We bring in Todd Rosenbluth, head of research at VettaFi. Thank you so much for being with us. I know people always want a balanced portfolio and fixed income, something that drives them. Where did fixed income stand? You talked about a record inflows. What drove that, and would that continue?
So you're right. We already passed the calendar year record through September with $215 billion of net new money that went into fixed income ETFs. We've seen even more go in October. We could approach $300 billion by the end of the year, which would be tremendous. Fixed income ETFs are roughly 20% of the overall ETF industry, but they're punching above their weight this year. We're seeing investors, advisors, take more control over their fixed income exposure, targeting the exposure to take advantage of the rate environment, to take advantage of the credit environment, and they're leaning heavily into actively managed fixed income ETFs. Now, many folks have used active management in fixed income, but through mutual funds, but some of the leading firms are now offering ETFs for investors, for advisors to build their portfolios. It's really an exciting time.
We think about the rate environment, and a lot of people were running because they were getting good rates. As rates come down, you're saying that it will still be attractive, and some of these ETFs. In fact, you're hosting a symposium on the 24th. I'm sure you'll be getting a lot of questions. Well, what kind of ETFs may serve me better in a lower rate environment? What would you respond to that question?
So we're seeing investors embrace taking on additional interest rate risk as rates are coming down. So there's a number of ways to do that. You can do that through a core or a core plus strategy and having the active manager do so. So we've seen Vanguard have success with Vanguard's core bond ETF or Vanguard core plus bond ETF. We've seen T. Rowe Price with their active QM strategy. The ticker on that is TAG, TAGG. And we've also, of course, seen investors lean in to take advantage even in short-term strategies. So they're going a little bit further out with fixed income strategies. So PIMCO has had a broad suite of active fixed income ETFs. Elder is a low duration ETF, and the ticker BOND. You got to love the ticker for PIMCO's active bond ETF, BOND.
Yeah, right.
We've seen these products gain a lot of traction in 2024 as investors embrace active fixed income ETFs.
It's amazing how you talk about the record inflows. I mean, of course, people were running to catch rates. That I understand. But are people just more likely to invest more as people are becoming more educated decade after decade? They realize that an invested dollar is the better way to go. Are we finding that the inflows just across the board are improved over whatever, year over year or 10 years or however you're measuring them?
You're right. So we've already achieved a record for fixed income ETFs. We've achieved a record for individual ETFs. So the Vanguard 500 ETF, VOO, has already set a calendar year record. We've seen IVV, which is the iShares S&P 500 ETF, also pass that record. Now it's behind Vanguard, but it's having a tremendous year. And overall, we're seeing the ETF industry is likely to pass the $900 billion mark for net inflows. That would set a new record. We could even see $1 trillion in overall ETF flows. So we're seeing a greater adoption of ETFs. We're seeing a greater adoption of fixed income ETFs as investors get more comfortable with the liquidity, the transparency, the ease of use benefits relative to a mutual fund, and those leading firms that have now offered a fixed income ETF alternative as opposed to mutual funds. So the Vanguards, the BlackRocks, Fidelity, T. Rowe Price, these firms have increasingly focused on ETFs to gain share, and we think they're going to continue to have success in 2025.
And the fee basis could sometimes be more favorable for the investor, right? An ETF over, let's say, a mutual fund or something else?
That's right. So fees tend to be less expensive or lower for an ETF or for a mutual fund. Now, people tend to think of active management as a premium fee, but for example, TAG, that T. Rowe Price ETF that I mentioned earlier, it's just 8 basis points for active management. We now have many active fixed income ETFs that cost 20 basis points or less. That's considerably cheaper than a mutual fund alternative. So more money going into your bonds or going into your stocks and less into the pocket of the asset manager is a great thing for all investors.
Meanwhile, it still is actively managed. And then it just brings the bigger question, like, why is it broken down like this? But that's a whole nother conversation. When you think about thematic investing, what other themes did well in 2024?
So we've seen strong demand for equity ETFs. That's still the largest overall bucket of the pie. And we've seen, as I mentioned, Vanguard 500, the iShares 500 ETFs, but even some upstart ETFs. The Victory Shares Free Cash Flow ETF, VFlow. This is a high-quality, growth-oriented ETF. It crossed the $1 billion mark in just under 16 months. So that's really exciting to see new entrants and even index-based or smart beta strategies have success. So there's a lot of opportunities for newer players that are entering the marketplace to raise their visibility, and we're excited to help tell those stories.
Yeah, on the 24th, as I mentioned, you'll have that symposium. What's the goal there? Where is it, and what are you hoping to achieve there?
Yeah, so thanks for giving me the another opportunity. This is a virtual event. Folks can go to etftrends.com to sign up for the Q4 Fixed Income Symposium on October 24th. 3 hours of content. Myself and some of my peers are going to have conversations with Vanguard and T. Rowe Price, Fidelity, American Century, Bond Blocks, PIMCO. I could name the dozen or so different asset management partners that we're working with. It's going to be a great event. I hope folks sign up at etftrends.com for the Q4 Fixed Income Symposium.
Todd Rosenbluth, thank you so much, Head of Research at Vetify. Thanks, Todd. Good to see you.
Thanks.
And have a good event as well. Still ahead, we'll bring in our panel, talk all about Apple ahead of the Apple Intelligence release that's due out later this month. We want to discuss the impact of AI service and what we've seen from the iPhone 16 cycle, the upgrades, how it's going. Let's bring in the team. We'll be right back.
Neil, how's my favorite client?
Quick question, Carl. Can you offer me the same choices as Schwab?
Choices?
Yeah. At Schwab, I can get full-service wealth management, advice, and invest and trade on my own.
Come on, you know Carl's the only choice you need, right? Neil, tell me you know this.
Gotta run, Carl.
Schwab.
Have a choice in how you invest with Schwab.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage and insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. All so you can trade brilliantly.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to the watch list. It's time to turn our focus right to Apple ahead of its release of Apple Intelligence, which is due out later this month. Of course, everybody was so excited about the upgrade cycle for the 16, what Apple Intelligence would bring. We're learning more as we go. It's not yet installed. Martin Yang's with us, Senior Analyst of Emerging Technologies and Services, Oppenheimer & Company, and William Kerwin, Equity Analyst at Morningstar. So, Martin, I'll start with you. We watched Apple shares hitting all-time highs. What are your thoughts on the valuation of Apple relative to what's coming in the world of AI?
The valuation is definitely at the higher end of the historical range, but Apple, in the world of AI, is the best venue for consumer-facing AI apps. And there's no better hardware to consistently carry the value of AI or consumer AI apps across PC or laptops, tablets, watch, and phones. And if you think about the best-in-class AI consumer experience, and Apple will be the go-to hardware vendors.
And over at Morningstar, you raised the fair value estimate to 185 from 170. Tell me a little bit about where you think this is headed, William, and why.
Thanks, Nicole. We have pretty bullish views, we think, for the impact of AI driving new device sales for Apple, particularly for the iPhone. So we think this will be a multi-year cycle with the iPhone 16 this year and the iPhone 17 next year. But we weigh that against seeing the valuation is pretty challenging today. Apple is near an all-time high, and we think its multiple has expanded past healthy levels, essentially. So while we have a very favorable view of what the fundamentals look like going forward, we think shares are overvalued today.
Yeah, it sounds like no one's jumping on board to way higher price targets here for Apple, but you like what they're doing. William, you mentioned the 16, this year, the 17 next year. Do you think people might even pause and not get the 16 for the holidays because they figure the 17 will come out? Or what kind of, growth are you expecting? I mean, I thought this was supposed to be the revolutionary time for Apple. Is it?
Positive growth inflection. Calling this a super cycle. We saw a very strong cycle back in 2021 when the iPhone 12 came out with 5 capabilities, but we think that was also partially driven by COVID demand.
Yeah, I'm going to jump in here, William. I'm just going to jump in here. Martin, same question. Are we in a super cycle or not really?
I believe we are in a super cycle, but this super cycle, I think the adoption curve will look a little different. We're already seeing relatively weaker initial reception for iPhone launch, but with the release of Apple Intelligence later this month, I think that will spread through word of mouth how much more innovative new experience Apple Intelligence will bring, and that will drive a stronger uptick in device upgrades and new device purchase in calendar 2025. So I'm still expecting a stronger cycle, but the cycle will come up at later with more months after release, not immediately.
Yeah. Do you feel that, Martin, that the balance sheet looks good to you? I mean, it's been referred to as a stellar balance sheet.
Yeah, balance sheet is rock solid. They still have more room for share repurchases, and this is increasingly a higher margin business and doesn't really detract the companies from returning more cash for shareholders. So I don't think there's any investor concerns on the balance sheet.
Right. And then when you think about the holidays, I mean, do you think that we will see demand? I mean, we talked about the different products and upgrades that we're seeing across the board. I mean, one, from the ear, the AirPods, and also the watches and things like that. I mean, detecting sleep apnea, for example, or helping with your hearing, adjusting for your hearing, like almost like a hearing aid. I mean, it was sort of, is that monumental to you, and will that help holiday sales?
I wouldn't characterize it as monumental, but I do expect this holiday sales to to have improving device sales across the accessories, the laptops and iPads and iPhones. iPhones in the holiday season, will be supported by Apple Intelligence rollout. I think definitely have a very positive outlook into holiday sales for Apple in the December quarter.
Yeah, and I think about the Apple Vision Pro, which came out, I forget what it was, 3,000 plus. Hopefully they're going to bring that price down at some point. But William, how are you feeling about, look, that you have a Meta, which announced a competitor for the Apple Vision Pro, and the holidays are coming up. I mean, what could be a win for Apple and what not so much?
We really think the Vision Pro is less about what the product looks like this year and more about where that product is evolving in 5 years' time, even in 10 years' time. Clearly, this is going to be a competitive environment. Meta is investing a lot in this. We think Apple will continue investing. To your point, we expect a lower price point, still probably in the ballpark of $2,000, to come out for maybe a basic Vision product in a year or two. But ultimately, we see this as a low volume product that Apple wants to eventually drive towards something that looks more like glasses.
Yeah. Martin, are you worried about the regulatory environment? I mean, the ecosystem of Apple is incredible. If you have a home filled with Apple everything, at the same time, the regulators don't always like that. Where do we stand there? Is that an overhang on the stock?
I don't think it's an overhang anymore. I think the biggest market for Apple on services in the US, and I think the ruling against Epic Games dictates that App Store will stay pretty safe without strong alternatives in the US market. And elsewhere, there will be third-party app stores that challenge Apple's own on app distribution, but because Apple's users doesn't really benefit that much more from alternative app stores. So I think the overall software ecosystem stays very strong for Apple, providing the best ease of access for users.
And I think once people really understand what Apple Intelligence is, or they understand how to utilize it, then it will become more desirable. Because even right now, people are sort of uncertain why they need AI exactly, on their newest phone. Thank you both so much. Martin Yang of Oppenheimer & Company, William Kerwin of Morningstar. Martin, William, thank you both. That's going to do it for us here on the watch list. I'm Nicole Petalides. Thanks for being with me. Download our free Schwab Network app. It's available in the Apple App Store. Tune in 24/7, schwabnetwork.com. I'm Nicole Petalides. Keep it right here. Market on Close with Oliver Rennick is next.
This election season, stay out of the muck and the mudslinging with Schwab Network's by-the-numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk.
No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
The market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Being lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see patterns. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways, as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I am very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
Welcome to Market Overtime on the Schwab Network.
Quality focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
It's controversial. The old guard is saying, away, off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in. Good afternoon and welcome to Market on Close. I'm Oliver Rennick. We've got a pretty good session here with an hour left. Russell leading the way, the NASDAQ going back positive after a little chop and a drop yesterday around semiconductors. Seeing some repair of that trade, but it's really about rotation here in the session. Got a good show coming up, lots to talk about as we've got earnings too picking up the pace, little momentum into tomorrow. Nice rally underway, all four indexes up. Pretty good amount for the Russell, 23. That's a pretty big deal on the small caps. Looking for a lot of things trying to break out. Maybe not the tech leaders, but there's enough conviction, it seems right now, elsewhere to give you some confidence. Tomorrow's the big day for economic data. Of course, you get the jobless claims, but this week's highlight is retail sales and industrial production as well. We do have Taiwan semi earnings as well, and that's going to be a big one. So tomorrow's the main day of the week. Yesterday was kind of a surprise drop around ASML's weak guidance. Definitely sent a little shiver throughout our AI trade, but today at least there's no more downside there broadly in the semiconductors. Stabilizing, not a bounce back either though, so if you're looking for the pure tech trade, then you might have to wait another session to see if TSM gives us some reassuring numbers tomorrow, but overall stability helps the market find some balance in big tech. Looking at the charts, there's definitely still some room for improvement. Semiconductors have already been a little bit sluggish on a sector basis. It's been NVIDIA and TSM kind of going out on a limb on their own, testing the old highs, getting through them on a closing basis, but not an intraday one. So if you really want to get picky on the technicals, NVIDIA still needs to get through its candle chart to an all-time high. Today's session in the range of it, pretty small compared to yesterday's wide candle and a big sell-off. So that's pretty much your NVIDIA context. At least there's no selling further and a good bounce in NVIDIA today. It's just by NVIDIA standards after a pretty juicy drop. You want to see some more. Maybe that'll be tomorrow's project after TSM. That being said, though, the rest of the stuff looks like we might be focusing on a different narrative. There's been a lot of fits and starts for rotation in the past year. None that really lasted too long, but now that we've had several weeks of breadth improvement under the surface, and the fact that the latest high in the S&P 500 did come without tech gains relative to the July high, this is a pretty good-looking rotation that appears to have quite a bit of conviction. Value trades are doing well. VLU ETF is the best performer on the day. Do have yields still kind of sluggish, but generally the trend has been for higher yields, and that has been a positive thing. Stocks have enjoyed that. That's been really important, seeing that you're not getting a breakdown in the small caps. You're not getting a breakdown in the value trade because yields have been going up. Now, yesterday was an exception. Today, kind of too. You're sitting at 4%. We had a decent rally in bonds yesterday. Not a lot of follow through here today. But I would also point to the dollar, which is still firm. So it's not like the last 48 hours of trading have really changed dramatically the message since the Fed cut, which has been one about the potential for an economic refresh in the cycle. Some trading it like an early cycle, some just trading it like a mid-cycle refresh, whatever you want to call it. The fact that the dollar is still moving higher tells us I think the bond bid yesterday was basically because stocks got hit. You just saw a little haven buying of treasuries, a little dip down in the 10-year that still is doing that today. But the dollar strong and firm and continuing the trend probably tells you that yields are more likely to go back up, which is what we've been wanting to see. Economic data have been beating expectations. That does, though, apply some pressure to the numbers tomorrow for retail sales to come in clean, industrial production to come in clean. We did get the New York Empire yesterday, which was pretty weak, but a tertiary data point, not a big deal. It's all about retail sales. When you have the market rotating into things that depend on the economy, you got to have the economy hit in the right spots and have it improve. That's where you do get a little bit more of kind of a higher beta, riskier version of the rally, one could argue, when it's value-led. We're starting to see, too, some risk appetite build. If you look to crypto markets, I think that overlaps with some of the same idea here of branching out in our rally, just beyond what has been a very high-quality tech rally. Also, look at some of the earnings. Look at the airlines, up almost 4%. Banks have been carrying the market this week. All that points to a very encouraging message about the economic direction. Yesterday afternoon, we talked to J.B. Hunt. That's another one with transports looking really good. Transportation group also breaking out. Airlines now doing buybacks and rallying a ton. Don't usually see that if the economy is heading over a cliff. Kevin Hanks, Jenny Horn, hosts here on the Schwab Network, joining me this afternoon. It's the airlines leading us today, Jenny, and we are flying.
We are flying, okay, especially because I felt like Delta's earnings were more muted. I mean, we saw shares lower, and they still said, promising things. International premium cabins are still doing well. And, as far as overall trends are concerned, Delta is still able to grow. I mean, there's a lot to like. But then United comes today and basically echoes a lot of the same. Of course, also now adding this buyback, which is significant. But and they're just blowing it out of the water. I think a lot of it was their framing. Like, if you look at some of the language from their CEO, it was very much like demand is strong. Sure, we're seeing some slowdown in domestic, but also, as far as overall expectations for the remainder of this year and into 2025, they expect no slowdown. So it's just wild to me because we obviously talk about these names, banks, so much of the economy, so frequently. So 2 months ago, what happened to that? Banks were going to be down. Airlines were going to be down, cruises were taking a hit. Everything was like travel's going to take a hit, and the U.S. consumer is going to be stressed. That is all dissipated now.
Yeah, it's very true. The message by the market's very, very positive right now on the economy. Look at United up 14%. I knew this was going to, I didn't know it was going to 14%, but yesterday we talked about, in this morning when it came out, that the buyback on top of all of it for a sector that's very sensitive on margins is just a big flex.
On a day where they announced that capacity had actually gone up. That's normally a death blow for airlines.
Yeah, empty seats.
When they raise capacity. By the way, you didn't even give him credit for his pun.
It was so bad that we had to move on. Thank you. We're flying.
Stocks are flying.
That was
it was so bad that it wasn't even a pun.
But here's the thing. 9 of 11 S&P sectors are up today, with only 2 of the Magnificent 7 up.
Yeah.
5 of them are down.
Yeah, that's a good point.
That is a stark reality. NVIDIA did what we said it might do yesterday, which is ASML still down, NVIDIA up, right? So they bought the dip on NVIDIA on that news. That being said, Tesla's up only less than 1%. All the other 5 Magnificent 7 stocks are lower, and not by a little.
Yeah, Apple's getting dinged pretty good.
They're healthy lower today, yet 9 of 11 sectors higher. That's a strong day.
Meta down 1.5%.
Yeah.
These are ones that were just at highs. Meta's been making highs. Apple did have a really nice move to its record yesterday. So Apple and NVIDIA kind of in the same camp now where they're fighting for the highs. Yeah. So at least nominally the levels that they're at are pretty good. But I hear you, because that's a big chunk of market cap. It's not up today.
Those are the big boxes on the visualize tab. That covers a lot of real estate on that tab, yet the market's still higher.
Yeah.
That is amazing, and especially because, okay, ASML, I have never talked about ASML more in my life than I have the last 2 days, but that name's still down 6.7% today. And okay, so I think Taiwan is now going to be the next test, or Taiwan Semi, when they report tomorrow, because if we hear also some more tepid guidance from Taiwan, then I think you have some more concern, because they're like the next leg closer to NVIDIA.
Absolutely.
So, I mean, I think that, forget about, I'm not saying that ASML's move yesterday and today wasn't blistering, sure, but I had a hard time making the connection that you could say the AI trade is going to take a ding this earnings period. But if Taiwan echoes the same thing, there's somewhat of the mediator, then I think that's really interesting.
You're spot on. ASML 2 steps removed, where there's enough customers that are kind of legacy, slow, think Intel, that could have been responsible for this. Taiwan Semi disappoints. That's NVIDIA. Because look, Taiwan Semi's at the high. So
Taiwan Semi's biggest customers, NVIDIA and Apple.
Right.
If they're having a problem,
then we got problems.
If their coffers aren't full,
correct,
then that's a red flag.
40% of the revenue comes from those two. So if they miss, then it might be a little bit harder of a thing to ignore. But that's tomorrow's issue. I mean, retail sales, all the stuff that's been working this week is very consumer, cyclical, economic in nature. That suggests that retail sales probably should be good, I would think. I mean, the whole stock message often doesn't move too far. If retail sales bomb tomorrow, that's going to be a problem.
Well, the headline numbers are for it slightly higher, from 0.1 to 0.3. The X autos is only supposed to be up 0.1. So not a real exciting number out of retail sales, but we'll see. Remember, the market trades off what the expectations are versus what the real number is. So yeah, we'll see. The numbers don't look real big though, in terms of consensus.
Yeah. By the way, we should give just a quick shout out to the financials again, because a lot of times they are a very muted, slow start to earnings. They fade on the reports, but we're getting like blistering rallies in some of them. Morgan Stanley's are going like parabolic.
Okay, and you mentioned the consumer stocks this week. I also will say one of the best performers, I believe, if not the best as of right now, is Walgreens this week, which is up 19% this week. You talk about like the comeback rally. I mean, that
they're closing like an eighth of their stores.
I know. So I mean, like,
there's a deep value trade, if there is one at all, or a massive trap. But to your point, they're closing down stores, which is what they've always should have done.
Not a small number either.
Yeah, whatever stores have the most people coming in to get shots and stuff, keep those one open. Close everything else. Stop selling all the stuff they sell in the
They're
Amazon
locking up
stores.
the toothpaste, Oliver. At some point, that had to hit the bottom line.
Yeah, it's awful.
They're locking up the toothpaste.
If you go to a Walgreens in the city of Chicago, you cannot buy a single thing. It's awful.
Fair enough. All right, good stuff. Thanks, guys. Appreciate it very much. Jenny Horn, Kevin Hanks, good analysis of the session here. Joining us, Cameron Dawson, is the Chief Investment Officer at New Edge Wealth. Hey, Cameron, welcome back to the Schwab Network. Always good to have you.
Thanks for having me.
So tomorrow we got a pretty big set of numbers. We got retail sales, industrial production, our jobless claims, right when the market's really getting confident on a lot of these economically dependent groups. Are we going to be able to fulfill their needs?
Well, it is a pretty high bar. And one of the things that's been jumping out to us is that the equal weight ratio of consumer discretionary versus consumer staple stocks has been hitting new year-to-date news cycle highs all through the past couple of weeks, effectively saying that the equity market sees no concerns with the consumer. And that has actually coincided with rising forecasts for household consumption within GDP, meaning that when you see that ratio move higher, it typically means that people are growing more optimistic about overall consumption. The question is now the bar too high? Are we thinking that the consumer is more resilient than it actually is? And that gets put to the test tomorrow with that retail sales data.
Okay. What do you think we need to see there? How impressive do these numbers need to be? Do you see the market as pricing in like Goldilocks, stability in the economy? Or are we getting to the point where we need to see like early cycle growth, like we are heating up?
Well, it is a really good question, because it's like this market is singing queen. It wants it all and it wants it now. Because when we think about the backdrop between fiscal policy, which remains still highly supportive of growth, you're running big fiscal deficits. Now you have the added benefit of monetary policy, where you have Fed officials talking about hundreds of basis points of cuts, which means that this would be the deepest non-recessionary cutting cycle in the last 40 years. And all of this is happening in an environment where growth is above trend and resilient. And so when you're getting full out fiscal monetary into a strong environment, no wonder you have equity valuations so high. No wonder you have credit spreads so very tight. The question is, can it last? Can it stay? Because it's not about where you are, it's where you're going. And that's where we have to ask the question of, could we see possibly the Fed not cut as much going into 2025 if the economy is so resilient? Or could we see growth actually disappoint, meaning that we're underpricing the current risks for the economic growth scenario, which are our two big questions as we roll into next year.
Let's go back to a chart for a second here that fits right into this discussion, which is the discretionary trade beating the staples trade. And you've got another element added to it, which is, I think, consumption forecasts, like economic outlook. So take me through this. The black line here that's going up and to the right is where the discretionary is beating staples, right?
Yeah, this is one of our favorite charts. When you see that black line move up and to the right, it means that the market is feeling more optimistic about the outlook for consumers. When discretionary is outperforming staples, you equal weight it to remove the impact of things like Amazon and Tesla, which are big discretionary weights. But when discretionary is outperforming staples, it's a sign that the consumer is healthy. And it has coincided, as that chart shows, with rising forecasts for household consumption. It's when that turns lower that you typically have a broader risk-off environment. You typically are cutting estimates not just for GDP, but also for earnings. And that's why, if you look back in 22, discretionary underperformed staples. So we really see this as a barometer for how the equity market is thinking about the underlying growth of the US consumer, which we know makes up over 2/3 of overall GDP. So if there's one thing we watch and check every day, it's to make sure that that's still in an uptrend. And if it is, it warrants optimism about growth. If it rolls over, that's when you have to be a little bit more cautious about the forward outlook.
Okay. So right now it seems like, I mean, we don't have to throw caution to the wind, but we should be probably, it makes sense that recession odds are dropping, right?
It certainly seems that way. We haven't made a recession call over the last 2 years as we've continued to see this underlying resilience of the economy. Now, it doesn't mean that we should stop asking the question about recession. The risk is that as soon as you stop asking it, that's when the odds of recession go up. It's sort of like a boy who cried wolf sort of paradox. So we still think we have to kick the tires on this economy and not grow complacent about recession risks. And the one thing we're watching really closely is that we do know that there's been this slowdown in hiring in the economy. We've seen companies pull back on hiring plans. Look at the JOLT survey that shows this slowing in hiring. Oftentimes in past cycles, when you see a slowdown in hiring, it is led or followed by an increase in firings. We have not seen that yet. Firings remain very subdued, but if you start to see hiring slowing down, turning into increased firings, then we probably have to increase our recession forecasts.
Okay. Cameron, what about the stair-step style rally for stocks versus a melty kind of froth up? It's one of those things that it felt like has been brewing around several corners the past year, never quite got there. Maybe at the beginning coming into this year, I think about stuff like the crypto markets that had been lagging that are starting to wake up, the small caps that are trying to break out, now 2,300 for the Russell. A few of these things that require a little bit more confidence, a little bit more risk tolerance perhaps.
Yeah, it's such a good point because even though we see valuations back to the levels that we saw back in 2020, 2021 timeframe, as well as going all the way back to 2000, which would suggest that we are in some kind of bubbly territory, what has been missing, at least over the last 9 months, is that spark in speculative type of activity. So that would be a longer term concern for us, or a sign that at least in the short term, you're going into a bubble, which we know is destabilizing over the medium and long term. So watch things like high beta stocks versus low beta stocks. Watch things like speculative tech, IPOs, all areas that tend to require that speculative spark in order to get them moving. Crypto would be put in that bucket as well. If you start to see that because of, as I mentioned earlier, the fiscal backdrop, the monetary backdrop into a strong environment, that could be a signal that we're closer to the beginning of the end of this cycle, given the fact that usually you see that spark in speculative behavior in the last gasp of a bull run.
Okay. Cameron, in terms of assessing how deep people are exposed into risk right now, you've got to look at equity positioning that I think is pretty encouraging. It looks like it's not over its skis. It doesn't look too excessive to me. Am I reading it wrong?
Yeah. This is really interesting. This is Deutsche Bank's consolidated positioning report. And the observation here is that institutional investors in aggregate pulled back on overall equity positioning following the July peak and into that early August swoon that we had. And even as prices in the S&P 500 have climbed to new highs, you have not seen positioning get back to its stretch territory that it got to back in July. So you're still in about the 61st percentile. Back in July, we were closer to the 95th percentile, which is why we think we saw markets trade down and sideways and choppy from that point in July. Now, there's one point to mention, though, is that there are other indicators that suggest that positioning is stretched and that you have complacency in overall sentiment. Look at things like put-call ratios, look at household surveys on equity ownership. Those remain within 1% of 20-year highs. So it's not to say that there isn't this broad ownership of equities, but if you were trying to make a case for a rally and a chase into year end, we would pull up this Deutsche Bank chart simply because it would suggest that there are some players out there who need to chase and get back in to get a piece of this performance.
Wow. All right. So it sounds like there's some maybe potential melt-up chase that kind of has to happen if things go right and people aren't in the right place at the right time after a little bit of fear crept in. Cameron, you've got one company-specific look. Let's talk some Microsoft real fast because we are seeing some diversification within the Mag 7 trade. Some looking weak, some looking strong. How come this one's in your list of, I feel like otherwise, very macro-driven charts?
Yeah, it just catches our eye given the fact that it's an AI darling, the application of AI, the fact that it's now trading below its 200-day moving average. And it just speaks to how what you've seen in tech is some falling of flies, that some of the past leaders have started to stumble. It doesn't mean that there still aren't great places within tech and great opportunities, but this became a very expensive stock that saw earnings effectively flatline. And there's a message for the overall market here. There's a huge divergence that is happening, at least in the last month or two, within equity markets. As we've made new highs, you've actually seen earnings estimates for 2025 start to turn lower. So we're running on these fumes of valuation upside, and that was the case for Microsoft earlier in the year, and now we're seeing the opposite side of that as it has to kind of grow into its multiple. So it's certainly an important message of one of being overbought, being very valuation extended. It can have a payback on the other side.
All right. Always some fun finds there and some good nuggets, some great macro analysis. Thank you very much, Cameron.
Thanks.
Cameron Dawson, Chief Investment Officer at New Edge Wealth. All right, some positioning potential for a little chase if we get some more strength and economic data tomorrow to justify this rally coming up. Let's talk the earnings as well. Going into the Mag 7 trade, one very reliable winner has been Netflix. So pressure's on. We'll also talk a few other entertainment and movie trades too. Netflix is not the only one to play the big screen. Be right back.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
accelerate your market knowledge,
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Let's talk some earnings. We've got Netflix coming up. Joining us from Wedbush Securities, Alicia Reese is Vice President of Equity Research, covering the stock as well as other entertainment plays we're going to discuss here. Alicia, thanks for joining us. Netflix.
Thanks for having me, Oliver.
Absolutely. This is a pretty fun report because, I mean, Netflix is just killing it the past year. And it feels like their business model's gotten more reliable than ever these past few quarters. So should we be expecting less volatility on these reports nowadays?
Well, you certainly have a little bit of volatility expected because they're lapping the password sharing crackdown. The survey work that we've done in the quarter, though, does suggest that they are still benefiting from that. They're still cracking down on accounts. They hadn't run through every account. And they're still benefiting from the ad tier as more members who had churned out before come back and they choose the ad tier. Or if, they have never tried Netflix and they didn't like the pricing, they can come in at the ad tier as well.
Okay. And at this point, how much transparency do we have there on who's sticking around with that and what kind of metrics then drive the stock? What's kind of the most important metric then?
Yeah, so far, throughout Netflix's history, it's the subscriber numbers that matter the most. Increasingly, it's the ARM, the ad revenue, or sorry, the revenue per user, per member. And in 2025, they're going to stop giving those metrics. And so they want investors to focus solely on top line revenue and earnings. And the reason is because if you're just tracking the subscriber numbers, you're not seeing the huge benefit that they expect over time from that ad tier. And that's not just the membership, and it's also the viewership, how often they're on the platform watching those ads and how many advertisers are on there and how much advertisers are willing to pay for those ad spots. Right now, those CPMs are quite high. They started off astronomical. They've kind of come back down to earth, but I think they'll stay elevated over time as that viewership rises, and especially as Netflix adds live events and live sports. Those CPMs are going to rise even further. The viewership's going to increase, and Netflix's revenue is going to show that handsomely. And it's a little decoupled from that subscriber numbers.
When do they start offering shareholders a little bonuses, dividends plus buybacks? Like, are we at that point of maturity for Netflix?
Well, they're certainly producing a lot of earnings and a lot of free cash flow. Between 2023 and 2026, consensus estimates that EPS will more than double. And that's getting into a pretty astronomical range for them. And, that puts PEG quite low. They can certainly do it. They still see themselves as a growth stock. And I think they're going to continue to operate as a growth stock as long as investors allow them to. Once they start getting that significant pushback, then we'll start seeing some dividends, I think. But I think they'll at least try to get through 2025 with the ad tier as their growth driver.
Okay. Seems like they're getting close, to being able to kind of almost operate like an entertainment utility in a way, given the stickiness and the reliability of their customers. I think what's fascinating, though, that a lot of people don't know more likely, I think people know how dominant Netflix has gotten, but some of the other companies in your coverage have had really extraordinary performance over the past year. Cinemark is one. NCMI is another one, which is like an overlooked National Cinemedia, which, as I understand, is the advertising component. So is that just because people are going to theaters that Cinemark's doing so well, or what's going on here?
Yeah, so for National Cinemedia, the interesting story is that they had a horrible time, obviously, through the pandemic when theaters were closed or were underutilized. And then just as that was coming back, the ad market was faltering, and so they've just gotten hit from every side. And just as that was starting to come back, the SAG-AFTRA strikes hit theaters again. So they've had a rough go. But just about now, you're seeing the ad market start to come back. You're seeing theaters coming back in the fourth quarter, and certainly throughout 2025. So that should benefit National Cinemedia quite handsomely. They've just gone through an extremely long upfront season. And, we don't know how that's going to fall yet, but once they report on the next quarter, I think we'll get a good idea.
Okay. And is this contingent on how well the big movies do, or is this now just kind of like a recovery trade that's got momentum now that we've kind of normalized entertainment?
I'd say both, Oliver, because you have one side where it's the upfronts, where, you have to have a good recovering business for the advertisers to lock in those ad spots. And they have some of the highest CPMs in the industry because you have a really focused environment in a theater, especially after the movie start times. You have those premium spots where the lights are down.
Right.
All you see is this massive screen in front of you. So that ad spot is pretty valuable. What you also have is the scatter market. So if you're having, you see a really big movie out there that's just hitting really hard, especially Gen Z, those advertisers want to get involved. And so they're going to pay even higher CPMs in the scatter market. So you want to see both throughout the year, honestly.
Wow, fascinating. All right. Well, they might be missing me because I always show up after all the stuff. I'm just getting there right when the main event begins. Great stuff, Alicia. Thanks a lot.
My pleasure.
Pretty fun trades in there alongside Netflix. Big winners over the past year for Cinemark and NCMI. Coming up, let's look at the options flows. Mr. Kevin Green, 30 minutes left for the day into tomorrow's heavy session of economic data and earnings. We are flat for the NASDAQ, 0.5% for S&Ps, 58.42.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
This election season, stay out of the muck and the mudslinging with Schwab Network's by-the-numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk.
No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
All right, we got some time into the bell here to see if S&Ps can push it into tomorrow's slate of economic data. Kevin Green joins us for a look at the options flow. KG, should we start doing this for the Russell, or how do we handle small cap leadership?
I mean, we can if you'd like. We don't see that much when it comes to options flow for the Russell options, so it gets a little bit distorted. But small caps are doing a phenomenal job here, especially when you're looking at the regional banks. I think that's another area that, over the last couple of trading sessions has really caught a bid. And then also too, because we're not talking about flows, if you're also looking at the industrial plays for small caps, those are also catching a bit here today too, with the nuclear deal that was announced by Amazon. A lot of those stocks that actually could be beneficiaries of building out those nuclear reactors are also seeing a healthy amount of gains here in this session here today.
Okay. So, all right, right now, though, we get a pretty steady pulse of buying pressure from market makers, from participants.
We are, but Oliver, we might be stalling out here a little bit. If we're kind of looking at it over a longer term time frame, that 10-day chart, we had a nice little rally here after kind of a sluggish start for the session. And one thing to just kind of note here, we are starting to get up to that resistance zone that we highlighted earlier today. 58.45 was the earlier negative or positive gamma level that we highlighted. Now it's actually pretty much sitting at 58.50. That's where you're seeing the majority of the flows. I don't see anything above that. So I'm not seeing a lot of speculators really saying that we could actually push through and then just continue to gap higher into the close here today. Now that can happen, but once again, you're just not seeing that enthusiasm. In fact, we're having more of a flag pattern kind of taking place, hitting that area of resistance, maybe pulling back here a little bit. I would kind of focus on that 58.30 area as an area of support, a little bit of a pullback, and then trying to push up higher either for today's session and or for tomorrow's session. That would kind of complete this little cup and handle pattern that we have going on for the market, instead of potentially kind of reversing all of these gains and then kind of looking like a failed recovery. But right now, this does look bullish more than bearish for the moment.
Okay. And the potential for extended breakout, if we get through that 58.45, how do you think about that, Kevin? What would have to happen if dealers have to reprice and push higher?
Oh, it would have to be very aggressive. I mean, you're talking about just on the volume, and this is an estimate, just on the volume side alone at that strike price, you're looking at around $60 to $65 billion worth of gamma exposure, pretty much almost for every single tick that we have to the upside. So if we're able to break through it, yeah, you could have a really nice reaction to the upside. Those dealers would have to then buy those futures contracts to be able to cover themselves to the upside here, to at least try to stay delta neutral. It's just a very hard wall to try to break through. Usually when you have, $20 to $30 billion worth of exposure, those are kind of areas that you can try to just grind through, if you will. Once you start getting to 50 to $60 billion, that's some strong resistance on an intraday basis. That's going to be hard to break. But if we are able to, it could be a nice little rally to the upside. I just don't see usually when that happens, Oliver, you actually start seeing speculators kind of getting into those strikes, higher strikes. You'll start seeing individuals getting into the 58.70s and 58.75s in very large volume, right? To really get those dealers really off sides. We're just not seeing that right now. I'm seeing it pretty much capped out at 58.50 for the major flows going into the close here.
Okay. All right, and thinking about, the overall kind of data set tomorrow, I mean, kind of the big day of the week, but as far as like expiries go, the calendar for options goes, how do those two things fit together? Because it looks to me like tomorrow should be our biggest volume day of the week.
It should be. I mean, we will have initial claims coming out, I believe, and then we'll also have retail sales. Now, that retail sales number, I think the market is expecting that to come in line or even come in a little bit hotter, just based on some of the other data sets that we've seen over the last couple of weeks. But there is that expectation, or there is a thought process out there that maybe it does come in a little bit light. And no fault of the consumer. It could actually just be base effects that are actually happening when it comes to energy prices alone. Now, gasoline prices continue to actually go down as the futures were rising there for a bit. So if you're still having the same type of demand when it comes to gasoline, but the price of the per gallon goes lower, then it actually kind of distorts the retail sales data because it's not adjusted for inflation. So if it does come in light, I would suspect that comes in light because of the gasoline sales coming in, or gasoline prices on the retail side moving to the downside. And then hopefully we do see this rally try to continue or even just trying to recover. Can we look at the shorter term time frames? I think that one's actually very interesting here.
We got 1 day, 5 minute. Is that what you want to look at here?
Yeah, 1 day, 5 minute.
Okay.
Yep. So this is going to include the price action that we had yesterday and then what we are seeing today. It's no secret that 58.45 is going to be a key area of resistance. We saw that yesterday, and then now we are seeing that here today. We had a nice little move to the upside. Well, when we started the day, it was a little bit weak, and actually I have a ratio chart there. It's the SPX equal weight compared to the SPX in general. Equal weight was actually outperforming. So, all of these sectors are still trying to lift up this market, even though the mega cap tech stocks, for the most part, continue to drag the market down. I mean, outside of Nvidia and Tesla, I think all of the Mag 7 for the most part in the red today. They have recovered a little bit. Then we started getting a little bit of a bid. Now you're starting to see an acceleration of that trend line to the upside. We're stalling out. We're flagging out right now. We want to either break to the upside or even just maintain this flag going into the close. What you don't want to see is a unwinding of these call positions, and then that the markets basically fades back to the downside here. But I think that ratio chart, once again, I got to give kudos to the other 497 or 493 stocks that are out there. They've been holding up their end of the bargain. It's just the mega cap names just have not been able to follow through. Maybe that's going to be something that they're going to be able to do when it comes to earnings, and that's where we can kind of reprice to the upside for the broader equity market.
All right, nice. Looks like things are still generally favorable. Seems like it's going to take something meaningful to crack us, but we certainly kind of opened up the potential for it yesterday. But no follow through today. Puts it in the hands of data heavy Thursday. Thank you, Kevin Green. Appreciate that. SPX 58.43, a little below it right now. Let's talk some commodities when we come back. Look at the strong dollar. USD not messing around right now as the greenback continues to firm up. Now up 30 bips in the session. Also going to give you a little preview of our upcoming conversation. I talked with Vivek Ramaswamy this week about the potential for a second Trump administration and what the economy would look like. More on Market on Close coming up.
Ethan, how's my favorite client?
Great. I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends? All that research sounds exhausting.
Nope, Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes up to 25 stocks in just a few clicks.
Somewhat of a curious winner in today's market is the U.S. dollar, with yields down again, a second session in a row, dollar outperforming. Joining us, Dan Demings, managing partner at KKM Financial. Is dollar as a holding in there pretty decent? Dan, what do you think?
Strong, yeah. I mean, pushing up to what? Probably 2-month highs here, a little over 2-month highs, possibly, Oliver. A couple things. I think number one, inflation data coming out of the UK overnight, coming in below the 2% mark, putting pressure on the central bank to possibly cut rates. So I think that's keeping pressure on the British pound. We do get some inflation data over tonight, going into tomorrow from the EU. So we'll see how that unfolds. But I think it's about the strength of the U.S. economy, the fact that we are seeing rates basically adjusting for the possibility that the U.S. economy is not going to slip into recession based on some of the data, recent data, and the GDP now from the Fed Atlanta Fed meeting. And so those things, I think, are being incorporated in the pricing structure. And, we're going to see tomorrow retail sales will be coming out, and a couple of we got weekly jobless claims. But I just think it's just kind of the idea that we're seeing moderation and or shifting dynamic in the interest rate environment here. Couple that with what appears to be declining inflation in other parts of the world, and therefore it puts some pressure on the central banks to cut.
Okay. The pressure to cut, Dan, does that get relieved if we get a big retail print tomorrow? Because it seems like if that happens, bonds will have to go back the other way. Yields would have to spike.
Well, I mean, yeah, I'm talking about the pressure to cut in other other central banks, not the U.S.
Totally.
Because the U.K. Now you got year-over-year inflation in the U.K. is below 2%, and we get the Eurozone reading tomorrow morning. So here in the U.S., yes, I think you've already seen that being priced out. The odds are shifting quite dramatically here. Certainly, still a high probability of a quarter-point cut in November, but that's still, now there's still about a 6 or 7% chance that there's no change, and that certainly could change as we see these data points unfold here, Oliver. But yeah, I think it's more about the fact that we are seeing now some of the expected cuts, and the aggressive nature of the Fed to cut more aggressively coming out of the market relative to the rest of the globe.
Okay. Yeah, well said. It seems like the pressure around the world is a little bit more supported in the data to cut. Maybe a stepwise process here makes sense. Any strong thoughts on how to trade the market into the end of the week with all the data coming tomorrow? Dan, you got any favorites that you're looking at here?
Well, I think that, we're seeing that seasonality component of the small caps kicking in once again this year, Oliver. I mean, this is about the time as we move in October, November into December. Small caps have a tendency to outperform the larger cap names as you kind of get this rotation that unfolds for whatever reason, the seasonality. And now with, again, rates are shifting, but we are seeing them coming off of their recent highs and moving back down towards, the levels from a couple of weeks ago. But that, in theory, would be a tailwind for the small caps as well. So I think that's one thing, a theme that I think will continue as we move through the rest of the year, unless there's a big shakeup in the inflation front or the jobs number where we see the idea that the Fed will not cut at all. That certainly would impact the small caps. But overall, I think those seasonality trends are working their way through the market. I'll couple that with also, I think the rotation that's unfolding right now, you're seeing utilities certainly catching a bid, also transportation's catching a bid, and the regional banks. I mean, with the yield curve normalizing, I think the banking sector is going to benefit from that as we move through the end of the year as well.
Kind of seems like it is. Good point with that connection, because banks have been really leading here. The other stuff I'm watching, gold pretty close to the highs, right back below it again. Bitcoin trying to get out of this long-term downtrend. Either of those you like to play in, Dan?
I mean, the gold market is something that we use in some of our models. We really don't use Bitcoin at this point, but something I keep a very close eye on. Proxies possibly, MicroStrategy being one of them. But when you look at the gold market, I think the bid's going to continue there, even with the dollar moving higher. There's just strong central bank demand for gold as an alternative store of value, and that's going to continue, I think, as we continue to see the evolution of the global communities, and especially if the tensions from a global perspective remain elevated. Couple that with, I think Bitcoin has now found its sea legs again temporarily, and I wouldn't be surprised, Oliver, if we go back and challenge that 75,000 level, the highs that we did see from the summer, as it does appear to me now that after we broke through 64,500 or 65,000, that it appears to me that there's further upside for Bitcoin based on just the general trajectory and also the longer-term technical aspects of the market.
All right. Nice. Good conversation. Thanks a lot, Dan. Good
right,
range per usual. Appreciate that look at the dollar and the commodity market. Dan Demi, managing partner at KKM Financial. Right now, let's take a sneak peek at my interview with Vivek Ramaswamy on the latest episode of Market Overtime. The former Republican presidential candidate has a new book out. We discuss the policy differences between Vice President Harris and former President Trump, the biggest economic issues facing the next administration. Take a listen. The way you see inflation, the way it was caused, who is to blame for this? And if the answer is Biden, I guess I'll get ahead by asking, why is it Biden to blame when you had $3 trillion in stimulus under Trump in response to COVID, admittedly another $2 trillion under Biden, but then how do we shift to inflation blame entirely one-sided?
Well, look, I think that the fact of the matter is, look at what inflation numbers were, area under the curve of inflation under Biden versus area under the curve of inflation under Donald Trump, and area under the curve inflation, which by which I mean the totality of compounded inflation was undoubtedly significantly higher, not only under Biden versus Trump, but under Biden versus any other president we've had in nearly the last half century.
What do you think caused the big spike in inflation, Vivek, from your understanding?
Yeah, I think there's two factors. I think there's two factors causing it. One is, I mean, the number one overall factor is government spending that exceeds the capacity of the private sector to absorb that government spending that drives up prices. But an exacerbating factor here is a Federal Reserve that aids and abets that by printing money to fund that government spending, which in turn creates a monetary supply version of inflation as well. So I think the combination of the Federal Reserve's response as well as the government overspending are the two drivers of inflation, and now we're suffering the consequences.
President Trump not overspending by that definition, Vivek? $3 trillion stimulus during COVID. I mean, that was Trump. I mean, I talked to the man on the street here in Chicago, and he is ready to vote for Trump because he knows he got a stimulus check.
Well, I'll give you my perspective on this, right? And one of the things I talk about in this book, right? The book is Truths, the Future of America First. I say that because I think that there are many strands of the America First movement going forward. There's more of a protectionist strain. There's one that involves more muscular government involvement. There's the version that I prefer, which I call more the national libertarian strain, which is to say that we don't want to replace the left-wing nanny state with the right-wing nanny state. We want to dismantle the nanny state and restore true free market capitalism. Not crony capitalism, not one-sided capitalism with other trading partners, but true capitalism, I think, is part of what made America great the first time and is going to make America great again. One of the things I will say about Donald Trump is what he's built here is a coalition that I do think is quite diverse. And I was in an event over the weekend with myself, Ben Carson, Tulsi Gabbard, RFK. We were all speaking at the same event, and we all, four of us, share one thing in common: we all ran against Donald Trump for U.S. president. And yet, still on the basic rules of the road, even if we have our shades of disagreement with one another, and, you know, obviously with President Trump when we ran against him, we're still part of a broad big tent coalition that I think is what President Trump is leading. So if you want to get into the philosophy of what we think the future direction of America First should be, that's why I wrote this book, and I encourage people to take a look at not only this book, but a lot of what I've said about what I think the future policy direction is that we need to take in our country. Yeah. But when I think about who's going to grow this economy between the two candidates we have here, no doubt in my mind, it's why I've supported Donald Trump, is he's leading a broad coalition that, you know, includes diverse voices on a range of questions of incremental views on what the corporate tax rate should be, or incremental views on exactly how we should or shouldn't use tariffs. Those are, by comparison to the economic worldview of Kamala Harris, right now, those are details. Roll this forward 3-4 years, I think those do become essential questions. I think those become really important questions as we think about the future of the Republican Party,
the next level
and the conservative movement in 2028 and beyond. But I don't think that that's mostly what's at issue in the next 25 days.
All right, at 4:30 p.m., 8 p.m. Eastern Time. Check it out this week on Market Overtime. About a 25-minute discussion with a lot under the hood. So definitely make sure to tune in, as we're getting pretty close to the day now, just 3 weeks away. Coming up, we're going to get the Big Picture team in to take us to the bell. Less than 10 minutes left.
The market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Being lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see pattern. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways, as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I am very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
Welcome back to Market on Close. We've got 7 minutes until the bell. Joining me, Joe Mazzola is a head trading derivatives strategist, and Cooper Howard is a director and fixed income strategist at Schwab Center for Financial Research. Afternoon, guys. Joe, get us started here. Stocks finding some leaders outside big tech. How encouraging is that going into tomorrow's slate of data?
Yeah, I mean, look, Oliver, we're within a stone's throw of all-time highs again. You've seen the Russell kind of join the party finally. If you look at kind of the sectors with the best breadth of recent, it's not tech, right? It's utilities, materials, industrials, financials, discretionaries. I mean, it's showing that we can extend beyond just the tech leaders and see some strength below the surface. And what I find is interesting is this is, with the backdrop of an earnings season that's started fairly well so far. Only about 10% of the S&P 500 has reported, but the expectation for year-over-year earnings growth was around a little over 4% kind of coming into the quarter. And that had been dropped fairly dramatically from the about 7.5% expectations coming into the cycle. And we're right around that 7% now. So, the bar was lowered maybe a little bit too much by the analyst, and the market's responding and rewarding those that are beating.
Okay. As we get a lot of data coming in tomorrow, Cooper, what is your baseline for the bond market? We got a decent bid into treasuries yesterday, and not a lot of pushback to it today.
Yeah, so it looks like we're in a little bit of a holding pattern for now. So I wouldn't be surprised if we see a little bit of choppiness going sideways, Oliver. I think that if we harken back to that non-farm payroll report, that did raise the debate of, are we going to get a pause or are we going to get a 25 basis point rate cut at the next Fed meeting? So we know that the biggest driver in terms of yields is the direction of Fed policy. It's likely going to be lower, but how much lower and how quickly are we going to get there? I also think obviously we get the claims data tomorrow. That's going to be important given the given the attention and the focus that many Fed officials have been paying towards the labor market as of recently.
Okay. Joe, do you think bonds, if they sell off, stocks should welcome that? So far they have the last 3 weeks. Is there any limit to the equity market's tolerance, say if we start pushing to 4.2 in the 10-year?
I think the one thing that is maybe holding the equity market back is the fact that there's still a lot of hedging activity going on. You're seeing a lot of buying, whether it's the SPX, but you're also seeing it in the NASDAQ and even the Russell, where people are paying a lot of money for these options. And I think the difference is that they're not getting rewarded for that. So I look at the spread between the implied volatility and then the realized vol, which is basically is the juice justify the squeeze, right? And so what we're seeing right now is people are paying up for these options, but we're not seeing enough movement in the market. Could be something around, maybe some of the gamma levels that we're seeing, and it's kind of forcing some of that compression of the equities around these strikes. But at the same time, there's a lot of hedging activity heading into the next couple of weeks. Yes, we know the election and there's other geopolitical risks, but it'll be interesting to me to see whether or not some of that starts to abate a little bit, or if you continue to see more and more of these option buyers step in. Is that something that can maybe push the market one way or the other? Time will tell. But we're seeing levels right now in elongated VIX levels that we haven't seen in a couple of years, where we're trading above the 200-day moving average, now coming up on the 64th trading session where we've been above that 200-day moving average. That's something we haven't seen in a couple of years. So just interesting to kind of note.
Yeah, for sure. VIX has been pretty stubborn, edging down a little bit here this week off of 20. Cooper, looking at the shape of the yield curve and bonds, we had the bull steepener, but then since the Fed cut, we had a good bit of bear steepening. What do you think is going to kind of be the contour going forward?
Yeah, so a little bit of a surprise maybe to some people is that the Fed cut rates and interest rates actually go up. We still do believe that the direction for the yield curve is more steepener. So we do think that it's likely that we're going to enter into more of a bull steepener led by further declines on the short-term rates. Again, we think that the direction of Fed policy is going to be lower, so that should help pull short-term yields lower, Oliver. Now, I think that there's probably less likely upside on longer-term yields unless we have something like a growth scare or an inflation scare. As of now, it doesn't appear that any of those are in the cards. However, there could be a little bit of a surprise, but we think that probably for longer-term yields, it looks to be that there's a little bit of a cap there.
Okay. Well, right now, the cap seems to be holding on enough for volatility to subside a little bit, and equity markets welcoming that. Thanks, guys. Joe Mazzola, Cooper Howard. We'll see if any of that changes tomorrow with all that economic data coming through. We do have some earnings this afternoon. Going to get a little bit industrial, CSX on the transports, Kinder Morgan for the energy trade. Be right back.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time learning. Trade brilliantly with Schwab.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Schwab.
Have a choice in how you invest with Schwab.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Binge watch the market with the Schwab Network.
Stocks all green. NASDAQ with a 7 basis point climb is a bit of a victory, considering that it looked like we might get a second session of selling, but NVIDIA turned around and we saw the low for tech put in shortly after the opening bell. So it was a grind. Wasn't too impressive for the big tech category, with many of the Mag 7 lower, 6 of them basically, but enough of a bid into NVIDIA. And enough else across the market, too, for the NASDAQ to end positive. Highlight, of course, was the Russell, but the S&P, nice little about 40 basis point climb, a little bit more than that, almost 0.5%. But that's still below our all-time high from Monday. Can't really complain too much, I don't think, about being this close to records. A little shifting leadership I'll talk about in the Risk Radar segment, going through some of the most compelling charts for breakouts. But we do need to shift our attention to some earnings. But yeah, today was not great for the semiconductors, but it could have been worse. So we tread a little water into tomorrow's Taiwan Semi Report. Joining me, Kevin Green and Caroline Woods, our senior markets correspondents, as we've got CSX and Kinder Morgan coming out this afternoon. Companies that I think deserve a little bit more attention than usual, given our discussion yesterday for JB Hunt and the strength of the transports overall. CSX, I think, then carries a little weight here, pun unintended. Good afternoon, Caroline. Get us started. What do you think? These companies have a little bit more fun than usual?
I don't know. I don't necessarily look at CSX and Kinder Morgan as fun companies, but I'm excited to be here with you.
Well, when people are thinking the economy's going to heat up, you know, we got to get some trains moving. The Bobby Bacala trade.
Structure with Kinder Morgan is probably more what gets Kevin Green excited. But no, I think that, it's important to note for CSX, obviously, it's had a good month, up about 3% this month. Could be impact from the port strike. But it hasn't done a whole lot this year. It's only up about 2 and change year to date. I will say, though, analysts on the whole are pretty bullish on that name. So, it should be interesting in terms of, how they actually report. I'm just looking here now because I'm seeing shares start to move lower. So it looks like maybe they're not going to impress because it's a miss on the bottom line here with 46 cents per share in terms of the adjusted EPS. The expectation was for 48 cents per share, so a miss by 2 cents there. And then revenue of $3.62 billion. The expectation was for revenue to grow about 3% to $3.68 billion. So that's a miss on both the top and bottom line. So I guess this is exciting here because it's, we've only seen, about 50 companies or so report earnings at this point, and on the whole, they've been better than expected. So here's a miss on both the top and bottom line, and we're seeing shares trading lower because of it. Have to look to see if I see anything for outlook. I know in terms of previously they had said low to mid-single digit total volume and revenue growth in the second half of this year. Not necessarily seeing what they have to say quite yet for the full year, but yeah, it's not looking good for CSX.
Yeah, definitely taking a little bit of a hit here, and the aftermarket is trading pretty actively. No credit for at least positive revenue, 1.5%, 1.4% growth. KG, not impressive enough to just have a positive number there?
Yeah, well, it's still a little bit weak compared to the street's expectations here, Oliver. So when you're talking about CSX, and I am actually excited. This is probably the most important company this week, in my opinion.
Really?
Yeah. I mean, at the end of the day, it's really showing what's happening with the overall economy here. Now, a couple of things have really have been headwinds for them, especially for this quarter. One is going to be coal sales, which they do transport a fair amount of coal on the East Coast. That's been a little bit weak, and it looks like it's going to continue to be that way in the near term. And the disruptions that they're going to see from the hurricane probably will also impact their top line moving forward. I believe that they did make a mention of issues when it comes to logistics. And then on the other side of that too, prices going down for fuel. You would think that would be actually a tailwind for a lot of these railroad companies, but they actually make money off of that. They charge a fuel surcharge to their customers. So as fuel goes down, they're not actually able to profit off of that as aggressively, and they actually do profit. They're kind of energy traders at the end of the day. So that also came in a little bit weak. Obviously, we know prices are going to the downside here. And then when you're looking at intermodal, especially when you're selling cars, which they're the major transporter for cars off the East Coast, that's also been slow. Car sales have been, for the most part, slow. So not surprising that you're actually seeing this report, a little bit of a pullback here. But I think the longer term optimism from analysts is spot on when you're talking about infrastructure spend here in the United States.
Okay. And I do think that, if we can get enough of these adding up in the right direction, then it gives a whole kind of different spin on an economy where all of the manufacturing related stuff has been really slow. That, recessionary basically. This is kind of where you have that argument that even if the numbers aren't great, if they don't show further deterioration, then it suggests a turning point, at least in that sector of the economy. Or Kinder Morgan kind of overlaps as well too. All of these being a little bit more industrial in nature, a little bit more commodity centric. And also just in the fact that, we have had lackluster demand internationally. I feel like a lot of this would reflect very positively on this here. Kinder Morgan has been in a wild chart on the year, Caroline. So, that one's been a huge winner.
Yeah, different expectations, I would say, for Kinder Morgan, given the fact that it's up more than 40% year to date, or right around there. And it looks like they're actually missing on the bottom line and top line as well. Adjusted EPS of 25 cents. missing by 2 cents as well. It's a theme here today. And then on the top line, $3.699 billion, lower than basically the $3.8 billion that analysts were looking for here. There are some estimates that were as high as just under $4 billion, so bigger miss there. So I'm just looking through here in terms of some of the commentary. Talking about the war in Ukraine, conflict escalating in the Middle East, talking about energy security and whatnot, but I haven't seen in terms of just commentary on the quarter just yet. But definitely, this is one that I know. I believe it was B of A just upgraded because of their, natural gas pipelines and turning more bullish on the name. But it doesn't seem like, I know that was a bright spot last quarter when they reported, but obviously not enough of a bright spot to actually help it achieve analyst expectations.
Right now, it looks like they are going to miss some of those expectations as well. Adjusted EBITDA, $1.88 billion. Analysts were looking for $1.92 billion. Looks like they're going to keep their fiscal year earnings outlook of EPS for around $1.22. It does seem like they did miss a little bit here. Their adjusted EPS for the third quarter, 25 cents. Street was expecting 27. Distributable cash flow, definitely important for this company. They see the fiscal year at $5 billion, but per share, they came up about 1 cent short on distributable cash flow, DCF, for the trailing quarter. So a couple misses. KG, I don't know if the market cares. It's kind of chopping around. It's doing all right so far.
Yeah, so for this name, it's just been on a tear lately. I think there's a couple of factors that have been in place. I think you had the hurricane trade that was actually setting in here. You have the optimism when it comes to liquefied natural gas. Kinder Morgan transports over 40% of all natural gas here in the United States, and it's a major player. And so liquefied natural gas, when you're looking at the actual operations themselves, is really constrained. It doesn't have the infrastructure in order for it to expand, but we are seeing demand globally just continuing to rise, and they've been able to utilize longer-term contracts to be able to hedge off some of the short-term fluctuations when it comes to the gaseous form of natural gas. So I think that's kind of one of the issues, and one of the benefits why you've seen the stock go up, but one of the issues that you're seeing when it comes to the reaction here for the market here today. But it does appear that they're going to also be kind of mitigating some of their expenses moving forward. They're investing a lot of dollars into their infrastructure for the long term. So I'm not sure if the price action's kind of gotten away from itself. I think there's just a couple of different factors there that's more structural in nature rather than maybe speculative.
41% rally on the year. Think these numbers are good enough to at least hold that, Kevin?
I mean, if you still have the demand for liquefied natural gas and the trajectory for that demand continuing to rise, then yeah. I mean, if you're looking at, you're able to sell liquefied natural gas at almost 3.5, 4x of what the gaseous form is going for right now. And so the logistics, when you're looking at overseas, Russia, Ukraine, even if you're looking at Saudi Arabia and Egypt, that all is shifting because of these geopolitical risks that is out there. The U.S. is going to directly benefit from that. Kinder Morgan is going to be a player in that space, and these regasification plants, if you will, take 8 to 10 years for them to actually be ramped up. So there's a constraint when it comes to liquefied natural gas, and this is the whole play for them right now. It's nothing else.
All right, good stuff, guys. Thank you very much. Caroline Woods, Kevin Green, a couple nice little industrial-themed earnings there. Not too bad of a response so far. A little drop in CSX, but not too big. George Tillis got a different type of energy on his mind. Our overlooked stock of the day is a nuclear winner, OKLO, with Amazon's latest investing into the nuclear world. That news, on top of what we heard from Microsoft and others, the sector is definitely deserving of attention. We'll be right back. This election season, stay out of the muck and the mudslinging with Schwab Network's by-the-numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk. No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
A fresh take on the hottest trends in the market. from every click to every tick.
There's no fear of missing out on next-gen investing. 1 p.m. Eastern, only on the Schwab Network.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Stock market's going nuclear. We've got a lot of winners in the new energy category as big tech looks to power all of its AI. George Tillis joins us, senior markets correspondent. We got robots we got to feed, George. Why not with nuclear energy? What could go wrong?
Well, OJ, we've seen a lot of stuff going on, obviously, with artificial intelligence. And there's, if you look at the utility stocks, quite a few of them like NRG and CEG Constellation, Vistra, VST has just come across, the ticker tape. These stocks have just been on a tear over the last year, and it's all about the expectations of higher electricity prices due to demand for AI data centers and all the technologies that are obviously in the forefront right now in terms of new technologies. So energy consumption is expected to increase, and so on the back burner we have certainly other forms of energy production or electricity production outside of coal and natural gas, and that's nuclear. And nuclear has now found a little bit of an additional, interest, if you will, from the standpoint of, companies like Microsoft looking at the 3 Mile Island reactors to restart those. And now there's a whole group of stocks, including companies like OKLO, which are essentially starting to establish models, or if you will, designs of technologies for small modular reactors that can actually be moved to certain site locations. So there's a trend going on with nuclear energy, especially on a forward basis, based upon the demands for energy, electricity, particularly because of AI data centers and the needs in that regard. But it's not just these small nuclear reactor or modular nuclear reactor companies which have been moving. Traditional utilities, like I said, if you look at NRG and Constellation, CEG, over the last year, these stocks, in some cases tripled, if not quadrupled. And Vistra Energy, symbol VST, also in that same camp. There's obviously some pricing for forward electricity going into next year, which was significantly higher, and that's pushed a lot of these stocks higher. But you have to keep in mind that these smaller companies like Oklo, which did receive a DOE approved safety design. In other words, their design was approved. Doesn't necessarily mean they're approved to start operating a modular reactor. There's a lot of backing from big tech companies. Microsoft with CEG, now you have basically Amazon and Google backing some of these small modular reactors. And again, they're making investments because of the demands for energy.
Okay. George, how do we determine what's going to be the determining factor for if these trades, valuation-wise? I mean, look at these companies. Like, a lot of these are not even, they're so early stage towards profit that, like, we have to still describe these as somewhat highly speculative, even though it seems like the energy demand is absolutely real. It's going to have to come from somewhere. Might it be these companies in this sector? Sure. But, like, for each company, you've got some pretty wild financials here that you're going to have to stomach as an investor.
Correct. So first you got to separate the groups of, traditional utilities that have revenues and earnings versus not. And some of the names I mentioned, like Constellation, NRG, their stocks have gone on a tremendous tear in the last year, but they do have revenues and earnings. They've been around for a long time, and they're operating under regulatory conditions under public regulatory commissions in each respective states. Forward prices for electricity have risen, especially for next year. That's why they're on a tear. Some of these smaller players, like Oklo, for instance, which we're primarily focused on, they haven't generated a dime in revenue. And so this is a company that's still in R&D phase. I don't see any expectation for revenue, at the very least, until 2027, late 27. And essentially, with the market capitalization, yesterday was $1.4 billion, so today it's about $2 billion. There seems to be, of course, a lot of interest from speculators pushing these stocks higher. Now, you got to keep in mind, a company didn't make any revenues last year, lost $560 million. So that needs to be financed, and that's going to be financed through equity offering. So I'm just saying here that this is, I can't do any analysis on this company if they don't generate any revenue. So it's still under, of course, speculative scrutiny, and you have to consider that. There are risks involved. But there are also other risks. One, obviously, the revenue mix isn't there. There's no revenue. They're burning through cash. There's also regulatory risk and safety and waste disposal issues that are going to need to be dealt with when these companies eventually get to production stage, if they ever do. There's also national security risk because, moving nuclear materials around requires a lot of planning and a lot of regulatory and even security protocols. The military uses nuclear fuel for their warships and other devices. Utilities use it, but those are basically operating under large security regimes. And so these are the challenges I see for this smaller industry, which again has caught a lot of interest, but right now it's still speculative.
All right. Speculative, but with good grounding and in the logic of kind of how, this story is going to go. So that's where I can get it. It's not like totally, out of left field. I mean, this is very much where we're going, it seems like, as we're restarting facilities and whatnot. But anytime there's excitement like that, I mean, there's going to be volatility as well. There's certainly going to be a lot of pressure for earnings to deliver, but it may not, be required overnight. These things might be able to run a little bit until, we really get to, the point where the rubber meets the road and they got to generate some earnings to justify these valuations. Good one to put on our list for sure. Thanks, George. Good overlooked. Oklo, OKLO, up big again today. Risk radar up next. Something really interesting happening in the market going into tomorrow's big slate of economic data. Green light on stocks. Be right back.
Ethan, how's my favorite client?
Great. I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends?
All that research sounds exhausting. Nope, Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes, 40 customizable themes up to 25 stocks in just a few clicks.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. All so you can trade brilliantly.
Ethan, how's my favorite client?
Great. I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends?
All that research sounds exhausting.
Nope. Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes up to 25 stocks in just a few clicks.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
Couple big things happening under the surface of the market here this week. It was supposed to be kind of a quiet week, but now tomorrow gets really interesting. Look at the leadership so far this week, and you're going to find a very positive message about the economy. Perhaps one that needs some validation by retail sales tomorrow, but generally we've had weeks of trend now building to get us here. Most important charts that I see are the regional banks and the blue and the transports. The cash tag doing a lot of work there on the DJT, Dow Jones Transport Index. Obviously, they look pretty similar. They're very cyclical in nature, very economically dependent, these groups. A little more tied into an economy and a theme that is about recovery or improvement, maybe not reflation, but at this point, some arguing an early cycle type of shift after the Fed cut rates 50 basis points. A lot of this stuff starts to add up for potentially a heat up in the economic cycle. We've seen a lot of failed starts for the regional banks. This looks like a real breakout. Financials have been well supported by the earnings this week. It looks like the commercial real estate concerns, that ticking time bomb has been diluted. It also seems like the big banks that acquired assets from the distressed ones a couple years ago are doing just fine. So that gives a lot of confidence into the economy. The transports are looking pretty good after J.B. Hunt. CSX wasn't great, but it wasn't terrible either. These things are pointing towards a little bit more of a cyclical bend in the market and what one could argue is a value rotation. Value factor has been outperforming. And keep in mind, we got the new high in the S&P 500 without big tech leading. It's great that NVIDIA is still sitting near the records, and Apple is too, but we've seen a good amount of breadth shifting in favor of things that are more cyclical. A lot of false breakouts by the small caps, by the regional banks, and by the value trade in general over the last year, but this one looks like it could be very real. Look at the way the 10-year yield's been trading next to the dollar. We got a bit of a bid into the bond market. I don't think that's what you want to see. You want yields to keep going up if you believe generally in the recovery of the economy or an acceleration in the economy. And the fact that the dollar's been strong these last 48 hours while yields have come down suggests that bonds, if tomorrow's numbers go well, will have to start selling off again. If the data tomorrow come in strong, get ready for a pop in yields. I think the market should be able to handle it, and you might have a little back and forth because sometimes the small caps and the value trade do panic a little bit if yields go up too much. But we generally know that there is a cap to how aggressive the Fed can get, and it's pretty dovish right now. Basically, you're just going back and forth between 25 or 50, but the concept of hikes is pretty much out the window. And if we don't have to worry about that, then the message right now of the rise in the dollar and the yields is that we don't need cuts because the economy should recover. That's the message that's echoed by the value trade, the regionals, the transports, and the small caps. The catch, of course, is that when you get more cyclical in nature, you have to have the economy live up to expectations. So there's a little bit more risk attached to that. The regional bank trade, obviously a little bit more speculative than perhaps the major financial trade. The small caps, a little bit more speculative than the big caps that have been so reliable now, centered around tech. So with the notion of the value rotation does come a little bit of a higher beta, a little bit of a riskier trade, and that's where you're starting to see the crypto markets warm up too. Bitcoin's been in the long-term channel to the downside, but now multiple days hanging out above that trend. It's not a breakout just yet, so the green light's not on crypto, but I think it's time to turn it yellow from the red because this has been a very reliable trend that now is bending. Hasn't quite released crypto to the upside, but if we are going to have that type of value rotation, the potential for Bitcoin to join in is there. So we get a yellow light, stocks still green, bonds might have to go red and the dollar green if tomorrow's data are warm, but this is an encouraging message about the economy. Let's hope the retail sales, industrial production, and jobless claims tomorrow live up to the expectations the market's now built in. Have a great night.
The
market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Being lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see patterns. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I am very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
This election season, stay out of the muck and the mudslinging with Schwab Network's By the Numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk. No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.